Hello students, myself DV Subramanyam, Chartered Accountant and Qualified Cost Accountant. I also achieved 3 times All India ranks in CA CMA examinations. Coming to this video is all about CA Foundation Business Laws Quick Revision. And in this quick revision, I covered 4 chapters, namely Negotiable Instruments Act having a weightage of 10 to 15 marks, Companies Act having a weightage of 15 to 20 marks, Limited Liability Partnership having a weightage of 5 to 10 marks, Indian Partnership Act having a weightage of 15 to 20 marks. Approximately, this quick revision is covering 60 marks of your examination. And throughout this quick revision, I used summarized notes prepared by me. You can see the summarized notes. Yes, this is for Limited Liability Partnership and Indian Partnership Act. And you can also look at the page numbers. Yes, I summarized entire these 2 chapters into 26 pages considering all key points. Reading these key points, it's sufficient if you write these points in examination for scoring maximum marks. As you all know, we are getting practical questions. So for provisions point of view, if you write these key points, it's sufficient. You can score maximum marks. And coming to Negotiable Instruments Act and Companies Act, yes, 2 chapters I summarized into 22 pages. You know, these 4 chapters I summarized into 48 pages document. Understood? So you can watch it at a standard speed. You will get maximum benefit once you watch it and once you revise these 2 documents. Getting it? So stay tuned and watch the marathon. So let's continue our revision with Negotiable Instruments Act 1881 chapter. So first of all, what is the meaning of a negotiable instrument? Negotiable instrument. So as you all know, instrument means a written document. A written document capable of creating rights and obligations on the parties thereto. So any written document which is capable of creating rights and obligations on the parties thereto, we call it as instrument. Suppose if you take promissory note, I promise to pay you rupees 5,000. I promise to pay Mr. X rupees 5,000. So because of issuing this promissory note, I'm having an obligation to pay 5,000 and you are getting a right to receive 5,000. Now it is a written document and it is creating rights and duties on the parties to that written document and we call it as instrument. Now any instrument, if it is transferable by delivery in case of bearer instrument, by endorsement and delivery in case of order instrument, we call it as negotiable instrument. So finally, the meaning of negotiable instrument, any written document capable of creating rights and obligations on the parties thereto, and if it is transferable by delivery or endorsement and delivery, we call it as negotiable instrument. So a document freely transferable by delivery or endorsement and delivery, passing property to a bona fide transferee. Property here refers to ownership. Bona fide transferee. As you all know, in transfer, you will find 2 parties, transfer or transferee. So for the time being, transferee is nothing but owner of the instrument. So transferee gets ownership. Genuine transferee gets ownership of the instrument. Next one, if you look at the types of the instruments, Negotiable Instruments Act deals with only 3 instruments: promissory note, bill of exchange, checks. By customs, hundis, treasury bills, bearer debentures, railway receipts, delivery orders, bill of lading, all these are negotiable instruments, but NI Act is not applicable to these instruments because Negotiable Instruments Act main objective is to create a system which is a complement to money. So as you all know, trade transaction 2 types, cash transaction, credit transaction. Cash means, at the time of purchase only you will make payment. Whereas credit transaction, you'll make payment after 2 months or after 3 months. That means after expiry of credit period. Now, to complement this credit system, yes, buyer is having an obligation to pay. Seller is having a right to receive that money. So to complement money with respect to credit transactions, then Britishers government introduced the concept Negotiable Instruments Act. So negotiable instruments primarily speaks about money. So if you look at treasury bills, bearer debentures, railway receipts, they talk about some other things. Railway receipt talks about ownership of goods. Bearer debenture talks about, creditor. That means you lend money to the company. So you are a non-trade creditor, like that. Delivery orders, bill of lading, all these talks about some other purposes. Whereas promissory note, bill of exchange, check talks about money. So that's why NI Act is applicable only to three instruments. One is promissory note, bill of exchange, check. Next one, instruments are of two types. Negotiable instruments are of two types, payable to order, payable to bearer. See, payable to order, if payee name was mentioned on the instrument. So who is payee? The person who is entitled to receive payment of the instrument. So if payee details are present on the instrument, then we call it as order instrument. If payee details are not present, or if it is expressed as payable to bearer, bearer means simply possessor, one who possesses that instrument, he is entitled to receive amount of the instrument. So then that instrument is known as bearer instrument. So instrument two types, payable to order, payable to bearer. When an instrument is addressed to payee, pay to specified person, then we call it as order instrument. When instrument, if there is no direction of payee details, then we call it as bearer instrument. See, without prohibiting transfer, allowing possessor to demand payment, all this I will explain you in types of instruments. Next one, coming to essential characteristics, instrument must be in writing. Definitely, oral instrument, it will not exist. So definitely instrument means a written document, so it must be in writing and it must be signed by the parties making the instrument, or else that instrument will not get any legal enforceability. An instrument must be freely transferable. As I told you, negotiable instruments main objective is to complement money. So money is freely transferable. Similarly, negotiable instruments should be freely transferable, and holder's title is defect free. See, holder's title is defect free means actually we had a concept of nemo dat quod non habet. That means no one can transfer better title than he possesses. For example, Mr. T, he is a thief of a gold chain. He stolen one gold chain and he sold that gold chain to Mr. I, innocent person. So do you think Mr. I gets ownership of the gold chain? The answer is no, because no one can transfer better title than he possesses. Actually here, the seller, Mr. T, is not having any title, therefore I will not get any title. That is the rule of nemo dat quod non habet. But coming to Negotiable Instruments Act, our NI Act is an exception to this rule. So that means here you will find two parties, transfer or transferee. If transferee receives that instrument for consideration in good faith means what? Transferor is not having any title. Suppose transferor is having defective title in the instrument. Defective title. Transferor is having a defective title, not valid title. But transferee is taking that instrument without knowing about the defective title of transferor. That means transferee is said to be in good faith. So if transferee receives instrument for consideration, if transferee receives instrument in good faith, and if transferee receives instrument before maturity, in case of time instruments, so we call transferee as holder in due course, and holder in due course will get better title than transferor possess. So that's why here we had a characteristic called holder's title is defect free. So any person receiving instrument for consideration in good faith before maturity will get a valid title even though transferor had no title. Next one, transferable still satisfaction. So there is no restriction on number of transfers. You can transfer negotiable instrument infinite number of times, but till its satisfaction. Satisfaction means once payment is done against that instrument, yes, that instrument is said to be satisfied. Unconditional promise under order to pay money only. The instruments like promissory note, bill of exchange, check should contain order or promise. That promise or order should be unconditional. That means condition should not be attached. So no condition should be attached. And these instruments should speak about money. These instruments should speak about time of payment, and these instruments should speak about who the payee is. If payee details are blank, then we call it as a bearer instrument. If payee details are present, we call it as an order instrument. But there should be certainty. Suppose I promise to pay you 5,000 or 6,000. Now amount is uncertain. It is not a negotiable instrument. I promise to pay you 5,000 rupees at Hyderabad or Delhi. Now place is not certain. Instrument is invalid. I promise to pay you 5,000 rupees after 3 months or after 5 months. Now time is uncertain. Instrument is not valid. So here sum of the amount, time of the instrument, payee, next one, place of the instrument should be certain. That means should be known. Next one, instrument should be delivered. Simply, creating a promissory note, creating a bill of exchange alone is not sufficient. I should deliver this instrument. Suppose I created a promissory note in favor of you. And if I keep that instrument in my possession, if I hold that instrument will not get any legal enforceability. The moment I deliver this instrument to you, you get right to enforce that instrument. So instruments will get enforceability only when they get delivered. So these are the essential characteristics of negotiable instruments. In detail, one by one, I'll discuss with you in the respect to instruments. Now, first instrument is promissory note. So, promissory note. Here, first you need to understand a trade transaction. As you all know, two parties will be there in a trade transaction, buyer, seller. Imagine this is a credit transaction. So, buyer is called debtor and seller is called a creditor. So, debtor is having an obligation towards creditor and creditor is having a right over debtor. Now, debtor, he is making a promise to creditor like this. I promise to pay Mr. Creditor 2 months after date, sum of 5,000 rupees, and it should be stamped and signed by debtor. Now this is one kind of promissory note. So signed by debtor. So this is one promissory note. So if you observe carefully, debtor is accepting one responsibility. I promise to pay Mr. Creditor how much? 5,000 when 2 months after date. Suppose this instrument was created on 10th January 2025. So from 10th January onwards, we will add 2 months time and we will also add grace days. So finally, you will get maturity date. On maturity date, I am liable to you. How much? 5,000 rupees. Now this is nothing but a promissory note. A promissory note is an instrument in writing. Definitely every instrument should be in writing and not being a bank note, not being a currency note. Because if you look at 50 rupees note or if you look at 500 rupees note, it will also contain the same matter. I promise to pay bearer a sum of 500 rupees. So that means a bank note, currency note is also a promissory note. So by virtue of this definition, many think that Negotiable Instruments Act is also applicable to bank note as well as currency note. That's why promissory note definition is excluding these two instruments. Bank note means, RBI issued note. Simply, whatever money we are using right now, 500 rupee, 50 rupee, all these are bank notes. Currency notes means, Government of India will issue currency notes, 1 rupee note, 5 rupee note. All these are, notes issued by the Government of India. So our promissory note definition is excluding bank note, currency note. That means NI Act is not applicable to bank note, currency note. Containing an unconditional undertaking. Undertaking means responsibility. So debtor is accepting one responsibility. And he is accepting that responsibility without adding any conditions. That's why the undertaking should be unconditional undertaking. Signed by maker. So who is the maker of the promissory note? Obviously debtor. Signed by debtor, you will see debtor signature to pay certain sum of money, that is 5,000, to a specified person, that is Mr. Creditor or bearer. So here, in parties, we are having two parties. Maker, person making the promise to pay, signs the note. He is the maker of the instrument. In our language, we call him as debtor. And payee, to whom the payment is to be made. In our language, he is a creditor. Now we will see essential characteristics one by one. These essential characteristics are forming part of definition only. So these are not new points. Everything is there in definition. Suppose promissory note is an instrument in writing. So definitely it must be in writing. Suppose any oral promise made, any oral promissory made, it is not a promissory note. Accordingly, Negotiable Instrument Act will not apply. Oral promises are insufficient. Next one, it must contain an express promise to pay. That means mere acknowledgement is insufficient. Suppose, I am telling to you, for example, I, Mr. V, and you, Mr. Suresh, for example. So I am making a statement or I am writing in a letter stating that I owe you rupees 5,000. In brackets, I am writing Mr. Suresh. Like, I owe Mr. Suresh rupees 5,000. Now this is accepting a liability. This is just accepting a liability, but nowhere, I'm making a promise. So here, promise to pay is an essential characteristic. Acknowledgement of debt is not a promise. Here, promise, there should be a promise. That promise is connected with the payment. So accepting a liability is not a promissory note. There must be an express promise to pay. Next one, promise must be definite and unconditional. Suppose if I attach conditions like this, I promise to pay Mr. Suresh 5,000 after my son clears CA examination. Or I promise to pay Mr. Suresh 5,000 rupees tomorrow if it rains. Now, I'm making a promise, but that promise is connected with a condition. And this condition may happen, may not happen. But if you look at money, I told you beginning, negotiable instrument main objective is, it is a system to complement the money. That means, it is similar to money. It is not money. It is similar to money. If you look at money, it is containing unconditional undertaking. Similarly, negotiable instrument should also contain unconditional undertaking or unconditional orders. So if you attach any condition, then that instrument loses its validity. NI Act will not apply. But of course, one condition you can attach, that is certain to happen. Suppose if I'm making a promise like this, I promise to pay Mr. Suresh rupees 5,000 2 months 2 months after death of D. 2 months after death of D. So definitely death of a person is a natural thing. It will happen. Time of happening of an event is uncertain, but definitely it will happen. Suppose you may get a doubt, sir, before the death of D, if promiser dies, or before death of the D, if promisee die, no problem. Legal heirs of promiser are liable to legal heirs of promisee. So you can attach a condition, but that condition should be certain to happen. If that condition is happening, the happening of condition is certain, then that promise is valid only. So first of all, promissory note should contain a promise, and that promise should be conditional or unconditional? Unconditional. Next one, creation of note alone is not sufficient. It should be signed by the maker. In case of no signature, promissory note is not valid. Next one, promise to pay money only. Suppose I promise to pay 5,000 and deliver you 2 horses. So here, I'm talking about money as well as kind. Now promissory note entirely invalid. Promissory note should speak about only money. Suppose I promise you to deliver 5 tons of rice. Now this is not a promissory note. Why? Because this is not speaking about money. It should speak about money and money only. And that money should be certain or capable of being certain. Some that can be easily ascertained. Suppose I promise to pay 5,000 or 6,000. Amount is uncertain. Instrument is invalid. Suppose I can make promissory note like this. I promise to pay you 5,000 plus interest at the rate of 12% for 2 months. Now here amount is actually not certain, but it is capable of being certain. How? You can calculate interest 5,000 plus 5,000 into 12% rate of interest. If it is per annum into 2 by 12. That means total 5,100 rupees, I'm liable to you. So here amount is capable of being certain. So amount should be certain. Next one, maker payee must be definite, certain, different persons. Suppose I promise to pay myself 5,000 rupees. Here, who is the maker? I. Who is the payee? Again, I. So maker, payee, if they are same persons, then it is not a valid instrument. So instrument will be valid only if there are distinct persons. And certain persons, if any fictitious person is there, if person is not in existence, suppose I promise to pay Mr. Suresh 5,000 and Suresh is not in existence. Now who will enforce that instrument? No one can enforce that instrument. That means that instrument is not valid. An act is not applicable. So parties should be definite, certain, distinct. Next one, it cannot be made payable to the bearer. The reason is, if you look at banknote or if you look at currency note, already they are bearer promissory notes. If you look at banknote or if you look at currency note, already they are bearer instruments. So let me show you 500. So if you look at this 500 rupee note, yeah. I need image. $2,000 specimen note. Yes, so it is visible. Now if you look at this note, here there is a statement. I promise to pay bearer the sum of 2,000 rupees. That means reading at this point, first of all, this is a promissory note issued by RBI. And this is payable to bearer. That means one who possesses this instrument is the owner of the instrument. Yes or no? Now, similar to RBI, if everyone start issuing bearer promissory notes, then there will be no distinction between RBI promissory notes and other people promissory notes. Everything will run in the economy and everything will lose its value. So that's why, who can issue bearer promissory notes? It's only RBI, Government of India. Only these two people can issue bearer promissory notes. Other than these two people, no one is allowed to issue bearer promissory notes. So that's why it cannot be made payable. At the time of making instrument, it can't be made payable to the bearer. By way of negotiations, if anyone makes blank endorsement, then order promissory note can be converted into bearer promissory note. So this restriction is applicable only at the time of creation of a promissory note. So that means at the time of making promissory note, it should be an order instrument. So what is the difference between order instrument and bearer instrument? Order instrument, where payee details are specified. Bearer instrument, payee details are not specified. So now, other than RBI, other than Government of India, any party, if they want to issue promissory notes, what kind of promissory notes they can issue? Bearer or order? Order. RBI, central government, can issue bearer promissory notes. Other people can issue only order promissory notes. That's why it cannot be made payable to bearer. Understood? Next one, it must be properly stamped as per Indian Stamp Act, and the stamp must be duly cancelled by the maker signature or initials. Cancel means what? In case of promissory note, yes, we need to attach a stamp, and someone should sign across the stamp. That is nothing but cancellation, so that duplicate usage will be avoided. Suppose if you attach stamp, if you are not signing on that stamp, that means what happens, a future date, this stamp can be separated from the note, and the same stamp can be used to the some other instrument. Now when you cancel it by making signature across like this, you can't use it subsequently. And there is a logic why instrument should be stamped. The reason is man-made instrument should be stamped compulsorily. If you look at check, it is not man-made instrument. Some authority is making that instrument. That's why stamping is not required. So if you take, immovable properties, if you take, promissory notes, bills of exchange, all man-made instruments should be stamped. And the logic is, it's a revenue to the government. So for revenue to the government, we had an act, Indian Stamp Act. As per Indian Stamp Act, proper valuation rules we need to apply. Like for example, for 1000 rupees, you need to attach one stamp, for example. Then if consideration amount is 10,000, then you need to attach 10 stamps. Like that. So valuation is taken care by Indian Stamp Act. So how many stamps we need to affix? It is taken care by Indian Stamp Act. Or like it may tell like this, total consideration on that 0.4% stamp duty you need to pay. So like that we need to pay stamp duty. Accordingly, we need to affix that stamps. Okay. So this is all about promissory note. So in promissory note, how many parties we are having? Two parties, maker, payee. And who is the maker? Debtor. Who is the payee? Creditor. And what is the nature of debtor's liability? Primary and unconditional, because he is making unconditional promise. So his liability is unconditional. And he is primarily liable. That means, he is the first person liable to that instrument. Getting it? Next one, bill of exchange. In bill of exchange, here also you will find two parties. First one is seller. This time seller. Next one is buyer. Assumed it is a credit transaction. Now seller becomes creditor. Buyer becomes debtor. Now, creditor is drawing an instrument on debtor. In case of promissory note, debtor makes an instrument in favor of creditor. If a debtor is making an instrument, it is nothing but promissory note. If creditor is making an instrument, it is nothing but a bill of exchange. So here, creditor, for example, creditor is Mr. Charan, debtor is Mr. David, for example. Now, what Charan will do, he will write like this. I order Mr. David to pay sum of rupees 5,000 3 months after date to Mr. David or his order. So like this, he will create an instrument, and the instrument should be stamped, and instrument should be signed by the maker. Here, who is the maker? Creditor. Creditor is Charan. Okay, I'm sorry. Here a mistake is, it's not David. I order Mr. David to pay sum of rupees 5,000 3 months after date to Mr. for example Suraj or his order, and signed by Charan. See, maker of the instrument will sign the instrument. So here, who is the maker? Charan is the maker, and maker of the bill of exchange is nothing but creditor. And he is imposing an obligation on one party. On which part? On whom he is imposing obligation? David. So David is nothing but debtor. Coming to bill of exchange, maker of the bill of exchange is known as drawer, one who draws the instrument. And on whom obligation was imposed? we call him as drawee. That means on whom instrument was drawn, we call him as drawee. And to whom the instrument is payable, we call him as a payee. So, Charan is directing Mr. David to make payment to Suraj or his order. So that means, for Charan, Suraj is a creditor. In business transaction, yes, I'm having debtors. I will also have creditors. So I will direct my debtors to make payment to either me, or I can direct them to make payment to my creditors. Suppose instead of Suraj, if I write my name, for example, that is, Charan. That means here, you can see drawer equal to payee. So two-party instrument. Here you will find only two parties. But in the details of payee, if I mention third-party details like Suraj, now it becomes a three-party instrument. So bill of exchange is a three-party instrument. So where you will find three parties: drawer, drawee, payee. So who is the drawer, ma? Creditor. And who is the drawee? Debtor. And who is the payee? One who is entitled to receive payment. Getting it? So now tell me, if a debtor is making an instrument, it is a promissory note. If a debtor is making an instrument, it is nothing but promissory note. If creditor is making an instrument, it is a bill of exchange. Clear? So yes, this is a example for a bill of exchange. I order. So who will order? Creditor will order debtor to make payment. Sum of 5,000 rupees 3 months after date to so and so person. And here, so and so person, payee details are mentioned. By default, it becomes order instrument. Clear? Now we'll look into the definition. A bill of exchange is an instrument in writing. Definitely instrument should be in writing, containing an order. So if you talk about creditor, debtor, who will be the dominant party? Creditor is the dominant party. And who is influenced party? Debtor. So definitely creditor impose order on debtor. So it should contain an order. Order means it's not command, it's a direction. And that order should be unconditional. Suppose I order Mr. David to pay sum of 5,000 rupees if it rains tomorrow. Or if Mr. A clears a CA examination. Now what it becomes? It is an order, but it becomes a conditional order. So as I told you, money contains no conditions. Money is not having any condition. It is transferable from one party to another party freely. Similarly, negotiable instrument should also transfer from one party to another party freely. So that's why you should not impose any conditions with respect to negotiable instruments. So order should be unconditional. Signed by the maker. Here maker is creditor. Directing certain person, so whom? Drawee, to pay certain sum of money and money only to or to the order of specified person or bearer. So parties, if you look at the parties, drawer, drawee, payee. Drawer, one who makes the instrument. Drawee, who is directed to pay, or he becomes an acceptor upon acceptance and is primarily liable. And payee is a person to whom payment is directed. Now looking at essential characteristics, all these essential characteristics are coming out of definition only. So definition, if you look at the definition, in writing, this is one characteristic. Next one, it must contain an order to pay, and that order should be unconditional. So 3 points over. Fourth point, drawer must sign the instrument. Yes, signed by the maker. And next one, drawer, drawee, payee must be certain. Though one person can play two roles. Here one person can play two roles means, drawer can be payee. But drawer, drawee should not be same persons. Drawer, drawee should not be same persons. If drawer and drawee same persons, that instrument is not enforceable initially. Next one, cannot be made payable to bearer on demand. See, we are having two instruments based on time. Time instrument, demand instrument. Time instrument, if you look at this example, 3 months after date. So here you will find maturity date. Only on maturity date, I am liable to you. Or I can recover money from you. In case of promissory note, I am liable to you only on maturity. In case of bill of exchange, I can recover this amount only on maturity date. That means until that instrument reaches maturity date, instrument will not get any validity. Not get validity means instrument is not enforceable. Instrument is enforceable only when it reaches maturity date. And if this time period is not mentioned, then it becomes a demand instrument. Suppose if you look at our money, here no time period is specified. Here time period is not specified. So it is a demand instrument. And similarly, if you find a check, in check also time period is not mentioned. Time period is not at all allowed. So check is always a demand instrument. Now what happens, if I allow bearer bill of exchange payable on demand, it becomes a self check. It becomes a self check. Self check means, here pay detail is option. Pay details are option. Pay to self. That means one who deposit that instrument, we will pay amount to that person. Understood? And check is also one type of bill of exchange. So for checks, banking, other acts will also apply. In addition to Negotiable Instruments Act, other acts will also apply. But for bills of exchange, Negotiable Instruments Act will apply. So to avoid that conflict, if that bill of exchange becoming a check, face it is a bill of exchange. But because of demand instrument, because of bearer instrument, if it is becoming a check, now again we need to apply some other rules. To avoid that confusion, we simply state that a bill of exchange can't be made payable to bearer on demand. Like promissory notes, if you take, bearer promissory notes not allowed. Similarly, bearer bill of exchange payable on demand is not allowed. Bearer promissory notes, why not allowed? Because it creates a competition with RBI money. It creates competition with Government of India money. And similarly here also, to simply to avoid a confusion between bill of exchange and check, so here we imposed a restriction. That's it. Beyond that, there is no logic at all. So bill of exchange can't be made payable to bearer on demand. Either it can be bearer instrument with time, or it can be order instrument with demand. But combination is not allowed. Like, payable to bearer on demand is not allowed. Next one, sum must be certain. Amount must be certain. Order must to pay money only. So I order you to deliver 5 tons of wheat or 2 tons of rice. It will not become a bill of exchange. And man-made instruments should be stamped properly. So it must be properly stamped. So this is all about bill of exchange. Now you can see the differences between note and bill of exchange. Only these points are there in ICS study material also. I considered only those points. So promissory note, unconditional undertaking. Bill of exchange, unconditional order. Next one, it involves promise to pay. It involves order to make payment. Two parties, maker payee, here drawer, drawee payee. Next one, acceptance is not required in case of promissory note. Why? Debtor himself is making the instrument. Whereas bill of exchange, creditor is making instrument on debtor. Now definitely confirmation is required. Confirmation, debtor, is he liable for that amount or not? Suppose there is a chance, creditor by mistake he may write higher amounts. Now making debtor liable for that higher amount is not good. So that's why here acceptance is required. And payable to bearer, it can't be made payable to bearer. And here it can't be made payable to bearer on demand. Payable to bearer on demand. This combination is strictly prohibited. You can also add one more difference, maker of the instrument. Here, maker of the instrument is debtor, promissory note debtor. And in case of bill of exchange, who is the maker? In case of promissory note, who is the maker of the instrument? Promissory note. Promissory note, who is the maker? Debtor. In case of bill of exchange? Yes, exactly. Clear? Everything. Next one, check. So check is a bill of exchange drawn on a specified banker, payable on demand. It includes electronic image of truncated check and check in electronic form. I'll tell you. First of all, check is a bill of exchange. So that means every check is a bill of exchange, but every bill of exchange is not a check. So that means, check will contain all the characteristics of bill of exchange. And what is the differentiating factor? If you talk about check, if you talk about bill of exchange, the differentiating character is it is always drawn on a banker, and it is always payable on demand. Suppose if you take bill of exchange, yes, for example, Mr. X can draw bill on Y, Mr. Y can draw bill on Z. That means drawee can be any person. Drawee can be any person. But in case of check, suppose X is having account with State Bank of India. So now X can draw check only on SBI. So check is a bill of exchange. First of all, check is a bill of exchange and it can be drawn only on specified banker because he's having account with SBI. Getting it? So now only on banker. So check can't be drawn on other parties. Check can be drawn only on banker. And as you all know, demand instrument, time instrument. If time is mentioned, it becomes a time instrument. Time for payment mentioned, time instrument. no time for payment mentioned, then it becomes demand. And if you take check, time for payment is not mentioned. It will have a date column, and it will have a pay column, and it will have a amount column, amount, and then signature of the drawer of the check. So drawer will sign it. So time for payment is not specified. This is a demand instrument. Now if you look at bill of exchange, it can be demand instrument, it can be time instrument, bill of exchange, but check always demand instrument. Getting it? Now tell me, what is the differentiating factor between bill of exchange, check? Bill of exchange can be drawn on any person. Yes, check can be drawn only on
particular SBI bank.
Specified banker with whom he is having account. Suppose you are having account with Punjab National Bank. Now you can draw check only on Punjab National Bank. I am having a account with Union Bank. Now I can't draw check on SBI. I can't draw check on Punjab National Bank. I can draw check only on Union Bank. And check is always demand instrument, whereas bill of exchange either demand or time. Understood? Now check also includes two things. One is electronic image of truncated check. Next one, check in electronic form. Check in electronic form, it is very simple. Like if you take NEFT, if you take RTGS, all this comes under check in electronic form. Suppose you are going, you are traveling from Hyderabad to Bangalore. So you reserved one ticket, using Red Bus. So when you select the ticket, they will ask you payment details. So you will enter your details, your login, your net banking credentials you will enter. That means you are creating a check in favor of a service provider. And amount you are entering online. Signature is also online. How? You will get a OTP. When you enter that OTP, so you are authorizing the transaction. That means right from creation till payment, that means till satisfaction, everything is online. That is check in electronic form. Example, Google Pay, Phone Pay, RTGS, NEFT. Next one, electronic image of truncated check. See, truncation means it's a process of minimizing the object. Suppose if you take, the material in your hand, it's a bulk document, it's a big document. Now, if I scan it, it becomes a small thing. It becomes a small thing because it looks like an icon. When you click on that icon, everything will be displayed. So your mobile is lesser than book size, and your mobile can carry that book. That process is truncation. Converting a hard copy into soft copy, it is a truncation. Using some methods, that means using some methods like we will scan it. So that's why it becomes electronic image of truncated check. See, generally what happens, so drawer of the check issues check to payee. Drawer is having account with State Bank of India. Payee, for example, payee is having account with Union Bank of India. Now payee will have two options. Either he can go to SBI, he can deposit with SBI and he can get amount spot, or he can send this check to Union Bank of India for collection. Now Union Bank of India on behalf of payee submit that instrument to State Bank of India to get that amount. Now Union Bank of India will credit amount to your account. But in this entire process, if you observe, the check is a paper. So it can be easily turned, it can be easily stolen. And this process, whenever bank is receiving a checks, it will take some 15 days time for clearance or 10 days time clearance. Every time they can't send a single checks for clearance. So at the end of the week or at the end of 3 days, they will send all these instruments to clearing house, where clearing house confirmation will be taken from drawee banker. Confirmation will be taken from drawee banker. So to reduce this process, so what payee banker, Union Bank of India will do, it will immediately scan that check, and that scanned copy will be sent over mail to clearing house. Clearing house will forward to the SBI through email only. So they will give confirmation online. So everything is fast and everything is secured. So now if you observe this check, at the time of creation, it is a manual paper. But in the process of clearing, it is getting converted into online copy, soft copy, electronic image of truncated check. So, Negotiable Instruments Act, the provisions which are applicable to check are equally applicable to check in electronic form, electronic image of truncated check. Understood? So what is a check, ma? It is a bill of exchange. And what is the distinction character, ma? Specified banker, payable on demand. So it is always payable on demand. Explanation terms, check in electronic form, drawn using computer resources, signed with a digital or electronic signature as defined in IT Act 2000, Information Technology. Truncated check, a check which physical movement is substituted by its electronic image. It's similar to your carrying certificates, ma'am. You're having physical certificates, 10th class, 12th class, all these certificates. So if you want to mail it to someone else, so you will scan it and you will send through email. Now that process is nothing but truncation. So check will also travel like that only. So we call it as electronic image of truncated check. And how many parties you will find here? 3 parties. In bill of exchange you will find 3 parties. Here also 3 parties: drawer, drawee, payee. See here, check is a bill of exchange. That means check should be drawn by creditor. Yes or no? Yes, here creditor only draws a check. Actually, trade transaction, you will find buyer, you will find seller. Correct? So buyer becomes debtor, seller becomes creditor because of credit transaction. Now debtor has to settle this consideration. To settle this consideration, he is giving a check. Now many will get a doubt, sir. Check is a bill of exchange. That means a check should be drawn by creditor. No, sir. Why debtor is drawing the check? But the point is, you should not look at debtor creditor relationship like this. You should look relationship like this. This person is having account with SBI, for example. For example, debtor is Mr. David. Who is debtor? David. And who is creditor? For example, Charan. Now, David, to discharge sale consideration, he is issuing a check. But is he drawing check on Charan? No. He is drawing check on whom? He is drawing check on State Bank of India. Now in State Bank of India, he is maintaining account. In that account, for example, 50,000 balance is there. Now with respect to 50,000, David becomes creditor to banker. David becomes creditor to, just wait. Yeah. Just observe carefully. David becomes creditor to banker. One more time I'll tell you. Some issue is there. Yeah. Cleared. So, if you look at the David Charan point of view, David is a debtor, Charan is a creditor. But just look from David and bank point of view. David is having 50,000 account balance in SBI. That means for 50,000 rupees, David is creditor to SBI. SBI is debtor to David. Now, David drawing instrument on SBI is nothing but creditor drawing instrument on debtor. So, don't look from David Charan point of view. Look at David and SBI point of view. Is it clear? So, check is also drawn by creditor. And who is the debtor? Banker. Clear? Now, you can see bearer instrument and order instrument. So, if you look at essential characteristics, only 3 points are there because, all the essential characteristics of bill of exchange becomes essential characteristics of check, except to 2 things. One is stamping. Second one is payable to bearer on demand. These 2 things avoid. Remaining characteristics same as it is, plus 2 characteristics. Must be always drawn on specified banker, must be payable on demand. Clear? Next one, instruments are of 2 types: bearer instrument, order instrument. So bearer instrument, payable to bearer, simply, payee details are blank. In a case of order instrument, payee details are present. That means if instrument is giving a direction, pay to so and so party, order instrument. Pay to the person who possesses that instrument, bearer. Okay. Now bearer instruments can be negotiated by mere delivery. Suppose I am having 5,000 rupee note. I am buying some things value 500 rupees. So, sorry, I am having 500 rupee. I want to purchase a thing which costs 500. Now, when I take that thing, I'll give 500 rupees. By simple delivery, shop owner becomes owner of the 500. Ownership from it gets transferred simply by delivery. But if you look at check, for example, the check is having my name, pay to Mr. V, rupees 500. Check is order instrument in this case. Now, simply if I give this check to the shop owner will not get ownership. Why? Because that instrument is telling pay to V only. Specified person is there. So now, ownership should be transferred from Mr. V to shop owner. For that, what I have to do? I have to make endorsement. So endorsement means very simple, signing on the instrument by the holder of the instrument. Signing on the instrument by the holder of the instrument. Now, what I will do? I will write shop owner name. Like for example, shop owner name is Suraj. Pay to Suraj and I will sign it. This is nothing but endorsement. And doing endorsement alone is not sufficient. I need to deliver that instrument. Then only Suraj gets ownership. So very simple, bearer instrument. By delivery, ownership gets transferred. Order instrument, By endorsement and delivery, ownership gets transferred. Simple example, 500 rupee note. If you transfer it, by transfer, ownership gets passed. If you take check which contains payee details, now by simple delivery, ownership can't transfer. Endorsement is compulsory. Next one, payee name bearer. Whereas here payee name is present. Example, pay to bearer, or payee details blank. Here pay to XYZ or his order. That means on due date, if XYZ is possessing instrument, pay to XYZ. On due date, XYZ transfer this instrument to, for example, ABC. Now XYZ is making an order, pay to ABC. Now pay to ABC. Getting my point? See, last endorsement is blank means what? Suppose I created a promissory note, order promissory note. For example, I promise to pay Mr. Charan 5,000 rupees 3 months after date. 3 months after date. Now, is this an order instrument or bearer instrument? Order instrument, because pay details are mentioned. Now, Charan is making an endorsement like this. For example, pay to blank, and Charan signed that endorsement. This kind of endorsement is known as blank endorsement. Now, who is the ultimate payee? Blank. That means pay details present or absent? Absent. Obviously, it becomes bearer instrument. Getting it? So now promissory note at the time of creation, it is an order instrument. So making of instrument is valid. By way of endorsement, it becomes bearer. So like this, it is possible. At the time of making, you can't make bearer promissory note. Clear? Next one, foreign instrument or inland instrument. See, inland instrument means instrument should be drawn in India, first thing. So where instrument must be created? In India. And it should be payable either in India or payable by a person resident in India. That means drawn upon a person resident in India. Drawn upon a person resident in India means payable by person resident in India. See, here we are having three conditions, A, B, C. What is A? Creation of instrument. So A should be always in India only. Either B or C should be in India. Understood? So either payable in India or drawn upon a person resident in India. Suppose if A is outside India, what is A? Creation. If creation is outside India, automatically it becomes foreign instrument. Automatically. It's immaterial. Suppose, sir, B as well as C both in India, sir. Both in India. Irrelevant. Where it was made? Outside India, foreign instrument. Sir, A is in India, sir. A is in India. But imagine both B as well as C outside India, sir. Then also it becomes foreign instrument. So to call an instrument inland instrument, A should be in India and either B or C. So what is A? Creation. That means drawn or made. Drawn is given to bill of exchange or check. Made is given to promissory note. Clear? So either drawn or made in India, payable in India, or drawn upon a person resident in India. So they can ask you a question like this, for example, instrument drawn in Mumbai. Just example, drawn in Mumbai. Payable at Sydney, outside India. Drawn upon, for example, drawn upon a person resident of London. Now, is it inland or foreign? They can ask you like this. So answer is foreign instrument because both B, C outside India. Suppose drawn in Mumbai, payable in Hyderabad, payable by a person resident of London, inland instrument. Suppose drawn outside India, for example, drawn outside India, Sydney. Now automatically it becomes foreign instrument. Clear? Now liability of the maker drawer of a foreign bill. This is an extra point. Just look at the point. Maker drawer's liability is regulated by the law of place where instrument is made unless there is a contract stating otherwise. Acceptor's liability determined by the law of place where instrument is made payable. Endorser's liability where instrument is made payable. Key principle. See, if you look at these 2 points, acceptor, endorser. Their liability is regulated by place where instrument is made payable. Whereas maker of a promissory note, drawer of a bill of exchange, their liability is decided by law where that instrument is made. I'll give you a simple example. Suppose Mr. David, drawer of the instrument, drawn instrument on Mr. Suraj. Who is Suraj? Drawi. Endorsed to, endorsed to, for example, Pradeep. And this bill was negotiated to, for example, Mr. Sai. 4 parties are there, right? Suppose drawer is from USA, Drawi is from London, Pradeep is from Sydney, and Sai is from India. Okay, so if you look at the instrument, drawn by David, USA, drawn on Drawi, London, endorsed to person Pradeep, Sydney, and finally negotiated to Sai, India. Now if you look at this instrument, instrument was drawn in USA, payable, for example, payable in London. So that means if you want to get payment of the instrument, you should present that instrument in London. Now on due date, this instrument got dishonored. What happened? Instrument got dishonored. Now for overdue period, generally for overdue period, you can claim interest. Yes or no? Interest. You can claim interest. As per USA negotiable instrument laws, rate of interest is 8%. And as per London, as per England, for example, UK, as per UK negotiable instrument laws, rate of interest is 6%. Now, if Sai wants to make drawer liable, then drawer is liable to pay interest 8%. Why? Where that instrument was drawn? USA. USA negotiable instruments laws will apply. If Sai wants to make Suraj liable, or if Sai wants to make Pradeep liable, then these people are liable to pay interest 6%. Why? Liability of acceptor, liability of endorser is governed by the law of place where instrument is made payable. Now you got clarity, right? So drawer is liable as per where instrument is drawn. Acceptor is liable as per where instrument is made payable. Endorser is also liable where that instrument is made payable. Next one, inchoate instrument. Inchoate instrument means incomplete, signed, stamped in case of promissory note, bill of exchange, plus delivered instrument. Incomplete, but it should be signed by the maker, it should be stamped, and it should be delivered. Then it becomes inchoate instrument. Generally, when consideration is not known at the time of making instrument, and consideration is not known, maker of the instrument will give a blank instrument in favor of payee, and he give authority to payee to fill the blank. For example, our transaction is gold transaction. So you are going to, our transaction is gold transaction. You are going to deliver that gold after 10 days. And I am liable to pay consideration after 10 days. So after 10 days, what would be the gold price? That consideration I should pay to you. So what would be the consideration? I don't know. Today, gold price is, for example, 7,500. After 10 days, per gram 7,500. After 10 days, it may go to 7,000 or it may go to 8,000. But I should pay advance to you in 10 days. 10 days advance. 10 days prior to transaction, I should pay advance to you. So in the place of advance, I'm giving promissory note to you. And since consideration is not known, I'm giving authority to you to fill the amount. Now, it should be stamped adequately, first of all, because without stamping, instrument won't get enforceability. And it should be signed by the maker of the instrument. Without signature, instrument won't get enforceability. And it should be delivered. Unless and until it gets delivered, it won't get any enforceability. Of course, after filling up the blanks only, instrument gets enforceability. But that amount who can fill? Payee. Now, how much amount payee can fill? Actual amount he can fill. Suppose after 10 days, consideration is, for example, 8 lakhs. Payee can fill 8 lakhs only. Suppose after 10 days, the consideration is 7,20,000. The gold price is, for example, 7,200, 100 grams, imagine. So 7,20,000. So how much amount payee can fill? 7,20,000 only. So actual amount, holder has power to complete the instrument by writing the amount within the limit specified either by the signer. Signer means, maker only, or the affixed stamp. So based on the doctrine of estoppel, which binds to the signer to honor the instrument once it is completed within authorized limits. So if you look at inchoate instrument, it is an incomplete negotiable instrument signed, delivered by drawer, maker, acceptor, endorser, either wholly blank or partially written. Place of payment, time of payment, everything is blank, or only amount is blank. That means partially blank or completely blank. But amount should be blank.
Amount mention చేయకూడదా the condition.
Suppose if maker is completing the instrument in all aspects, it becomes complete instrument. So then it won't become inchoate instrument. See, here consideration is not known. That's why maker is giving a blank instrument to the payee. If it is a check, stamp is not required. Now how much amount payee can fill, how much amount holder can fill, actual amount he can fill. Let's see next one. Liability of the drawer maker. Holder can recover only the amount intended by the signer. Suppose after 10 days, if gold price is 7,20,000, you can recover only 7,20,000 from me. If gold price is 8 lakhs, you can recover from me only 8 lakhs. That means intended amount, actual amount you can recover. But if you are a holder in due course, the holder in due course can recover any amount within the stamp limit, even if it exceeds the intended amount. So for understanding this, let's have an example. Suppose 1 lakh consideration requires 1 stamp. How many stamps required for 1 lakh? 1 stamp. For 2 lakhs, 2 stamps. For 2.5 lakh, 3 stamps. Because 2.5 stamps not possible, right? Next one, for 7 lakhs, 7 stamps required. For 8 lakhs, 8 stamps required. Now, we don't know the consideration, but it is within the range like, 7 lakhs to 8 lakhs. That's why what I did, I created a promissory note having 8 stamps. So I affixed 8 stamps. And on all 8 stamps, on all these 8 stamps, I made a signature. And I gave this blank instrument to you. Okay. Now, on the date of consideration, for example, actual consideration is 7 lakhs. How much amount you can fill in this blank? 7 lakhs only. And how much I'm liable to you? How much amount I'm liable to you? 7 lakhs. Suppose even if you fill 8 lakhs, I'm liable to you 7 lakhs only. Because actual consideration is 7 lakhs. So you get ownership only with respect to 7 lakhs. You can recover only 7 lakhs from me. Suppose you filled it up 8 lakhs and you issued that instrument to holder in due course. That means you transferred, you negotiated that instrument to holder in due course. As I told you, who is holder in due course? He receives that instrument for consideration in good faith. That means, he is not having any knowledge about this 7 lakhs, 8 lakhs arrangement. Actually you are liable to your neighbor. For example, you are liable to your neighbor, Mr. Naveen. How much you are liable? 8 lakhs you are liable. That's why you filled it up 8 lakhs and you gave it to Naveen. So Naveen received this instrument for 8 lakhs consideration and he received this instrument in good faith. That means he don't know about our arrangement. And he received this instrument before maturity. Actually, you are having title, you are having title for 7 lakhs. But you transfer this instrument for 8 lakhs. So actually, nemo dat quod non habet, as per nemo dat quod non habet, Naveen will get ownership with respect to only 7 lakhs. But negotiable instruments is an exception to nemo dat quod non habet. That means Naveen will get a 100% good title. That means Naveen will get title with respect to 8 lakhs. So tomorrow he can recover 8 lakhs from me. Suppose instead of 8 lakhs, you wrote 10 lakhs. And how much amount Mr. Naveen can recover from me? 8 lakhs only. Why? Because it is having only 8 stamps. Of course, holder in due course is a hero in our concept. But he is a common person with respect to Indian Stamp Act. He is hero in our chapter. So common person to Indian Stamp Act. That's why since 8 stamps are affixed, holder in due course can recover 8 lakhs only. You may get a doubt, sir. Actual liability is 7 lakhs. No, sir. If you are paying 8 lakhs to Naveen, 1 lakh is lost to you. No, sir. No problem. I will recover that amount from you. So I will recover that amount from Mr. C. That is, 1 lakh I will recover. Payment made by mistake or payment made because of, some fraud or coercion, undue influence like that. So 1 lakh rupee I will recover from C. But HDC can recover full amount. That is the point. Holder can recover actual amount. HDC can recover any amount covered within the stamps. Understood? So person signs, delivers a stamped blank incomplete negotiable instrument. It gives prima facie authority to holder to complete it within the stamp limit. Liability of the signer is established for the amount completed by the holder in due course. So HDC can recover full amount, whereas holder can recover actual amount. And this full amount is also subject to limit of stamps, the value covered by stamps. A holder other than holder in due course cannot claim more than the intended amount. So very simple, my inchoate instrument. How much amount holder can recover? Actual amount. Holder in due course, any amount, full amount, subject to value covered by the stamps. Understood? Next one, ambiguous instrument. See here, ambiguous instrument. Name itself is telling confusion. So confusion is either it may be a promissory note or it may be a bill of exchange. It is having characteristics of both promissory note, but name is bill of exchange. Then it becomes ambiguous. For example, I am Mr. V. I am the drawer of the instrument. I draw an instrument on M, and instrument was made payable to payee. For example, Mr. Payee is Pradeep. Payee is Pradeep. So actually, who is the maker of the instrument? Mr. V, drawer. And who is drawee? M. So what is the drawee nature of liability in case of bill of exchange? Primary and unconditional. If drawee fails to pay that amount, payee will recover that amount from drawer. That means drawer nature of liability is secondary and conditional. Why secondary? Primary liability lies with M. So that's why secondary. Why conditional? If M fails to pay, then Mr. V is liable. That's why conditional. Getting it? So in case of bill of exchange, tell me in case of bill of exchange, what is the nature of maker's liability? What is the nature of maker's liability? Secondary and conditional. In case of bill of exchange, who is the maker? Mr. V. Mr. M is a drawee. I named here Mr. V is a maker as well as drawer or maker, both are same. Is it clear? Next one. In case of promissory note, suppose M is giving promissory note to V. M is giving promissory note to V. Who is M? Maker. And who is V? Payee. And what is maker's nature of liability? Primary and unconditional, because promissory note should contain unconditional promise. Yes or no? Now come on. So maker's nature of liability in case of promissory note is primary and unconditional, whereas maker's nature of liability in case of bill of exchange is secondary and conditional. Understood? So what is the maker's nature of liability in bill of exchange? Secondary and conditional. Promissory note? Primary and unconditional. If you understand this point, ambiguous instrument is easy. How it is easy? Now just look at this, our earlier example. I draw an instrument on M, right? So I am the drawer, and what is the instrument I drawn here? Bill of exchange. Suppose Mr. M is a minor. Do you think minor gets liability? Minor will not get any liability. Then who is primarily liable to the instrument? Mr. V. So V gets primary and unconditional liability. What is the name of the instrument? Bill. In case of bill of exchange, maker's liability should be secondary and conditional. But in this case, if you look carefully, maker's nature of liability is primary and unconditional. So name of the instrument is bill. Characteristics are matching with the promissory note. Now there is a confusion. Confusion is name a bill, but maker is having primary and unconditional liability. So that's why we call it as ambiguous instrument.
Pradeep knows M is minor, then why?
He don't know. Pradeep is receiving that instrument from Mr. V.
Okay.
On maturity date, when Pradeep wants to present this instrument for payment against M, Pradeep came to know that M is a minor. Understood? So similarly, suppose M is not a minor, imagine M is a fictitious person. Then also Mr. V gets primary and unconditional liability only. Is it clear? And even head office drawing a bill on branch office. Head office drawing a bill of exchange on branch office. For example, Kalyan Jewelers is there. It is having two branches, Hyderabad branch, Chennai branch. One day, Hyderabad branch sent some materials to Chennai branch, gold materials. So Chennai branch is actually liable to Hyderabad branch. For this, Hyderabad branch drawn a bill on Chennai. Bill of exchange was drawn. So who is the drawer? Hyderabad branch is the drawer. And who is the drawee? Chennai branch is the drawee. Imagine this instrument was negotiated to, for example, Lalita Jewelries. Now Lalita Jewelries point of view, who is the maker of the instrument? Kalyan Jewelries. So he will not look into the Hyderabad Chennai branches. Between them there may be a settlement, but for an outsider, Hyderabad branch, Chennai branch, both are under the control of Kalyan Jewelries only. So maker is Kalyan Jewelries. And what is the maker nature of liability? Primary and unconditional. But what is the name of the instrument? Bill of exchange. So name bill, characteristics matching with promissory note, then it becomes a ambiguous instrument. Now holder will get a right to decide the instrument whether it is a promissory note or a bill of exchange. If he decides it's a promissory note, it will be promissory note forever. If he decides bill of exchange, it will be bill of exchange forever. Suppose in the instrument, for example, in the instrument, in words, I wrote like this. Sorry, in figures I wrote like this, but in words I wrote like this. Now there is a confusion. Figures is telling 80, whereas words is telling 8. Now so there is an ambiguous there is some confusion is there, so I will call it as ambiguous instrument, and I will consider it as 80,000 only. No, not allowed. Figures, there is a chance of making mistake, but words, there is no chance of mistake. So in case of conflict between words and figures, follow words.
Words may be incorrect.
Intention, when I'm writing zeros, by forgetting, I may add extra zero, but words, I won't do that mistake. Words, I will apply my sense of mind. That's it. See, the holder has a discretion to treat it either as a promissory note or bill of exchange. Once election is made, instrument is treated as accordingly, and this choice can't be changed later. So even if instrument passes to next party, so they will also treat according to the election of the holder. Suppose I decided it as a promissory note. Next parties can also decide it as a promissory note. They can't decide it as a bill of exchange. Examples of ambiguity: instruments with language conditions that make it unclear, where unconditional orders, promises to pay. So simple: name, bill, characteristics, promissory note. Understood? Next one, negotiation of negotiable instruments. Very simple. 2 points you have to remember. Why we are making these instruments? Because they are transferable, similar to money. How they can be transferable? Our objective is transfer. Objective alone is not sufficient. We should have certain means. That means certain resources. So negotiation is our end, but we need means to achieve this end. In economics, we are having these terms, means to satisfy ends or wants. So means, coming to resources, we are having two resources. One is endorsement, other one is delivery. So endorsement and delivery is required for order instrument, whereas delivery is sufficient for a bearer instrument. So negotiation by delivery, note to bill of exchange check payable to bearer can be transferred by delivery alone. Next one, note to bill check payable to order can be transferred only by endorsement and delivery. So transfer of rights in the instrument to make transfer. See, why we are making negotiation? So that for example, I am holding one instrument and I want to make you owner of the instrument. So I can make you as a owner of the instrument by making negotiation. So by delivery in case of bearer instrument, by endorsement and delivery in case of order instrument. Objective is making next person owner of the instrument. So for making next person as owner of the instrument, here I am opting for negotiation. Clear? Next one, negotiation of negotiable instruments by delivery and endorsement. So by delivery, it is for payable to bearer. Same content is repeated in material also. That's why you can see in summary notes also the content is getting repeated. So you can avoid it. Exception to negotiation by delivery: if instrument is delivered on a condition that it only takes effect upon a certain event, it is not negotiable unless event happens. This exception does not apply if holder is for value. Holder is for value or HDC, both are same, and has no notice of the condition. Some instruments are known as escrow instruments. Some instruments, escrow instrument concept is there. In instruments, escrow instrument concept is there. Here, I will not impose condition in the instrument. Here, condition in instrument, I will not impose any condition in the instrument. I will impose condition in delivery. Where I am imposing condition? Delivery. Then it becomes escrow instrument. For example, you are having a land and you want to construct a building on this land. One day I came to you, madam, I will construct building on this land, I told you. And you told, what is the guarantee? In middle of the project, if you ignore, if you leave that project, so I may be at loss of some 5 lakh rupees. So you need to complete this project within a period of 12 months. If you fail to complete within 12 months, or if you drop the project in middle, I will be at loss of 5 lakhs. So who is responsible for my loss? Like that you asked me. Immediately I told you, don't worry, I will deposit a certain money of 5 lakhs with you. This is, we call it as security deposit. So if I complete the project within the timeline, this security deposit will be given back to me. If I fail to complete the project, you can forfeit the security deposit. You can have that 5 lakh rupee amount with you. Suppose I'm not having 5 lakh rupees money. Instead of that, I'm giving a promissory note to you. Suppose I promise to pay Miss C rupees 5 lakhs on demand, and it was stamped and it was signed by me. So demand instrument, yes, promissory note can be demand instrument. It can't be bearer instrument. It should be an order instrument. At the time of making, it should be an order instrument. Yes, pay details are present. It is an order instrument. Now, I'm not imposing condition in the instrument, but at the time of delivering this instrument, I'm telling you, madam, you can enforce this instrument only if I fail to complete the project. So now where I impose a condition? In delivery. Suppose if I impose same condition in the instrument, the promise becomes conditional promise, and instrument, it won't be a valid negotiable instrument. Understood? So here I am imposing a condition in the delivery. Such kind of instruments are known as escrow instruments. Now in this case, when you can enforce this instrument? Only when I fail to fulfill the condition. Then only you can enforce instrument against me. Then only you can recover this amount from me. Suppose you transfer this instrument to Mr. Hari, who received that instrument for consideration of 5 lakhs. Actually, there is no consideration for you, but you transfer this instrument to Hari for consideration, and Hari is not having a knowledge of these arrangements. He received this instrument in good faith, and since it is a demand instrument, maturity concept will not come. So reasonable time, Hari became holder of the instrument. So such a person is known as holder in due course. Even though transferor Miss C is not having title, so actually Miss C is not having any title, no title, but HDC will get a valid title. So tomorrow if Hari demands money, I'm liable to Hari 5 lakhs. Later I can recover that amount from Miss C. Understood? So escrow instruments, generally holder cannot recover amount of the instrument until condition imposed in the delivery gets satisfied. But this rule is not applicable to HDC. Understood? And even you can deliver this instrument only upon happening of those conditions. But you already delivered that instrument. And who received that instrument is important. Who received that instrument? HDC received that instrument. So therefore NI Act is in favor of HDC. So instrument transfer is valid. Accordingly, maker of the promissory note is liable. So generally instruments are negotiated by delivery, but escrow instruments can't be delivered until conditions imposed are failed or satisfied. But if that instrument reaches HDC, then this exception will not apply. Getting it? So finally tell me, who can deliver instrument? Owner can deliver instrument. Under NI Act, who is the owner? Holder. Understood? Negotiation by endorsement. In case of order instrument, negotiation is happening by endorsement and delivery. Importance of delivery. Delivery is required not only at the time of making instrument, but also at the time of negotiation. At the time of making instrument, I will deliver instrument to you. Even at the time of negotiation, I have to deliver that instrument. So delivery is essential not only at the time of negotiation, but also at the time of making the instrument. Conditional or special purpose instruments. Just now I told you. Escrow instrument. Escrow. Again here you can see unless negotiated to HDC. So conditional instruments. Conditional means here I'm not imposing condition in instrument. I'm imposing condition in delivery. Such instruments can't be negotiated until happening of those conditions. But this rule is not applicable to HDC. Correct. Incomplete contract. As you all know, inchoate instrument. Inchoate instrument. Contract on, incomplete contract. Contract on a negotiable instruments remain incomplete and revocable. Revocable means cancellation is possible until delivery. That means, for example, I made a promissory note in favor of you. Until I deliver it to you, I can cancel it, I can tear it off, or I can strike it off. So that means contract of negotiable instrument is revocable. Contract of negotiable instrument is incomplete. Up to when? Up to delivery. Once delivered, contract is valid, enforceable. So without delivery, rights in the instrument are not transferred to the transferee. Even in this rule is applicable in case of transfer also. At the time of making, at the time of transfer, both times delivery is a crucial factor. Endorsement without delivery. There is a practical question on this. In ICA test your knowledge, practical question is there. If an instrument is endorsed but not delivered, the endorsement is ineffective. Suppose Mr. Arun is holder of the instrument. Who is Arun? Holder of the instrument. Who can make negotiation? Only holder, Arun. Suppose Arun made endorsement like this, pay to Raju, and Arun signed this endorsement. So this is full endorsement. So there is no blank. This is a full endorsement. But before delivering this instrument to Raju, Arun died. Now, can legal representatives deliver this instrument on behalf of Arun? No, because Arun is not in existence. Now, legal representatives, simply if they deliver instrument to Raju, Raju will not get any ownership. So, simply the person who is making endorsement, same person should make a delivery. So, if delivery is not happening, endorsement becomes invalid. So, if the endorser dies before delivery, legal representative cannot complete negotiation by delivery. Legal representative, once again they need to make endorsement, once again they need to make a endorsement and delivery. Getting it?
The legal representative doesn't make any
Endorsement. Then Raju, the payee cannot get any right. He cannot exercise any right. So he can exercise rights only if that instrument gets delivered. So transferee gets rights only when he receives that instrument. From whom? From the person making endorsement. So if endorser dies before delivery, legal representative, once again they should make endorsement and they should deliver that instrument. So without making endorsement, already father made endorsement, right? So we will deliver that instrument. Now Raju will not get any title. Raju can't recover amount from prior parties. Next one, 138 to 142, practical section in the entire Negotiable Instruments Act. See here, the logic of this section 138, for example, I'm having a account balance of 5 rupees. But every day I'm going to shop, I'm purchasing the things on credit basis. For example, I'm purchasing thing of 5,000 rupees. To discharge this consideration, I'm giving a check. So shop owner is going to my bank for getting a amount of the instrument. And my banker, is dishonoring the instrument. Dishonoring the instrument, reason insufficiency of funds. What is the reason? Insufficiency of funds. So tomorrow shop owner, if he comes to me, what I will do? No problem, I am having second check, take this second check. Same second check, shop owner went to SBI. SBI once again dishonored the instrument on the grounds that insufficiency of funds. Third day, I am giving one more check. Same happening, for third check also. So here the problem is not with the check. The problem is insufficiency of funds. Now imagine if one customer is doing like this to that shop owner. Now, do you think shop owner accept checks from other parties? No, he will not accept checks. Why? If it is getting dishonored due to insufficiency of funds, second time also he will give another check or third check or fourth check. He will give the same checks or he will give some other checks, but same treatment. So this should not happen. The shop owner should be protected and this kind of drawer should be punished. So the punishment under section 138 is Mr. V, who is giving checks without sufficient balance. Sufficient balance means, balance to match the amount of the check. He will get a punishment of, imprisonment up to 2 years. Fine up to twice of the instrument. Getting my point? So, maximum 2 years imprisonment or maximum 2 times of the instrument amount as a fine. So if this kind of punishment is imposed, so definitely next time when I'm giving this instrument, I will check whether sufficient balance is there or not. Is it clear? So simply to protect checks from, to protect concept of checks from, some fraudulent persons, this section was imposed. A check is dishonored if funds are insufficient or if it exceeds the arranged amount. Suppose my account balance is 9,000 and I gave a check of rupees 5,000. Now balance sufficient or insufficient or sufficient. But the very next day, I'm having a house EMI. House EMI of, for example, 6,000 rupees. So, the next day automatic 6,000 debit will happen. Now, what would be the balance? 3,000. With this 3,000, 5,000 obligation can be met or cannot be met or cannot be met. That means sufficient funds is there, but it is exceeding the arranged amount. So you may ask me, sir, today balance is good, no, sir, but tomorrow bank deduction, standard deduction obligation is there, right? So that's why what bankers will do, even though amount is there, but it is for another obligation, that's why they will dishonor the instrument. Then punishment is imprisonment up to 2 years, fine up to twice the check of the check amount, or both. Suppose I issued a check for 5,000, right? So here I may get imprisonment up to 2 years, or fine up to how much? 10,000 rupees. Sometimes both. It all depends on frequency. Oh God. Is it visible on your screen? So what is the punishment amount under section 138? What is the punishment under section 138? Imprisonment up to 2 years, fine up to twice the amount of the instrument of check, instrument, or both. So what is the maximum punishment is leviable if the frequency of committing dishonors is very, very high. Understood? So you have to remember this punishment. But just now I told you, so if I issue a check with insufficient balance, I should be punished. Sometimes what happens, business persons, they are very busy. So they won't make bank reconciliation statement on daily basis. Suppose, I'm giving daily some 10 checks. Daily I'm issuing 10 checks. One day I issued check to you, rupees 50,000. And you didn't encash this instrument, you didn't presented this instrument for, you didn't presented this instrument with my banker. Some 1 month completed, you are maintaining this check, you didn't deposited this check with SBI. After 1 month, when I see the bank balance is 60,000 rupees balance is there. So looking at the balance, I issued one more check to my creditor. For example, 55,000 rupees, I issued a check. And creditor immediately encashed this instrument, my balance came to 5,000 rupees. At that point, you presented check for payment. See, when I issued that instrument, when you presented that instrument immediately, I issued a check. If you present that check immediately, you would have got the amount of the instrument. But you made a delay and I didn't perform BRS. As a result, looking at bank balance, I issued fresh checks and my balance became insufficient for discharging this check obligation. Now, here dishonor happened, but this is not intentional dishonor. This is unintentional. So here I am innocent. I should not be punished. I should be given one opportunity. So first, you should intimate me. If I make payment promptly, then 138 will not apply. So you have to make intimation to me. And if I fail to make payment after this intimation, definitely I should be punished. So that is what, conditions for 138. Checks presented within validity, within 3 months from the date of check or within its validity period. Generally, checks will have a validity period of 3 months. However, one can reduce the period. One can't increase the period. One can reduce the period. Understood? Next one. So check should be presented within its validity period. Second one, demand notice. Payee holder must send a written notice within 30 days after receiving bank information regarding dishonor. So when you receive information from the banker saying that instrument is dishonored due to insufficiency of funds, so immediately the payee should communicate that matter with the drawer. Within how many days? Within 30 days of receiving intimation from banker. And drawer should be given a opportunity of 15 days to make payment. And if drawer is not making payment within 15 days after receiving this information, then drawer should be punished. So if you observe carefully, total 45 days time is there. 45 days means what? You received message from banker that check is dishonored due to insufficiency of funds. So within 30 days, you have to make communication with me. And next within 15 days, I will make payment to you. So if I fail to make payment within 15 days, then you can lodge complaint against me and, court will take care of my punishment, either imprisonment up to 2 years or, fine up to twice the amount of the instrument or both. So presumption is generally in favor of holder. Suppose, when you go to court assumes that this check is issued for consideration. No, sir. I give this check only for gift. For example, it's your marriage and I gave the check to you as a gift. I gave a check of rupees, for example, 50 lakhs as a gift to you. Now, actually, here consideration present or absent or absent. But when you go to court, court is in favor of you. So it assumes that holder received this instrument for consideration. And burden of proof lies on the drawer. No, sir, there is no trade transaction between us. Just I gave it as a gift. Like that, I should prove in the court of law. If I able to prove like that, then there will be no punishment on me. So burden of proof lies on the holder. Sorry. Burden of proof lies on the drawer. See, this kind of punishment will be imposed only on consideration transactions where I purchased goods and I'm not paying amount. In case of gift, consideration present or not present or not present. So if there is no consideration, imposition of section 138 will not prevail. Section 138 is not applicable. So it is presumed that check was issued for discharging a debt, a legally enforceable debt or liability. So burden of proof is always on the drawer. No, sir, I gave this check for gift. Like that, who will have a burden of proof? Drawer. Defense not allowed. Drawer cannot defend by claiming they did not believe the check would be dishonored at the time of issuance. Like, ignorance of law is not an excuse, right? So at the time of issuing check, I don't know section 138, sir. If I knew section 138, I would not have issued the check. So this one time, please don't apply section 138 against me. Like that, can I take any defense? No. Ignorance of law is not an excuse. Next one, there is also a protection. For example, there is a trade transaction between you and me. There is a trade transaction. As per this trade transaction, I am liable to you rupees 5 lakhs. To discharge this consideration, I am giving check to you. I am giving check of 5 lakhs to you. And I knew that when you present this instrument with my banker, definitely banker will issue a notice of dishonor to you. So definitely you can impose section 138 against me, directly. That means, you have no power to impose 138. You can lodge complaint in the court of law. And, court is having powers to impose section 138 against me. So to avoid this, what I'm doing, I'm calling my banker and I'm telling to my banker, if so and so person named Miss C comes to you, brings to you check number, for example, 234689, don't honor this check. Stop payment order. We call it as stop payment order. So if I issue any stop payment order to the banker, to avoid this section 138 consequences, what court can do, court will lift a stop payment order, and court will observe whether balance in the account is sufficient to discharge liability or not. That means, what sometimes, drawers of the checks they will do, to escape from section 138 punishment, first they will issue checks and they will give a stop payment order to the bankers. Tomorrow, if court of law, if court tells that, you issued a check, and the check got dishonored. So we are going to impose section 138 against you. Then what drawer can tell? Sir, if check is dishonored due to insufficiency of funds, then only you can take action against me under section 138. But here check was dishonored due to what? Stop payment order. See, I need to link up the point. First of all, tell me, check dishonored due to insufficiency of funds. So definitely 138 is attractable. So to avoid this, what I'm doing, I'm giving a stop payment order to my banker. And banker is dishonoring this instrument. On what grounds? Stop payment order. It's not on insufficiency of funds. Dishonor due to stop payment order. Now, whether section 138 are attractable or not attractable, actually not attractable. In this way, drawers can easily escape from punishment under section 138. So, to avoid this and to punish drawers, so here also bankers, here also courts will make section 138 attractable. Understand? So even if a check is dishonored due to stop payment order, first court will observe. Suppose if this order is not there, whether balance in the account at that time, is it sufficient to discharge this check or not? To discharge the obligation of this check or not, they will check. And yes, sufficient, sir, 138 not attractable. Insufficient, sir, 138 is attractable. See, on this point only, we had one practical question in a ICS study material. 5 questions are there. At the end of this quick revision, I will show those questions also. So next one, presentment of the instruments rules. See, presentment means placing instruments. Suppose, in school days, you can see the competition, the winners will get prizes, presentation, presentment. Now here, presentment means placing an instrument in the hands of appropriate person. Suppose I gave a promissory note to you. Is it a negotiable instrument or not negotiable instrument? Negotiable. You can transfer to X, X can transfer to Y, Y can transfer to Z. Now who is the ultimate holder of the instrument? Z. How I can know that information? On due date, if he presents that instrument to me, I can make an assumption. Yes, Z is the holder of the instrument. So I will make payment to Z. So this, payment obligation is arising only by way of presentment. So placing instrument in the hands of maker of a note to make payment, or in the hands of acceptor to make payment, we call it as presentment. And this presentment is of two types: presentment for acceptance, presentment for payment. Bills of exchange requires acceptance. Yes or no? Presentment for acceptance. So bill of exchange payable after sight. That means, here maturity period will be counted after acceptance. 3 months after sight means 3 months from the date of acceptance. So it must be presented for acceptance to drawee within a reasonable time and during business hours. If drawee can't be found after reasonable search, the bill is said to be dishonored. Dishonored due to non-acceptance. If directed to a specific place and the bill must be presented there, if drawee can't be found, then also it is dishonored. So for acceptance, you present that instrument to my office address. When you presented that instrument at office address, I was not found or I am not there. So you can treat that instrument is dishonored. Dishonored due to non-acceptance. Presentment by registered post is allowed by agreement or usage. So directly you can come to me for acceptance, or you can post it to me. So I'll open the letter, I will give my acceptance, and I again repost it to you. Next one, presentment of promissory note for sight. See, actually promissory note doesn't require acceptance. Then this promissory note for sight means promissory note for payment. Bill of exchange sight means acceptance. After sight means acceptance. Whereas promissory note for sight means payment confirmation. See, a promissory note payable at a certain period after sight must be presented to the maker for sight within a reasonable time during business hours. If presentment is not made, no party is liable to the person making the default. So bill of exchange after sight means after acceptance. Promissory note for sight means for payment. So when I present it for payment, you are liable to me. Without presentment, you are not liable. So when we can treat instrument as a dishonored instrument? Only after presentment, when the purpose is not satisfied, when the purpose is not fulfilled, then instrument is said to be dishonored. If the purpose is getting acceptance and acceptance we didn't get, dishonored due to non-acceptance. If presentment is for payment and if we didn't get payment, then dishonored due to non-payment. Actually, in negotiable instruments, what happens, for example, M is giving instrument to P. Maker of the instrument is giving instrument to payee. P negotiated this instrument to X. X to Y. Y to Z, finally Z to Z negotiated this instrument to H, holder. So on due date, who is the holder of the instrument? H. On due date, H will recover amount from M. H will present this instrument in the hands of M to get payment. If M fails to pay, then he can recover amount from any of the prior parties. That means, either P or X or Y or Z are liable to H. Whomsoever H wants to make liable, H can recover that amount from prior parties. But this right H can exercise only when H presents this instrument for payment. Suppose if H fails to present this instrument, if H is making a default with respect to this presentment, then he can't get rights against prior parties. That means his rights are always associated with a duty. When he fulfill duty, he will get rights. So what is that duty, ma? Duty to present on maturity date. If he fails to do so, then all prior parties are said to be discharged. Next one, drawee time for deliberation. Drawee has 48 hours time to decide whether to accept bill of exchange presented for acceptance. See, in a business world, I will have n number of suppliers and I will place n number of orders over a period of time. So I'm having, for example, 5 suppliers. Daily I'm buying from 5 suppliers. At the end of the week, you are sending a bill of exchange to me for acceptance. Now, during the week, how much amount I purchased from you? How much amount I am liable to you? I need to verify. I need to verify through my books of accounts. So I should check my books of accounts. If amount is matching, I will give acceptance. For this, I need sufficient time. And that sufficient time is 48 hours excluding public holidays. Suppose 48 hours excluding public holidays over, I didn't give acceptance. Then you can treat it as dishonor due to non-acceptance. So 48 hours is important condition. Next one, presentment for payment. Same. Here, only by presenting this instrument for payment, you will get right to recover amount of the instrument. If presentment is not made, then all other parties are discharged. They are not liable. Presentment can be made by registered post also. One simple example, negotiable instrument, it is since negotiable. The maker don't know about the holder of the instrument. I gave it to you. I think you are the holder of the instrument, but you transfer to someone else. And who is that someone else? How can I come to know? So simply if that person comes to me, if that person presents that instrument to me, I'll make payment. And another example, I'm having checkbook of 20 checks. I issued 20 checks to 20 customers. 20 suppliers. Now, how banker knows about these 20 suppliers? Once they come to banks, once they present their checks into the banker, to the banker will make payment. So without presentment, payment is not applicable. And without presentment, can I treat instrument as dishonored? No, instrument is not said to be dishonored until and unless it got presented. Exception for promissory notes payable on demand. For promissory note which is payable on demand, and if no place is specified, then presentment is not required. See, actually, these kind of instruments are not at all prevailing right now. Right now, promissory note bill of exchange is not at all popular. Right now, we are having only checks. Yes or no? So there is one kind of instrument, a promissory note, which is payable on demand, and place of presentment is not specified. If place is not specified, then presentment is not required. So immediately you are liable towards that instrument. So generally, demand promissory notes, if I'm giving, what is the sense of giving demand promissory notes? First of all, no sense at all. Instead of giving it directly, you can pay money. So these kind of instruments were popular old days, where because, in old days, the promise is, if a person is making promise, he will die for that promise. Earlier days. So, they will have words like, I will pay after 1 month, but on note, they will not mention the time limit. Court will observe only writings on the instrument. So they will go only with the wordings. As per wordings in the instrument, it's a demand instrument. And place for presentment is not mentioned. Then presentment is not at all required. Whenever he comes to you, you are liable. That's it. So olden days, word has so much of power. But right now, it is everything, whatever I'm speaking, we will put it in the agreement. Everything will be written. So olden days, this kind of promissory notes prevail, but right now, not in existence. But you have to remember that presentment is not required for promissory notes payable on demand, where place of payment is not specified. They can ask you this 2 marks, true or false. Like, presentment is required for promissory note payable on demand and not at a specified place. The answer is false, because presentment is not required. Truncated checks, I already told you. Hours per presentment, only during business hours. For bank, banking hours. Suppose evening 8 o'clock, if you go to bank, if you knock the door, I need payment of the check. They will not make payment. They will make payment only during banking hours. So for other parties, business hours. Next one, presentment for payment. Yes, if it is a time instrument, it should be presented on maturity date. Before maturity date, even if you present it, I'm not liable to it. So that's why you can see bills of exchange will be discounted with the banks. Next one, presentment for payment, installment payments. So every installment will have a due date. And you all know the time instrument will have a concept of maturity. Maturity date will be 3 days after the last date of the instrument. What is the concept of these 3 days? Grace days. In accounts, we are having concept of calculating maturity date of bills of exchange, right? So after calculating the grace days, after considering grace days, you will get maturity date. Only on maturity date, you need to present, and I am liable for it. Before maturity date, you can't present. Even if you present, I'm not liable at all. Presentment for payment. If place is specified, present it at specified place. If place is not specified, then usually business address. If business address is not there, then residential address. Suppose I'm not having business address, I'm not having residential address, then wherever I am found, present there. But logically speaking, a person without business address, without residential address, who told you to sell goods on credit basis to such person? Logically, this will also not applicable. But as per the law, if no place mentioned, and if that fellow is not having business address, that fellow is not having residential address, then wherever he found, present it and demand for payment. Next one, it's up to the parties. See, when I'm doing a credit transaction with you, I'll make a number of inquiries about you, whether you make payment on timely basis or not. It's not, it's not like a lucky dip. Okay, simply blindly trusting you, giving goods on credit basis. It won't be like that. So first I will go through your credit history. Then only I will sell goods on credit basis. So since these points are there, this law is made in the year 1881. At that time, when a person is making a promise, he will die for the promise. Now it will not happen. No promises. Every day we are making promises. Every promise, maximum promises, we will break it. So if we speak about 1881 time period, all these are valid points only. But we are in the year 2025. So these points may not be worth. Next one, presentment of check to charge drawer. To charge drawer before the relation between drawer and banker changes. Check should be presented before the relation between drawer and banker changes. The meaning of this point is, suppose today I gave check to you. So today, imagine date is 10th January 2025. You can present it this check to my banker, within 3 months. Within 3 months, check is having a validity of 3 months. Within 3 months, you can present it. But you made a delay. You presented it on 10th of February. During its validity only, you presented it. But you took 1 month time. Meanwhile, in this 1 month, SBI announced bankruptcy. Actually, I'm maintaining account balance of 1 lakh in this account. I'm maintaining balance of 1 lakh rupees because I issued a check of 90,000 to you, so that you can encash that instrument. Like that, I maintain 1 lakh balance. And you failed to present it within a reasonable time. Meanwhile, what happens? Bank became bankrupt. Bank became insolvent. Now, banker, the relation between me and banker is changed. Banker is announcing, for example, we can't pay you, we can pay you 0. Now, you can't demand 90,000 from me, because if you present that instrument before bank became insolvent, you would have received that instrument, and loss to me have reduced from 1 lakh to 10,000. So before, between the drawer and banker relation getting changed means if banker is getting closed. Understood? Suppose, sir, the same day banker became insolvent, sir. Now obviously I'm liable to you. 1 month time is there, 1 month time is there. You can present it within a reasonable time. You fail to present it within reasonable time. Meanwhile, what happened? Banker became insolvent. Now you can't recover amount from me. So if you want to charge drawer, if you want to recover amount from drawer with respect to check amount, that instrument must be presented with banker within a reasonable time. And presentment of check to charge other parties, so it should be done within a reasonable time. So here it is a reasonable time, whereas to charge drawer, that reasonable time is before drawer banker relation is getting changed. Understood? So confusion, actually there is no confusion at all. The point is very clear. So to charge drawer before bank gets failed, present it. And to charge other parties like endorsers, it should be presented during its validity period. That's it. Next one, demand instrument should be presented within reasonable time. Presentment by agent or representative. So if I present that instrument to your agent, presentment to agent is equal to presentment to principal. Act of agent is equal to act of principal. Accordingly, valid. So if I am giving instrument to your agent or your legal representative, that presentment is valid. Excuse for delay in presentment. Suppose, maturity date. On maturity date, government announced a lockdown for 1 month. Actually, I need to present it on maturity date, but it is in a lockdown period. So even if I present after 1 month, delay is there, but still that presentment is valid. All the prior parties are liable. Actually, if you make any delay in presentment, all the parties except the maker of the promissory note gets discharged. Yes or no? So you will get a right only when you perform a duty. So if you violate your duty, you won't get right. But if that delay is because of an excuse, suppose it is beyond the control of a holder, like lockdown, when presentment is unnecessary. So no presentment is necessary in case where maker, drawee, acceptor prevents presentment or if he is unreachable after due search, among other exceptions. Suppose I'm trying to present it, but you are not there at that place. So now no need of presentment. Liability of banker for negligently dealing with the bill. If bill of exchange is dishonored and the banker negligently deals with causing loss to the holder, the banker must compensate the holder for loss. Who is the default here? Banker is negligent, right? So banker is liable to compensate. Actually, there is a rule like this. The point is, suppose I issued a check with 50,000 rupees to you. Actually, my bank balance is 5 lakhs. When I issued the check, bank balance is 5 lakhs. My account number ends with 7719. At the time, when you presented this check to banker negligently entered account number as 7791. Actually, my account is 7719, but in his system he entered it as 7791, and the account balance in 7791 is 50 rupees. Accordingly, he issued a notice of dishonor. Yes, instrument got dishonored like that. Banker issued a dishonor to you, dishonor notice to you, and you made an allegation against me. So you gave a check of 50,000 and your bank balance is 50, like that. You are telling you are spreading this news. As a result, my credibility in market gets affected, and everything is done because of banker negligence. So definitely here, I can make my banker I can make my banker to compensate my loss of reputation. The banker should not act negligently. If banker is acting negligently, holder can recover loss, drawer can recover loss. Holder can recover instrument amount 50,000, whereas drawer can recover compensation amount, like which is affecting his reputation. Next one, the same point is there here also. Okay, last concept, rules of compensation. Holder is entitled to the amount due on the instrument along with the expenses for presenting, noting, protesting. Suppose instrument is 50,000 and for presentment I opted registered post expenditure, for example 50. Now holder can recover 50,000 50 rupees from maker of the promissory note or acceptor of the bill of exchange. Understood? Suppose if that instrument got dishonored, and for the dishonor I made noting and protest also. So noting and protest they will act as an evidence in the court of law. Yes, instrument is dishonored. Notary public will issue a certificate called certificate of protest. It will act as an evidence that instrument is dishonored. As you know, court will not give punishment directly without evidences. So this noting and protest will act as an evidence. For noting and protest, I incurred 500 rupees charges. Now holder can recover 50,550 rupees from the party, maker of the note or acceptor of the bill. If the person charged resides at a different location from where instrument was payable, holder is entitled to receive the amount at current exchange rate between the two places. Here current exchange rate means, charges, simply charges. Suppose, if you look at cash deposit machine, if you deposit cash at a non-local branch, suppose you belongs to Hyderabad and you deposited cash in Chennai cash deposit machine. So if you deposit 20,000 rupees, the entire 20,000 rupees will not be credited. The amount will be credited. The amount credited will be 19,980 rupees only. Why 20 rupees got deducted? Bank charges. Understood? So in this case, you should not deposit 20,000. You should deposit 20,020 rupees. Understood? Suppose, I drawn a bill of exchange on you. How much? 20,000 rupees. And you should make payment to me. Suppose you are residing in Chennai, I am residing in, for example, Delhi. So for transfer of this amount, generally bankers will levy charges. So those charges also, who should bear the charges? Acceptor of the bill of exchange. Including charges, you should transfer that amount to me. An endorser who pays the amount due on the instrument is entitled to receive amount paid along with 18% interest per annum for the delay period. In case of delay, from date of maturity to date of payment, if there is any delay, for delay period, yes, one can claim interest at the rate of 18% per annum. If person charged and endorser reside in different places, B, D are same points, but in D point you can see endorser. If you want to make endorser liable and the endorser is entitled to receive the amount at the current change rate between the two locations. See here the concept is, suppose M gave instrument to P. P transferred that instrument to X. X to Y, Y to H. On due date, H presented this instrument for payment and M dishonored this instrument. Now what H did? H recovered this instrument amount from X. Now H is happy. Y is also happy because both the parties, all these parties gets discharged. He can recover not only instrument amount but also current exchange rates. Next one, the party entitled to compensation may draw a bill upon the liable party for the amount due along with all expenses incurred, and this bill must be accompanied by the dishonored instrument and any protest if applicable. So M drew a check amounting 2 lakhs payable to N and subsequently delivered to him. After receipt of check, N endorsed same to C but kept in his safe locker. Endorsement is over. After some time, N died and P found the check in N's safe locker. Does this amounts to endorsement under Negotiable Instruments Act 1881? No. Why? Endorsement is said to be completed only when it is delivered. So here, before delivery, the endorser got deceased. So therefore, no delivery, it's not complete endorsement. Next, second question. M owes money to N. Therefore, he makes a promissory note for the amount in favor of N. For safety of transmission, he cuts the note in half. That means it's not tearing the note. It's like, executing instrument in two parts. So part 1 is enforceable only if it is attached with part 2. Safety point of view, I'm executing instruments in two parts. Part 1 is enforceable only when it is attached with part 2. Suppose if I am not sending part 2, then part 1 will not get any enforceability. He then changes his mind and calls upon N to return the half of the note which he had sent. N requires M to send the other half of the promissory note. Decide how rights of the parties are to be adjusted. So here, delivery is not complete. So instrument, negotiable instrument contract can be revocable. So until delivery, instrument is revocable. That means, incomplete. Bolnath drew a check in favor of Surender. After having issued the check, Bolnath requested Surender not to present check for payment and gave a stop payment request to the bank in respect of check issued to Surender. Decide under the provisions of NI Act 1881 whether the said act of Bolnath constitute an offence? Yes. Because insufficiency of funds is there. To escape from that punishment, he is giving an instruction regarding stop payment order. So it will not act as a defense. So he will get punishment. So Rama executes a promissory note in the following form. I promise to pay a sum of 10,000 after 3 months. Is it a valid promissory note? No. because payee details are not present. So it becomes bearer promissory note. Bearer promissory note, you had no authority to make bearer promissory note, so invalid promissory note. Nakul made promissory note in favor of Sahadev of 10,000 and delivered to him. Sahadev endorsed promissory note in favor of Arjun but delivered to Arjun's agent. Very simple. Delivery to agent is equal to delivery to principal. Act of agent equal to act of principal. Subsequently, Arjun agent died and promissory note was found by Arjun in his Arjun's agent's table drawer. Arjun should knuckle. Whether Arjun can recover that amount under provisions of an act? Yes. Because delivery to agent is equal to delivery to principal. So third question you can see, accordingly act of Bolnath, his request stop payment constitutes an offense. And fourth one you can see, it's a illegal promissory note. Fifth question, as already told you, Arjun is eligible to claim payment of the promissory note. So with this, revision of an act completed. Let's continue our marathon with the next chapter, Companies Act 2013, which is having a weightage of 15 marks in your examination. So first one, definition of a company. So company means company incorporated under this act or under any previous company law. This act means Companies Act 2013. Previous company law means, Companies Act 1956, Companies Act 1913, Companies Act 1882, Companies Act 1866. So the logic of the definition is, company means not only a new company but also old company. Old company means companies which are incorporated under previous company laws. So even though you are incorporated under Companies Act 1956 or 1913 or 1882 or 1866, you have to follow our new Companies Act, that is Companies Act 2013. And if you look at the applicability of Companies Act 2013, first it is applicable to all existing companies as well as new companies. Next one, our Companies Act is also applicable to big companies. Big company stands for, B stands for banking company, I stands for insurance company, G stands for generation or supply of electricity. But there is small exception. Exception is if Banking Regulation Act and Companies Act, if Insurance Act and Companies Act, if Electricity Act and Companies Act, if they had conflicting provisions or inconsistent provisions, then for insurance company, banking company, electricity company, follow respective statutes. So simple, special rule always overrides general rule. For these three companies, Companies Act is a general act, whereas for them, Insurance Act, IRDA Act, Banking Regulation Act, Electricity Act, all these are special acts. So follow special acts in case of inconsistency. Next one, companies governed by special acts. For example, Life Insurance Corporation. So what Life Insurance Corporation Act is telling? If LIC Act is silent, then apply Companies Act to LIC. If LIC Act is specifying that, no, Companies Act is not applicable to us, then Companies Act is not applicable. So for the time being, if LIC Act is silent, then our Companies Act is also applicable to Life Insurance Corporation. Next one, body corporates incorporated by any act is applicable as specified by central government through notification. See, there is a difference between company and body corporate. So what is the difference? First of all, you all know that every company is a body corporate, but every body corporate need not be a company. See, the difference is body corporate is an incorporated association. Company is also an incorporated association, but company is incorporated under Companies Act, whereas body corporate, it may be incorporated under other acts. If you take LIC, it's a body corporate. If you take LLP, it is also a body corporate. So simply, any incorporated association becomes a body corporate. But if that incorporation happens under Companies Act, then it becomes a company. So by default, yes, if central government specifies through notification, for example, few provisions applicable to LLP, then Companies Act is also applicable to LLP. Next one, features of a company or characteristics of a company. Every company will have following characteristics. So what are those characteristics? Let's see one by one. Separate legal entity. See, company is separated from its members. Suppose if you take partnership type of organization, partnership is not a separate legal person. It is a relationship among the partners. So suppose Mr. A, B, C, three persons came together. They had a like mindset, same mindset. So they started a business in the form of partnership, partnership type of organization. A contributed plant and machinery. B contributed working capital. And C contributed, for example, C contributed his managerial skills. So with these three things, with plant and machinery, with working capital and skills, this partnership firm A, B, C and Co, it is doing a business operations. It is carrying business operations. But suddenly A got a doubt, without my plant and machinery, this A, B, C and Co cannot survive. Similarly, B also got a question, I am very superior because having plant and machinery, having skills alone is not sufficient. Because of my working capital only, they are procuring raw materials, they are converting raw materials into finished goods. Now C is also thinking that he is a superior because having plant and machinery, having working capital alone is not sufficient. How to deal with suppliers, how to deal with customers, entering contracts with suppliers, entering contracts with customer is important. So I am superior. Like that, everyone is thinking superior, and suddenly a dispute came between them. Now what A is doing? A is withdrawing his plant and machinery, or B is withdrawing his working capital, or C is C is not providing the skills. Now what happens? A, B, C and Co cannot carry business operations. So this is the biggest disadvantage in the partnership. As long as partners have same mindset, without disputes, they can carry business operations. But if these three people, A, B, C forms a company, for example, ABC Private Limited. Now, whatever they contributes in the form of capital to the company, all those assets becomes assets of ABC Private Limited. So Mr. A is contributing plant and machinery, it becomes asset of ABC Limited. B is contributing working capital, yes, it becomes a cash balance of ABC Private Limited. And C is contributing skills, so definitely this is also asset of the company. How it is an asset? Using managerial skills only, company is carrying business operations. Now suddenly if A wants to withdraw his ownership, he can withdraw not by selling plant and machinery but by selling his shares. As you all know, company will issue shares against the contributions made by the members. Now any person, if he want to withdraw from the association, by selling his shares, by transferring his shares to another person, he can come out of the organization. That means there is no stoppage with respect to company carrying business operations. From carrying business operations, there is no stoppage. Like if A want to withdraw, by selling his shares, he will get out. B, by selling his shares, he will get out. Now plant and machinery, cash, everything is with ABC Private Limited. Of course, even if C withdraws, company will look for a director who can do business operations effectively and efficiently. So by having directors, yes, one can easily carry business operations. Now there is no stoppage with respect to business operations. Second thing, in case of partnership, yes, owners nothing but partners. And these owners have a joint and several liability. That means I'm liable not only for my share, I'm also liable for my partner's share. And my nature of liability is unlimited. So these are the biggest disadvantages in partnership type of organization. And moreover, who carry out business operations of a partnership firm? Partners only. Partners only will carry business operations. Their nature of liability joint and several, and as well as unlimited. Unlimited liability means what? Here, the liability is not restricted to business assets. Liability is also extended to personal assets of the partners. Suppose three partners contributed capital of, for example, 10 lakhs each. So capital amount is 10 lakhs, 10 lakhs, 10 lakhs. Outstanding loans, for example, 1 crore. Fixed assets, current assets, imagine balance is 50 lakhs. Next one, P&L debit balance. That means accumulated losses. Accumulated losses, it is some 80 lakhs. Now total is 1.3 crore. Now they decided to stop the business operations. Now, with this 50 lakhs, we can settle 50% of the outstanding creditors. Remaining 50 lakhs, these 50 lakhs, who should contribute? Partner should contribute. So already we contributed to the partnership firm. Okay, but here liabilities are there, deficit amount is there. Assets are not in a position to meet liabilities. Assets are less than liabilities. So the deficit amount you have to contribute from your personal assets. That's what unlimited liability. Suppose if any partner become insolvent, loss arising out of insolvency partner should be borne by other partners. Understood? Now, second point, separate legal entity. As a separate legal entity, what happens, company, if you take a partnership as well as if you take company, partnership, those who can know about carrying business operations, if they start partnership, it's best thing. So simply here owners should have business idea, business knowledge. They should have business knowledge. But coming to the company, owners just they will make investment. The role is restricted to investment. Now who will carry business operations on behalf of company? Directors, nothing but agents of the company will carry business operations. Now we can appoint skilled persons as directors. We can appoint skilled persons, knowledgeable persons as directors of the company. So that privilege is there in case of company type of organization, whereas that privilege is not there in case of partnership type of organization. First of all, legal entity, separate legal entity. That means, company is separated from its owners. So act of company, owners are not liable. Suppose, company took a 60 lakhs loan from State Bank of India and company made a default in repayment of this 60 lakhs. Now, SBI can recover that amount from company assets. SBI will not ask my owners. That means, SBI will not ask members to contribute this 60 lakhs. So here owner's role is restricted to investment, and that investment, if they are holding fully paid up shares, then their liability is zero. For future liabilities, owner's liability is zero. So even though if company makes default, owners are not responsible for company debts. Company acts. Understood? So having separate legal entity is advantage from holding assets point of view as well as liabilities point of view. Liabilities point of view, company is responsible, members are not responsible. Assets point of view, company is the owner of assets, so there will be no break with respect to carrying business operations. The company is a distinct legal entity, separate from its members. It can own property, raise loans, enter into contracts. Members do not have ownership rights over the company property. See here, members are owners of the company. Company is owner of company assets. That doesn't mean members are owners of the company assets. Why? Because separate legal entity. Perpetual succession means continued existence. So here, members may become insolvent, or members may decease, members may be died, but existence or non-existence of members will not affect existence of the company. See, company birth, company death, everything is taken care by operation of law. For getting incorporation certificate, we need to file documents, and for liquidation of company also, we need to file documents with the authority. So existence as well as death of a company is decided by operation of law. It only ends when legally wound up. Limited liability. Many think that this limited liability characteristic is for company. No. Company will always have unlimited liability. Like a natural person, company will always have unlimited liability. So here I am talking about, limited liability. I am talking about members, owners of the company. Owners of the company will have limited liability. Liability of members is limited to the unpaid value of the shares. In case of company limited by guarantee, liability is limited to the amount guaranteed by the members. See, here we are having two types of companies. Company with the share capital, company without share capital. In case of without share capital, you can see company limited by guarantee. So Indian Contract Act, we are having a guarantee concept. So here, each and every member will give a guarantee with respect to certain amounts. So in the event of liquidation, they are liable only to the extent of guarantee amount. In case of with share capital, members liability is restricted to unpaid value. So how we get unpaid value? Very simple. Face value minus paid up value. Face value suppose 10 rupee, paid up value is 6 rupee. Now unpaid value means 4 rupee. Suppose member M is holding 1000 shares. Now 1000 into 4, 4000 rupees is the maximum liability of the M. And if you take suppose Mr. N is holding 10,000 shares. 10,000 shares into 4 rupees unpaid value, 40,000 is the liability of Mr. N. And here there is no joint and several liability concept. Suppose if M becomes insolvent, N is not having any obligation to contribute towards 4,000 rupees deficit. So no joint and several liability, limited to the extent of unpaid value. Suppose if you look at the balance sheet of a company, suppose paid up share capital is 60,000, 10,000 shares, paid up value 6 rupee. Whereas face value how much? 10 rupee. Outstanding loans, for example, 1 lakh. Current assets plus fixed assets put together 80,000. And profit and loss debit balance, that means, loss amount 80,000. Now, total 1.6 lakh, 1.6 lakh. Now, this company decided to liquidate itself. So, now this 80 lakhs is not sufficient to settle 1 lakh debts. So, there is a deficit amount. How much the deficit amount is there? 20,000. Now, members, to what extent members are liable? Unpaid value is how much here? 1 lakh, actually 10 rupee face value minus 4 rupee, minus 6 rupee paid up value, 4. 4 into 10,000 shares means 40,000 is the unpaid value of all the members. 40,000 or deficit amount 20,000, whichever is lower. That is the maximum liability of the members. So that means here members are not liable for complete unpaid value. They are liable only for 20,000. Suppose if deficit amount is 1,20,000, now they are liable only to the extent of 40,000. So maximum liability is unpaid value and no joint and several liability concept. And if you look at these two companies, liability point of view, if you look at these two companies, if you are a member of company with the share capital, your liability may arise in two situations. Situation one, when company wants money for expansion. If company need money, that means during going concern, they can call for money. Board of directors can call for money. Or suppose company is not making calls on shares, suddenly it went into liquidation. And during liquidation, there is a deficit portion is there. Deficit, that means, assets minus liabilities, negative figure we got. So deficit amount. That means, in case of a company with share capital, member liability will arise in two circumstances. One is during lifetime of the company, if board of directors are making calls on shares. Or during liquidation, if assets are not sufficient to settle outside liabilities. But coming to company without share capital, here member liability will arise only at one instance, that is at the time of winding up or at the time of liquidation, when assets are not in a position to meet its liabilities. So member liability arises twice in case of company with share capital, whereas member liability arises only once in case of company limited by guarantee. That too only at the time of winding up, and that too when assets are not sufficient to settle outside liabilities. That is all about limited liability. Next one, artificial legal person. See, company is not a natural person like us. So company is not a citizen. Company is not a citizen. A company is created by law, has rights similar to the human being. It can own property, enter contracts, can be sued on its own name. However, it cannot do the things like marriage, practice as a learned profession. Even it can't vote in elections like a natural person doing. Of course, it can acquire properties, it can enter into the contract. Suppose if it is not paying amount to the creditors, then creditor can sue the company. Suppose if it is not receiving money from debtors, then it can sue the debtors. Next one, common seal. See, natural persons, we can sign any contract, but artificial person like company, how it can sign the contracts? So two options are there. Option one, common seal. But right now, common seal is just optional. Companies Amendment Act 2015 made a common seal optional. Actually, common seal is nothing but official signature of the company used to authenticate documents. So in the absence of common seal, two directors signing the contract document, it's sufficient. Company is bound by the contract document. In case company is having secretary, then one director plus one company secretary signing the contract document. Yes, company is bound by that contract agreement. As you all know, oral contracts can be oral or in written, but enforceability point of view, everything should be in writing. So in writing, definitely parties should sign the contract document. So if company is a party to the contract, then how signature will happen? If common seal is there, common seal plus these people will sign. If there is no common seal, then these people will sign. If these people are signing on behalf of company, assume that company is signing it. Next one, corporate will. Next topic is corporate will, lifting of corporate will. See, this concept is connected with separate legal entity. In separate legal entity, the biggest advantage we are having is act of company. Act of company is not equal to act of members or act of directors. So accordingly, act of company, who will get punishment? Company will get punishment. Only company will get punishment, like unlimited liability, for example. Act of company, who will get punishment? Company. For example, company is not making payment to its creditors. So who will be punished? Company will be punished. Members are not at all connected with the acts of company. So this is the advantage. Because of this, members will get more protection. They are not liable for the acts of the company. But if you take partnership type of organization, act of one partner, all other partners are liable. Complete firm is liable. But company, act of company, only company is liable. Now tell me, who is having unlimited liability? Company or members? Company. And who is having limited liability? Members. So this advantage is available if you are forming a company for lawful purpose. As long as you are forming, you are incorporating companies for lawful purpose, this advantage will be with you. But if you are incorporating company for unlawful purposes, then this wheel will be lifted. For example, only one example I'll tell you. So for example, I'm Mr. V. I'm having a tough fighting with for example, Mr. K. I don't like Mr. K. He's always, he is always doing acts against to me. Now I want to kill Mr. K. So definitely if I kill Mr. K, I'll be sent to jail. I'll be punished. So that's why what I'm doing, I'm incorporating a company with name like V Murderers Private Limited. The objective of this company is to kill a person whenever it receives a contract. So to kill a person for a valid lawful consideration. So now, I incorporated a company. I'm the member of the company. I'm also director of the company. One day I went to the company premises as a customer. In company we are having advantage of dual role. Dual role means, a member of a company can act as a customer, can act as an employee, can act as a director, can act as a creditor also. But in case of partnership, this benefit is not there. In case of partnership, you can be a only partner. You can't do business with the partnership firm. Coming to company, a member can participate with company in n number of roles like an employee, director, customer, creditor also. Now, as a customer, I approached this company. Now I'm giving an order to the company, contract order to the company. So kill Mr. K. I'll give you 5 lakh rupees like that. I made a contract with company. Now this company, it recruited for 4 gundas. And these 4 gundas killed Mr. K. Next day, when police came to me to arrest me, what I will tell, it's not me. I didn't kill Mr. K. Company killed Mr. K. So company should get punishment. So this is the certificate of incorporation. So take this certificate of incorporation and take all legal actions against company. So because of this separate legal entity concept, if these cases are prevailing, so everyone for carrying unlawful business operations, what they will do, they will float a company and they will ask a punish company. But this is not correct. So this should be eliminated. So separate legal entity is definitely a benefit, but this benefit is available only to the people with a good intention, with who wants to do business operations lawfully. But if your intention is bad, if your intention is fraudulent, then the benefit of separate legal entity will be ignored. That is nothing but lifting of corporate will. So legal concept that a company is distinct from its members and they are shielded from the liability for the company's actions. So we had few case laws also, Solomon versus Solomon Company. So Solomon versus Solomon Company, here, the concept is separate legal entity is available even though 100% of share capital was held by one person or family members. Either a single member or all his family members are holding 100% share capital of a company. It is still assumed that company is separate person, members are separate persons. Understood? Lifting of will. Cases where corporate personality is disregarded and courts focus on the real actors behind the company. So who acted behind the company, they should get punishment. For that, what we will do, we will ignore corporate will. So few cases we are having, 5 case laws we are having. So I'll give you a summary of these 5 case laws. Determining the character of the company. To determine whether company is a enemy company or friendly company. Actually, company, whether it is a Indian company or foreign company, it all depends on place of incorporation. It all depends on place of incorporation. Suppose, sir, 10 Korean people came to India and formed a company in India. Now, is this company Korean company or Indian company? Answer is Indian company only. So 10 people from Africa came to India and incorporated one company in India. Now, is it an African company or Indian company? Indian company. So that means, nationality of the company depends on place of incorporation. It doesn't depends on, members' citizenship. It doesn't depends on director's citizenship. So you may belong to other country, but if incorporation happens in India, it is an Indian company. Understood? Now the point is, what happened here? For example, 5 members from USA. Imagine 5 members from USA came to India and started one company in India, a trading company. The name of the company, for example, ABC Limited, ABC Private Limited. So yes, USA company is sending all the goods to ABC Private Limited. ABC Private Limited is selling all the goods in India. And here this company is getting money from the customers in India, and this company is sending money to USA company. USA, we had parent company, and India, we are having a subsidiary company. Now, suppose the relationship between India and USA is not good, and it triggered to war. So, India in one group, USA in another group. Now, these two countries becomes allied enemies. Now here, USA company, to make investment in defense, it is collecting all the money from its subsidiaries, or it is collecting money from all its customers. So yes, it called ABC Private Limited to pay the money. ABC Private Limited, it denied the payment, stating that there is a war between India and USA. Now you and me becomes allied enemies. USA company is telling that no. You are incorporated in Indian company. You are as an Indian company. I'm a US company. Okay, between us, definitely whatever you are saying. Okay, the relation is not good. Okay, fine. India versus USA relation is not good. Okay, fine. But if ABC Private Limited is collecting money from its customers can deny making payment to ABC Private Limited. The reason is, if customers make payment to ABC Private Limited, obviously ABC Private Limited through other channels, they will transfer money to USA company. Now ABC Private Limited is telling that no, I'm not a foreign company, I'm an Indian company. My incorporation happened in India. You can look at the certificate of incorporation also. As per certificate of incorporation, my place of incorporation is in, for example, Hyderabad. So I'm not a aligned enemy, I'm a aligned friend. So you can make payment to me like that. ABC Private Limited is calling all its customers. Now customers, there is a dispute between customers and ABC Private Limited. Yes, matter went to the court. So court observed that, okay, if customers make payment to ABC Private Limited, what would be the next status? What would be the next step? Definitely this company will transfer amount to USA company. So here, by ignoring separate legal entity of ABC Private Limited, we can observe that this company was operated by foreigners. So who are the real persons behind this company? If they are aligned enemies, then this company is also aligned enemy. If they are not aligned enemies, then this company is also not an aligned enemy. So here, to know the real character of the company, we ignore corporate will. Understood? Second one, to protect revenue or taxes. Previously, olden days, companies were taxed with less tax rates, whereas individuals were taxed with high tax rates. Right now, if you observe carefully, individuals' highest rate of taxation is 30%, whereas for corporates, rate of taxation is 26%. Of course, we are having basic exemption limit, we are having slab system, but maximum rate of taxation, if you observe, highest taxation rate for individual is 30%, whereas for companies is 26%. Now, I'm getting 100 crores, for example, 100 crores income. If I take this money directly, I need to pay tax of 30 crores. But if my company receives this 100 crores, my company will pay how much tax amount? Only 26 crores it will pay. So 4 crores can be protected. 4 crores can be benefited. So for this purpose, I incorporated a company named C Limited. And C Limited is receiving this amount of 100 crores and it is paying tax of 26 crores. And C Limited is just acting as an intermediary only for receiving this amount. The real intention of incorporating C Limited is not to carry business operations, only to avoid a high rate of taxation. So if your intention is like that, we ignore C Limited corporate will and we will tax entire 100 crores in your hands. Accordingly, we will collect 30 crores from you. Suppose company already paid 26 crores. Okay, fine. So from 30, we will deduct 26. Balance 4 crores, you have to pay. Now ignoring will, we are putting entire income in your hands and we are charging tax accordingly. So that is the second one. To protect revenue or tax, if company was incorporated, we ignore corporate will. Third one is to avoid legal obligations. Suppose company C Limited is liable to pay bonus. For example, bonus rate is 10% of profits. Example. Actually, this is not a formula for bonus, but for example, I'm telling you. Suppose C Limited net profit is 100 crores. Then how much bonus I should pay? Into 10% means I need to pay 10 crores bonus. So in my company, I'm having 50 workforce. So definitely I need to pay bonus of 10 crores to the 50 workforce. Imagine. Now, to avoid this, what I'm doing, 50% of or 60% of my operations, I'm shifting 60% of my operations to another company called subsidiary company. So I'm incorporating a company with the name S Limited. And in S Limited, the number of employees is 0. But 60% of my revenue operations, I'm shifting it to S Limited. Since S Limited number of employees is 0, here bonus obligation is 0. And in C Limited, what would be the net profit after transferring 60% of the operations to S Limited? Only 40 crores. Why? 60% already transferred to S Limited. Now 40 crores into 10% means how much? 4 crores. So originally employees are liable, originally employees should get how much bonus? 10 crores. But now how much bonus they are receiving? 4 crores. So this case, yes, if you allow yes limited corporate will, what happens? Employees were paid very less bonus. So to protect welfare of employees, if any subsidiary was incorporated or if any company was incorporated to reduce our company profits, so we are going to ignore corporate will of yes limited, and we are going to consider the 60 crores profit in the hands of C limited. Now C limited total profit will be 40 plus 60 which belongs to S limited, total how much? 100 into 10%. So now they will get a same bonus, original bonus. See, the actual case studies are different. For easy, for marathon purposes, I'm taking easy examples. So that means, I'm taking all the numbers, all the characteristics, imaginary characters and imaginary figures. Next one, formation of subsidiary to act as agents. Suppose my company is a C limited. It is engaged in manufacturing, for example, vehicles. It is engaged in manufacturing vehicles. Over a period of time, I violated Factories Act provisions. I violated environmental rules and regulations. As a result, what happened? Government of India came to me and it cancelled all the licenses of me. Now I can't carry manufacturing operations in India because my license was cancelled. Now what I'm doing, I am incorporating another company, S Limited, which will act as an agent to C Limited. Now S Limited is applying for licenses in order to carry manufacturing operations, but S Limited is carrying manufacturing operations not for itself but for C Limited, because C Limited is having a reputation, brand image in public, and it can't carry manufacturing operations because its licenses were cancelled by Government of India. Now if a company with name S Limited applying for licenses to carry manufacturing operations on behalf of C Limited, that means acting as an agent to another company, now here we will ignore S Limited corporate will. Accordingly, we will cancel all the licenses looking at the figure of C Limited. Understood? Next one, company formed for fraud or improper conduct. So Guilford Motor versus Horn. As you all know, company is an artificial person. It's not a natural person. It is an artificial person. So as I told you, company is an artificial person. It is not a natural person. So definitely it can't do things on its own. It requires human agency. For carrying its operations, it definitely requires human agency. So in the human agency, you can find board of directors and you can also find employees. Suppose company C Limited, it is providing services to its customers. In employees, particularly one employee, Mr. E, he is maintaining good relations with customers. Now looking at E, board of directors are very much worried about E's conduct. Why? Because this fellow is maintaining good relations with customers. Tomorrow, if E left our company, if E leaves our company, and if he start a separate business, separate showroom for providing services, definitely all our customers will go to that showroom. They will not come to us because he is maintaining good relationship with the customers. So that's why what C Limited did, it made one agreement with Mr. E. That agreement is, tomorrow if you leave our company organization, if you are going to start a separate business, you should not seduce or you should not attract company customers. So if you attract company customers, yes, you will be punished. Like that, they made an agreement. This is an agreement in restraint of trade, restricted, complete restriction, void. But local jurisdiction, locality limits, you can't carry business operations within this locality. It is allowed, it is valid. So he signed this contract document and immediately the next day, he left the company. And he started same service showroom in the same in the same locality, but he didn't started that business in a sole proprietorship type of organization. He formed a company, for example, E Private Limited. Now E Private Limited is distributing pamphlets among the customers of C Limited. So it went to the customers of C Limited and it is distributing pamphlets to customers. Now all the customers are diverting to E Private Limited. Board of directors questioned Mr. E, why you did this? E is telling, no, I didn't do this. Company did this. Act of company is not act of a member, or it's not an act of a director. So company did it. and I personally signed this agreement. Okay, I will not start any business within this locality. I didn't start any business. Company started the business. Company gave pamphlets to the customers. I'm just a director or I'm just a member. So who acted here? Company acted here. So act of company is not equal to act of members. So accordingly, I should not get any punishment. That is the argument of Mr. Yi. But if we allow that argument, what happens? All agreements which are in restraint of trade can be overridden with these arrangements. Actually, E is doing that activity, but not directly through a corporate will of E Private Limited. So here what court did? Court ignored the E Private Limited corporate will and observed Mr. E. The real person behind this company is Mr. E. Actually, he can start this business in sole proprietorship or in case of partnership also. But why he started company? Because to avoid this agreement, to override this agreement, he started a private company. So he can do with sole proprietorship. He can carry this business operations in sole proprietorship type of organization or partnership type of organization. But why he selected company? In order to override this agreement. As a sole proprietor, as a partner, if he start this business, definitely company can take action against Mr. E. So here corporate will was lifted. When a company is formed to defraud creditors, defeat the law, or for improper purposes, the will may be lifted. So here in every examination, definitely one question will come on this case studies. They will not ask you to write case studies, but they will narrate a story. They will narrate a situation which is similar to the case study, and they will ask you whether corporate will be lifted or not. So after studying these 5 case studies, one point is very common. If company is formed with a good intention, genuine intention, lawful intention, corporate will is available. It will not be lifted. But if a company is incorporated with a fraudulent intention to defraud creditors, public, government, non-payment of taxes, next one, employees, non-payment of correct bonuses, or acting as an agent, or to identify the real character of the company, whether it is an enemy or whether it is a friend. So only in these cases corporate will be disregarded. At CA foundation level, this is the concept. But actually corporate will sometimes we ignore corporate will for genuine reasons also. If you take an example like holding company, subsidiary company. Holding company is a controlling company, subsidiary company is a controlled company. So at the end of the year, holding company has to prepare consolidated financial statements, which includes the figures of Yes Limited. So there what we are doing, we are ignoring wheel of Yes. And we are taking all the financial figures of Yes and we are adding to financial figures of H. So this is, for preparation of consolidated financial statements. But at CA foundation level, you just remember the logic, if your intention of incorporating company is fraudulent, illegal, unlawful, then corporate will be lifted. That's it. Next one, classification of companies. So right from here onwards, all the topics are very small topics, simple topics. So company limited by shares, company limited by guarantee, unlimited company. All these 3 companies are talking about liability of the members. Liability of company is always unlimited. Similar to a natural person, company liability is always unlimited. But liability of a members depends on the nature of the company. If you take limited by shares, here liability is limited to unpaid value on their shares. So if I am holding 40 shares, my liability is restricted to 40. If I am holding 4 lakh shares, my liability is restricted to 4 lakh shares. So I'm not liable for my friend holdings. I'm not liable for my neighbor holdings. So no joint and several liability and no unlimited liability in case of company limited by shares. Shareholders' separate property cannot be used to meet company liabilities. As I told you, company took 60 lakhs loan from SBI and it made a default in repayment of 60 lakhs. Now, SBI can recover amount from company by selling company assets but not member assets. Understood? So liability is restricted to company assets. Liability is restricted to unpaid value of the shares held by them. Limited by guarantee. Limited to the extent of the amount they undertake to contribute in case of winding up. Members can only be called upon to contribute at the time of winding up, after winding up begins. So that's what the difference between A and B. In case of B, liability arises only once in the lifetime of the company, that too at the time of winding up. Whereas in case of, in first case, liability arises in 2 cases. One is when board of directors are making calls on shares. The other one is when official liquidator is asking for contribution money. Contribution money, for financing the deficit amount. Understood? So company limited by shares, member liability arises in two situations. Suppose if you are holding fully paid up shares, then your liability is 0. Next one. Such companies do not raise working funds. Which companies? Company limited by guarantee. They do not raise working funds from the members, but may get funds from donations, fees, endowments. Actually Section 8 companies, they select this category, company limited by guarantee category. So they will not carry business operations, just they will carry charitable activities. For carrying charitable activities, they get donations. Understood? Next one. Some clubs, if you take, few members can form a club, and that club will provide services to those members. So these clubs are operated by a fees paid by the monthly fees paid by the members, annual fees paid by the members. That's it. So a Section 8 company, charitable company, or clubs. So only for few families or few local residents, they form clubs under company limited by guarantee concept. So for operating these companies, donations or monthly fees, monthly subscriptions sufficient. Membership privileges differs from those in case of company limited by shares. One thing is very different. But the difference is these companies will carry business operations. This company will not carry business operations. So accordingly, membership privileges will also differ. Suppose if you are a member of a company limited by guarantee which is offering club services, so here you will get some personal services for which you will pay monthly fees. That's it. Unlimited company, no limit on liability of the members. Each member is liable for the whole amount of the company debts. Members can be called for contribution towards the liabilities of the company even after they cease to be members. See, look at the last point one more time. Members can be called for contribution towards the liabilities of company even after they ceases to be members. That means, actually present members are liable for deficit amount. Deficit means at the time of liquidation, if assets are less than liabilities, the difference amount, I call it as deficit. All present members are liable towards the deficit. But if any present member is not making payment, then we will go with past members. Here past members means members who transferred shares within 1 year before commencement of liquidation. I'm not making all members liable. I'm making only, suppose, 1st December 2025 is a commencement date of winding up. So present members are, for example, A, B, C. Deficit amount is 30 lakhs. So A, B, C are liable to contribute 30 lakhs. Suppose if present members are not making payment, we will observe from whom they got shares. Suppose A got share from X, B got share from Y, C got shares from Z. And when these transfers happen, suppose these transfers happened on 1st June 2025. So now if you observe carefully, this transfer happened within 1 year before commencement of liquidation. So now if present members are not making payment, not contributing, then we will hold past members. Logic is very simple. We had a concept called going concern. Going concern means what? Company will carry business operations for the next 1 year. So everyone will think that, unlimited period. Company will carry business operations for unlimited period. It's not correct. It's not unlimited period. Just next 1 year, if you are able to carry business operations, then going concern assumption is said to be appropriate. This assumption we will take every year. Every year, 31st March, we will take this assumption. So next 1 year, are we able to do business? Yes, then going concern is there. So forcible future is the word used in going concern. Forcible future means 1 year. Now, standing on 31st March 2025, XYZ came to know that this company can't carry business operations further. And looking at the balance sheet, they came to know that deficit amount is 30 lakhs. So at any point of time, within the next 1 year, at any point of time, if company goes into liquidation, we 3 members should contribute how much? 30 lakhs. So that's why what they will do, they will find out innocent persons and who are financially incapable persons. They try to transfer shares to those persons and they try to protect themselves. But the point is, who is getting affected? Creditors is getting affected. So that's why for protecting creditors, what we will do, we will ask present members to contribute. If present members are not in a position to contribute, then we will hold past members. And past members means who transfer shares within 1 year. When you are going backdated, that 1 year restriction is from commencement of winding up. Commencement of winding up onwards, go back 1 year. Understood?
More than 1 year?
Then past members are not liable. Only present members are liable. More than 1 year means, it is exceeding the period of going concern assumption. That means that might be a genuine transfer. Suppose they are making transfer on 31st March 2024, and company is getting liquidated on first, for example, first September 2025. So standing at this position, they can project or they can predict up to 31st March of 2025 only. And this 1st September 2025 is beyond the radius of 12 months. So I imagine, I can assume that these transfers are happening genuinely. But if transfers are happening 1 year before commencement of winding up, I assume that these transfers they are doing only to escape from the liability. So if present members are not making payment, then past members I will make liable. So that is the reason. Next one, classification of companies on the basis of number of members. So here we are having only two companies. On the basis of number of members, we are having only two companies. One is private limited, the other one is public limited. And in case of private limited company, if there is only a single member, minimum and maximum, if there is only single member, we call it as OPC and others. So OPC is a private limited company where minimum and maximum number of members is 1. Understood? Coming to other companies, minimum number of members is 2 and maximum number of members is 200. And for public company, minimum number of members is 7, maximum there is no limit at all. Understood? So let's see OPC. So who can become a member? Only one person can become a member, and that one person should be a natural person, and that one person should be Indian citizen, and that one person should be his period of stay in the preceding financial year should be 120 days or more. So these three conditions to be satisfied, then only that person can become a member of the company. That person, another person who satisfies these three conditions can become nominee of OPC. I'll just tell you the logic why OPC is required. Why OPC today? Why OPC we are having? See, I want to start a business under company type of organization. But what Companies Act is telling? For private company, minimum 2 persons are required. But I don't want to share my ownership. I should take decisions independently. So for me, only two options are available. One is sole proprietorship. Only one option is available, sole proprietorship. For company, definitely I need how many parties? 2 parties. But I had no intention to share my ownership. I had no intention to share my profits. So in that case, the best option is sole proprietor. But sole proprietor, we had a disadvantage of unlimited liability. And from Government of India point of view, sole proprietors can't be governed. Government of India cannot govern sole proprietors because they don't know how many sole proprietorship organizations are there in India. But if you are a company, definitely, company incorporation is compulsory. So creation of company, every year filing of financial statements, annual returns, everything is taken care by government, central government. That means transparency is possible in case of company or sole proprietorship company. Every year when you are filing returns with the central government can monitor you. Central government can know what activities you are involved into. So transparency is possible in company, whereas the transparency is not possible in case of sole proprietorship. But this fellow don't want to share his ownership. In that case, we should provide an alternative mechanism to that person. That alternative mechanism is OPC. Here even a single person can start a company. So he can have all the advantages like limited liability, separate legal entity, perpetual succession, every advantage as a company, he can enjoy. But in OPC, one extra character is there. In addition to member, the extra character is nominee. Whenever member position got vacated, nominee takes the position of member. But this member and nominee should satisfy 3 conditions. What are those 3 conditions? Both should be citizen of India. Both should be natural persons. And both period of stay in the preceding financial year should be 120 days or more. So let's look into the material. 1 person company, only 1 person as a member. Separate legal entity with limited liability for the member. Simplified procedural requirements compared to other companies. Member must be Indian citizen and resident. But here we had a note point. The note point is period of stay in the preceding financial year. If it is 120 days or more, then he is eligible to become a member of the company. He is eligible to become a nominee of another OPC. Nominee must consent to become a member in case of subscriber's death or incapacity. Suddenly, if a member got deceased or if a member became insolvent, then there arises a vacancy in the position of member of OPC. In that case, nominee becomes member of the OPC, and after becoming member, he will appoint another person as a nominee. But before naming someone as a nominee, it is compulsory to take consent of that person. Only after taking written consent from that person, you can name that person as a nominee. No minor can be a member nominee, because minor has no contractual capacity. He cannot become member, he cannot become a nominee. And one person company is prohibited from carrying two activities. It's not two, three activities. One is non-banking financial activities. The second one is investment activities. And third one is Section 8 activities. See, the objective of having OPC is to encourage entrepreneurship. Entrepreneurship main objective, entrepreneur main objective is profit. It's not charity. That's why OPCs are strictly prohibited from converting into Section 8 company. OPCs are prohibited from carrying NBFC activities as well as investment activities. If you want to carry investment activities, carry individually. If you want to carry charitable activities, form Section 8 company. If you want to carry NBFC activities, form a non-banking financial company. But OPC, no. Reason for OPC, more privileges are there. And for these companies, more restrictions are there. So that's why conflict of points are there. That's why, OPC is prohibited from carrying three activities. So they can ask you a practical question like this. OPC is planning to start NBFC activities, or starting, they had a plan to start investment activities, or they had a plan to convert themselves into, they had a plan to convert OPC into Section 8 company. So advise board of directors of OPC, like that they can ask you a question. Now you have to write this provision and you have to write a conclusion stating that OPC is prohibited from carrying NBFC activities, investment activities, Section 8 activities. Significant points, only one member. At any point of time, you will have only one member. And there is no limit on minimum paid up share capital. Nominee to replace member only in the death of member or in the incapacity of the member. Not only these cases, another case is there. Suppose financial year 24-25, my period of stay is 150 days. So 25-26, I am eligible to continue as a member of the company. But in 25-26, what happened? For example, I got married to a foreigner. After marriage, I went abroad. And my period of stay in financial year 25-26 fall into 80 days. Now for financial year 26-27, I'm a disqualified person. As a disqualified person, I can't continue position of member. So now what happens? Vacancy arises in the member position. Now also nominee will take position of member. So like this, a question was asked in CA Inter. The question is, suppose M is a member of OPC, N is a nominee of OPC. On 1st June 2024, for example, N got married to F, a foreigner. After marriage, N left India. And period of stay of N with respect to financial year 24-25 fallen below 120 days. So what are the consequences with respect to financial year 25-26? Very simple. There is a vacancy in the nomination clause. Member has to appoint another person to take the position of nominee. That means, vacancy, it is important. Vacancy arises because of three reasons. Reason one is death. Reason 2 is incapacity. For example, becoming unsound mind or becoming insolvent. And third reason is disqualification under Companies Act. 2013. Here the disqualification is, suppose if he is revoking Indian citizenship, he went outside India, he applied for USA citizenship and he revoked Indian citizenship. This is one disqualification. Suppose his period of stay in the preceding financial year is fallen below 120 days. Then also this is a disqualification. So in all these cases, what happens? There arises vacancy. Understood? Next one, private company. Private company is a company which should have minimum paid up share capital as prescribed. Right now, what is the limit? Not yet prescribed. And these 3 points are very important. These 3 points differentiate private company from public company. So what are those 3 points? First one is restricts. Next one is limits. And third one is prohibits. So if someone asks you how to differentiate a company, whether it's a private or public, very simple. Just open company AOA. In company AOA, if you are able to find restricts, limits, prohibits, then it's a private company. Restriction is on what? Restriction is on transfer of shares. Limitation is on what? Limitation is on a number of members. Prohibition is not on what? Prohibition is on making public offer. Making public offer. So these words should not be interchanged. Sometimes students will write restricts public offer, prohibits transfer of shares. That is wrong. The transfer in case of private company is allowed, but subject to some restrictions. So what are those restrictions? Every time when you want to transfer shares, you have to communicate with board of directors. Why? The name itself is telling private company. That means they maintain privacy. They maintain confidentiality. If you are transferring shares freely to other people, what happens? Confidentiality will be affected. So a new person will come to the company. He will know all the confidential matters. So to protect confidentiality, to provide privacy, yes, if you have an intention to transfer shares, communicate your intention with the board of directors. Board of directors will allow you to transfer shares only to the existing members. In this way, restrictions are imposed. Next one, limits membership to 200. So maximum number of members is 200. While counting the number of members, two people are excluded. One is present employees. Second one is past employees. Past employees, not all past employees. Past employees who became member during their employment period. Suppose, private companies, they can encourage employees to work harder only by making a payment of salaries. But few private companies, startup companies, they may face cash crunch. So in that case, they generally offer ESOP, employee stock option plans. So this motivates employees a lot. Why? Because, after getting a share, he is not only an employee, he is also a owner of the company. Now, when they are offering ESOPs and when you are imposing condition of 200, so they can't offer ESOP to all its employees. So this benefit of ESOP should be extended to all the employees. So that's why 200 count is not permitted. 200 count is not applicable to employees. That means, employees, even 1000 employees are becoming members, their count shall be treated as 0. And the problem is, employee will not have perpetual succession concept. One day he will retire because of age factor. Now he will become ex-employee. Now becoming ex-employee, sir, if we count this 1000 as 1000, what happens? Number of members will go beyond 200. So which should not happen. That's why not only present employees, employee who got terminated because of, retirement or superannuation, that employee, when he became member during employment period, is not counted. Suppose if he become member after termination of employment, then he will be counted. Understood? All ex-employees are excluded only when they become members during the employment period. If they become members after employment period, then counted. Understood? Next one, private company is prohibited from making a public offer. That means it cannot issue prospectus, it cannot offer securities to the public because name itself is a private company. Understood? Next one, private company can be a small company and OPC is compulsory a private company. Significant points, minimum 2 members, maximum 200 members. No invitation to the public to subscribe to shares. No restrictions on paid up capital. So next concept is small company. So what is a small company? Any company satisfying 3 conditions. It is a small company. First of all, it should be a private company. Its paid up share capital shall not exceed 4 crores. Its turnover shall not exceed 40 crores. Then it becomes a small company. Now by virtue of this definition, just tell me, company name Kalyan Jewelers Limited. Paid up share capital is 4 lakhs. Turnover is 40 lakhs. Is Kalyan Jewelers Limited a small company? Small company or not a small company? So if you write small company, the answer is wrong, 0 marks. Because you are looking at the limits, but you are not looking at the nature of the company. So what I told you, small company, it's a private company. Kalyan Jewelers Limited is a public company. So if it is a public company, it will never become a small company even though it satisfies the requirements of paid up share capital and turnover. Understood? So 3 conditions satisfied, then only it becomes small company. And small company excludes section 8 companies. Small company excludes holding companies. Small company excludes subsidiary companies. Small company also excludes statutory companies. Statutory companies. That means a company which was incorporated under a statute. Is it clear? Yes. So any company which was incorporated under statute, we call them as statutory companies. For example, LIC Act is there. Even though LIC satisfies the limits of paid up share capital turnover, but still it is not a small company. Of course, public company is also not a small company because it should be a private company. Therefore, public company is not a small company. So in examination, they will try to confuse you like this. Like for example, ABC Private Limited, whose paid up share capital is 2 crores. Paid up share capital is 2 crores. Turnover is 20 crores. Out of 2 crores paid up share capital, 1.5 crore paid up share capital was held by C Limited. Now, can you classify ABC Private Limited as a small company or not? The answer is no. Why? Because this is a subsidiary to C Limited. Out of 2 crores, when 1.5 crore was held by C Limited, that means C Limited is holding 75% of ABC Private Limited. So it will become a subsidiary company. So subsidiary company is excluded from small company. Holding company is also excluded from small company. So they can ask you a question like this also. For example, same company, ABC Private Limited. ABC Private Limited. Its paid up share capital is 1 lakh. Its turnover is 10 lakhs. But ABC Private Limited is holding 60% of paid up share capital of D Private Limited. Now, can we classify ABC Private Limited as small company? The answer is no, because this is a holding company. Holding, subsidiary, statutory, Section 8 company, public company. These 5 companies are excluded from small company, even though it satisfies the limits of turnover as well as paid up share capital. Getting it? Next one, public company. So what is a public company? Any company which is not a private company is a public company. So a company which is not a private company, it's a public company. Next one, it has no restrictions on transfer of shares. Shares are freely transferable. And paid up share capital, minimum paid up share capital as may be prescribed. And minimum number of members is 7, maximum no limit. Next one, a subsidiary of public company is also considered as public company. Suppose P Limited, which is a public company, holding 60% paid up share capital of C Private Limited. Now P Limited, actually it's a public company. C Private Limited, by its AOA, it's a private limited company. But for this purpose, this is deemed public company. Any company, whether it is a private or public, if it is a subsidiary to public company, it is deemed to be public company. That's it. Understood? Significant points: minimum number 7, maximum number no limit, shares are freely transferable, and no minimum paid up capital requirement. Right now, requirement was not yet prescribed. That's why no requirement. So in entire public company definition, it is very important to remember this part. This part is very, very important. So see, any private company, if it is a subsidiary to public company, then it becomes a public company. Clear? Next classification is classification based on control. So here, on the basis of control, companies are classified into 2 types. One is controlling company. Other one is controlled company. Controlling company, controlled company. One who controls another company, we call it as controlling. And one who got controlled by other, we call it as controlled company. Suppose holding company controls subsidiary company. So subsidiary company will listen to holding company terms and conditions. Now to become a holding, to become a subsidiary, what is the criteria? The criteria is more than 50% of voting power. And we get voting power from holding paid up share capital. So for the time being, 50% of paid up share capital, 50% of voting power, both are same. But if company is having 2 types of shares, like equity shares with normal rights, equity shares with the differential rights, then voting power of paid up share capital will not be same, will differ. So in our syllabus, we are not having that concept, so just ignore. So for the time being, 50% of voting power. Any company having 50%, more than, it's not equal to, it's more than 50% of voting power in another company, then another company becomes subsidiary, and first company becomes a holding. This control can be of three types: direct control, direct plus indirect control, total indirect control. Suppose H Limited, S Limited. In S Limited, H Limited is having 60% of voting power. Now H Limited becomes holding company, S Limited becomes subsidiary company. Next one, S Limited, H Limited, same criteria. 60% of voting power was held by H Limited. In S Limited, 60% of voting power is held by H Limited. S Limited is having 25% voting power in A Limited, and H Limited is having a 26% voting power in A Limited. Now, if you go to A Limited general meeting, annual general meeting, who will attend annual general meeting of A Limited? Members. Out of members, both H as well as S can attend the A Limited. Already H is having 26% control, S is having 25% control, and since S is subsidiary to H Limited, S will listen, S will cast 25% of voting rights as per the will and wish of H. So that means, H along with its subsidiary can control a third company. Now this third company becomes subsidiary to H Limited. So this is a case of direct plus indirect control. So only H alone is not controlling A, H along with S is controlling A. Why S will listen to H? Because S is already a subsidiary to H. Next category, for example, H Limited is having a 60% voting power in S Limited, and S Limited is having a 75% voting power in A Limited. Now if you observe carefully, A Limited is already under the control of S Limited. S Limited is also under the control of H Limited. Now if H gives any direction to S with respect to A, S will implement the direction and A will also implement the same direction. Getting it? So that means, A is indirectly controlled by H. Understood? So now if you observe carefully, A is a subsidiary to S, A is a sub-subsidiary to H. In fact, A is a subsidiary to H. So sub-subsidiary concept is not there. Sub-subsidiary is also a subsidiary. So this is totally indirect control. So how many types of control is there? Three types, direct plus indirect, indirect. And this is one part of definition. Another part is there. Let's see. A company is a holding company when it has one or more subsidiary companies. So if a company is having a subsidiary, then this company becomes holding company. Very simple definition. Any company having subsidiary, it becomes a holding company, and it includes only body corporates. For example, if you take Reliance Industry Limited, 51% paid up share capital. 51% paid up share capital was held by Mukesh Dhirubhai Ambani. Now, can I call Reliance as a subsidiary to Mukesh? No, because Mukesh is a natural person. So to call someone as holding company, it should be a body corporate, first of all. Next one, controls the composition of board of directors in the subsidiary company, or exercises controls more than 50% of total voting power of the company. So this point is okay, but what is the first point? First point, suppose H Limited company is there, S Limited company is there. Here H Limited is not holding a single share of a H Limited. It is not holding single share. But they entered into an arrangement. As per the arrangement, S Limited majority of directors. Suppose S Limited is having 9 directors. Out of 9, 5 directors appointment, removal. This power is with H Limited. Now also H Limited becomes holding, S Limited becomes subsidiary. That means control can be either through voting power or control may be through board of directors. If I had a majority of, if I had control on the composition of directors of the another company, that another company becomes subsidiary, I will become holding. Understood? Cannot have unlimited layers of the subsidiaries. Like, layers means like this: A, B, C, C, D, like this. 1, 2, 3, like this. Unlimited layers not possible. But it can have like this. It can have multiple subsidiaries like this: A, B, C, D, E. This is permitted. Horizontal permitted. That means all these are fellow subsidiaries. This is permitted. But sub-subsidiaries, there is a restriction. Permitted to 2 layers only. Maximum 2 layers. Next one. A company is a subsidiary company if another company, that means holding company, controls either composition of directors or controls more than half. Remember, greater than 50%. Don't write in examination 51% or more. It is wrong. Here, more than half. That's it. That means greater than 50. Suppose capital of a company is 1 lakh. Now, how many shares, how much share capital holding company should possess? More than half means 50,001 sufficient. Suppose each share face value is also 1 rupee. That means how many shares are there? 1 lakh shares are there. So 1 lakh out of 1 lakh shares, 50,001 shares held by one company. That company becomes holding. This company becomes subsidiary. And subsidiary company extends even if control is indirect through another subsidiary. As I told you, control can be direct alone or direct plus indirect or indirect alone. Next one, a private company that is a subsidiary to public company is deemed to be a public company for the purpose of this act, regardless of whether it's a private company by its articles or not. So as I told you, any company which is a subsidiary to public company, by default, it becomes public company. Next one, associate company. Associate company is a company in which another company has significant influence. Significant influence means how much? 20%. But it should not exceed 50%. Why? If it exceeds 50%, it becomes holding subsidiary. So the voting power control should be like this, greater than or equal to 20%, but less than or equal to 50%. So if it is 51%, holding subsidiary relationship will come. If it is exactly 50%, associate relationship will come. Understood? So 20 to 50, any percentage between 20 to 50, it becomes holding and subsidiary. It becomes associate. And associate company also includes joint ventures. So joint venture, it's a joint arrangement where parties have joint control and rights to the net assets of the arrangement. So next one, on the basis of access to capital, companies are classified into 2 types, listed company, unlisted company. So what is the difference between listed and unlisted? Listed company means any one of its securities listed on any one of the recognized stock exchange. See, as a company, I can have equity shares. I can issue equity shares. I can issue preference shares. I can issue convertible debentures. I can issue non-convertible debentures. So for the time being, 4 securities. Any one category listed with any one recognized stock exchange, either NSE or BSE, that's it, I'll become listed company. But listed company excludes specific class of companies as prescribed by regulations in consultation with SEBI. So this point you will study at CA inter level. Detailed explanation is given with respect to this point. For example, a company which has issued NCD on private placement basis but listed on stock exchanges is considered as unlisted company. That point is not there in our syllabus, so just ignore the point. So for the time being, listed company means any of its securities listed on any recognized stock exchange. Either it may be equity or preference or convertible debentures or non-convertible debentures. So need not be equity alone. Any other security listed on recognized stock exchange, that's it. Listed means what? Approval ma. Suppose stock market, stock market is a platform to trade securities of the company. So where n number of buyers, n number of sellers will come to sell their shares, n number of sellers will come to sell their shares, n number of buyers will come to purchase the shares. So this is a platform. Stock market is a platform for trading securities. On this platform, if you want approval for trading your securities, we call it as listing. So any of its securities listed, any recognized stock exchange. It's not all stock exchanges, it's just any stock exchange, then you become listed company. Next one, unlisted company. Any company which is not listed company, it is unlisted company. So unlisted company means, it also includes, private companies. It also includes public companies which are not listed. Suppose if you take Reliance Industry Limited, its say shares were listed on recognized stock exchange. So this is a listed company. Geo Platforms Limited, another company is there. It's a public company, but it is not listed on recognized stock exchanges. So it is a unlisted public company. So who can get access to public money? Only listed companies. It's not public companies. Listed public companies will have access to public money. Next one. On the basis of ownership, government company. A company where 51% or more. For holding subsidiary, what is the percentage? More than 50. Holding subsidiary more than 50. Very important. Whereas for government company, it's greater than or equal to not 50 but 51. Greater than or equal to 51% of paid up share capital held by CG, SG, both CG, SG, and includes subsidiaries of government companies. Paid up share capital includes voting power for shares with differential voting rights. Right now, concept is not there, you just ignore. Now the point is, suppose take a company, for example, G Limited. G Limited paid up capital, 20% was held by central government, 20% held by AP government, AP state government, 10% held by Telangana state government, and 5% held by Tamil Nadu state government. Now, what is the status of G Limited? Is it a government company or not a government company? So 20 plus 20 plus 10 plus 5. So total how much it is? 55%. So G Limited becomes government company. Understood? Suppose G Limited 40% of capital was held by central government. 50.1% of capital was held by Indian Oil Corporation, IOC. IOC is already a government company. IOC is already a government company. IOC, in IOC, 52% of capital was held by CG. So IOCL is already a government company. Now, what is the status of G Limited? What is the status of G Limited? Is G Limited a government company or not a government company? Government or not government? Answer is government. Why? Here, central government is holding 40%. Here for us, it is not the point. Here, this is a subsidiary to government company. That's why it becomes a government company. Understood? Another tricky question. Chance of getting this question is there. Chance of getting this question is there. So the question is, suppose, listen carefully. Answer me. G Limited is a company. 20% of capital was held by CG. 20% of capital was held by SG, state government. 20% of capital was held by Indian Oil Corporation Limited. And 40% was held by public. Others, simply others. Now, what is the status of G Limited? Whether G Limited is a government company or a not government company? So, answer is non-government company. If you look at the definition, 51%, while calculating 51%, you have to consider only CG, SG, both CG, SG. That's it. IOC is not a government. IOC is not a government. It's a government company. So you have to consider only CG holdings plus one or more state government holdings. That's it. So you should not consider Indian Oil Corporation like this. So by this, G Limited is a non-government company. Understood? Suppose would your answer differ if 60% of capital was held by IOCL? No, answer is different. It's a government company. Why? Because this is a subsidiary to IOC. Subsidiary to government company is also a government company. Very simple definition. Government company, to get status of government company, either 51% of paid up share capital should be held by CG, one or more SG, CG plus one or more SG, or more than 50% of voting power should be held by government company. So don't add these both. Don't mix up. Individually, you have to check. Next, foreign company. Only two things you have to remember. Two things. Okay, three things. What are those three things? Place of incorporation, place of business, business activity. Place of incorporation should be outside India. If it is in India, then it is an Indian company. If a place of incorporation is in India, default it becomes Indian company. So here place of incorporation should be outside India. And place of business should be in India. And they should conduct some business activities in India. Then only it becomes a foreign company. Now listen carefully. Place of incorporation, suppose it is Singapore. Place of business is also Singapore. Business activity is also Singapore. Now is it a foreign company? No. No, it's a company incorporated outside India. To call it as a foreign company, place of incorporation should be outside India plus place of business should be in India. If place of business is also outside India, then it is not a foreign company. It's a company incorporated outside India. See, there is a difference between three terms. Company incorporated outside India, company incorporated outside India, foreign company, Indian company. There is a difference between these three. Indian company, place of incorporation is said to be in India. Company incorporated outside India means, place of incorporation is outside India. Whereas foreign company means place of incorporation outside India and place of business should be in India. Either of these two conditions are not satisfied. Either of these two, if any of these conditions not satisfied or either of the conditions not satisfied, either it may be company incorporated outside India or it may be a Indian company. That's it. Understood? So company incorporated outside India becomes foreign company only when they start business operations in India. That business operations in India may be two types. One is either physical business operations or electronic mode of business operations. Like, Alibaba Group, if you observe, they are providing online platform for buying and selling of the goods. They are incorporated outside India, but business is happening in India, not through physical establishments, but through electronic platforms. Now it becomes a foreign company. Physical mode of operations, for example, Amazon, it is having a branch office in India. So it becomes a place of business is in India and there is a physical branch is there, so it becomes a foreign company. So branch operations may be either, branch may be physical or maybe online. That's what, either directly or through an agent or via electronic mode. Understood? So our next concept is Section 8 company. This is a company with charitable objects. So not every company is meant for earning profits. There are few companies where main objective is serving public welfare activities. Now for carrying these activities, yes, we had an option of society, we had an option of trust. But in these two categories, transparency is not up to the mark. If you are a company, definitely every year you need to file annual returns, you need to file financial statements with ROC. So transparency is possible throughout the India. If you are a society or if you are a trust, you are governed by state government rules and regulations. So your activities are permitted, your reporting responsibilities is permitted to that state alone. So transparency point of view, Section 8 companies are best compared to society as well as trust. Now for forming Section 8 company, three conditions to be satisfied. What are those three conditions? First condition is object clause of MOA. Second condition is all about surplus, excess of income over expenditures. Third one is dividends. Objects should always contain SARC objects. SARC means, S stands for science, sports, social welfare. A stands for art. E stands for education or environment protection. R stands for religion. C stands for charity, commerce, etc. So objects should be, first of all, charitable objects. Shortcut is SARC. Second one, surplus, dividends. Dividends are strictly prohibited. There is a prohibition on declaration and payment of dividends by the Section 8 company because they are not carrying business operations. If they are carrying business operations, profits can be distributed. But how they are carrying operations? They are carrying operations with the donations they receive. So donations belongs to public. This is a public money and this money should be spent only on public. So dividends strictly prohibited. And what we should do with the surplus is invest surplus in promoting objects of the company. Sometimes, suppose your objective is to run an educational school. And for construction of this school, you got a donations of, for example, 10 lakhs. And construction cost around 9.6 lakh came. So there is a surplus. How much? 40,000 surplus is there. Now this 40,000, can I distribute in the form of dividends? No. Then what I should do with this 40,000? Invest this 40,000 on promotion of educational activities. So they will ask you a question like this, few individuals want to start a company with charitable objects for 10 years. After completion of 10 years, they want to distribute the surplus, accumulated surplus they got over a period of 10 years. Whether the distribution of accumulated surplus allowed or not allowed? Answer is not allowed. Next one, utilization of profits, promoting the objectives of the company. Dividends are strictly prohibited. Examples, we had examples. Next one, formation licensing. In addition to formation of a company, normal formation, you need to get a license from CG. Once you get license, then CG allows you to omit name limited or private limited in your name. Generally, name of a company always ends with private limited in case of private companies, limited in case of public companies. But for Section 8 companies, this restriction is not there. So they can use names like, foundation, federation, board, like this. Next one, the company once registered enjoy all the privileges of limited company, like, limited liability of members, separate legal entity of the company, perpetual succession, all these advantages company can have. Next one, revocation of license. So you have to remember 3 points here. 3 points. What are those 3 points? Contravention of Section 8 provisions. Contravention of license conditions. The contravention of Section 8 conditions, contravention of license conditions attracts revocation of license. As I told you, dividends distribution prohibited, but you are distributing dividends. That is contravention of Section 8. And at the time of giving license, central government imposed some conditions, like priority should be given to the local areas, like some few areas it prescribed. And they told you have to spend amount on primary schools, not secondary schools, but you are spending amounts on colleges. So whenever a condition imposed by central government, if you are violating, then central government, it will come to you, it will give an opportunity of being heard to you, and then they will revoke the license. And suppose if you are carrying activities which are prejudicial to the public, prejudicial, that means that violates public interest, then also license stands cancelled. License stands cancelled. Prejudicial, for example, you said that your objective is providing education, and you are providing education like how to hold guns, how to target, how to kill people, how to kidnap people. So this is also a learning only, this is also training. But if I allow you to provide this kind of training services, public interest, public will be in panic situation. Kidnap, robbery, murder, all these are against to the public interest. So whenever a Section 8 company contravenes its objectives or conditions of the license, or it is carrying fraudulent activities, then central government, after giving opportunity of being heard, cancels the license. After revocation of license, government either it may order for amalgamation of the company or winding up of the company. Amalgamation means one company acquires another company. So purchaser company will acquire selling company. And this amalgamation should happen only with similar Section 8 company. Similar company means similar Section 8 company means. So yes, getting practical question on this category also possible. Suppose Delhi Sports Club is there. This is Section 8 company engaged in providing sports training, and some fraudulent activities. Company was engaged in some fraudulent activities. Central government observed these activities, and central government cancelled the license. Now, two companies are there. For example, Hyderabad Sports Club, one company is there. Another one is Dream Education Society. Dream Education Society. This is also a Section 8 company. Just wait. Dream Education Institute. Now it will make sense. So now this company should be amalgamated with another Section 8 company. So which Section 8 company is preferable? Whether it's a Hyderabad Sports Club or a Delhi Educational Institute or Dream Educational Institute? Answer is Hyderabad Sports Club. Why? Because both are engaged in same activities. It's not, I'm not giving priority to the state. I'm giving priority to the objectives. So here it is engaged in sports, Hyderabad Sports Club. Here it is engaged in education. Now, if you want to amalgamate this sports club, it should be amalgamated with another sports clubs. That means a Section 8 company with similar objectives. They will ask you a question like this. Suppose another company, for example, Geo Platforms Limited, which is a profitable objective company. So Geo Platforms Limited wants to acquire Delhi Sports Club. So amalgamation possible or not possible here? Not possible. Why? It should be amalgamated only with a Section 8 company. That too, which company? Similar Section 8 company. Understood? So next one, penalties for contravention. If you are violating Section 8 or if you are violating license conditions, then punishment is, for company 10 lakhs to 1 crore, officers in default 25,000 to 25 lakhs. And if any person is involved in fraudulent activities, then he will get a punishment of Section 447. Best example, we had one movie called Shivaji, Rajinikanth sir movie. So in that movie, what happened? he converted black money into white money through some anti-money laundering through money laundering activities. Actually, I provided services to one client, 1 crore rupees the service fees. If I receive this 1 crore, I need to pay tax of 30 lakhs. So that's why what I did, I incorporated one Section 8 company. And I asked that client to donate 1 crore to this Section 8 company. So Section 8 company, actually, I incorporated this company. So company will be under my control because 100% of capital, held by me and my family members. Now, what is the main objective of incorporating this company? Is it for good purpose or fraudulent purpose? Of fraudulent purpose. To avoid taxes, I incorporated Section 8 company. So that means fraudulent activities. So here the person engaged in that kind of fraud will get a punishment under Section 447. So key points: minimum paid up share capital not at all required. No need to use words limited, private, limited. Directors, they're exempted from exempted requirements for minimum directors, independent directors, and they should not have any, need not to possess these kind of committees. These are exempted from having these committees. And even a partnership firm can become member of Section 8 company. Actually, partnership firm has no separate legal entity. It cannot acquire shares. It cannot acquire properties in its own name, but it can become member of Section 8 company. And for normal companies, notice calling for general meeting is 21 days. Duration of notice is 21 days. But whereas for Section 8 companies, 14 days is sufficient. So that means today if I'm giving notice calling for meeting, I should wait for 21 days. After 21 days only I can conduct a meeting. But for Section 8 company, it's not 21 days, it's 14 days. So that means delay in making decisions can be reduced. For normal companies, 21 days we have to wait, whereas for Section 8 company, 14 days we have to wait. Understood? All these committees, are not applicable to Section 8 company. So with this Section 8 company completed, only Section 8 company you have to remember conditions for getting license and reasons for revocation of license. And what is the consequence after revocation? Either amalgamation with similar Section 8 company or winding up. Understood? Okay. So next concept is dormant company. Dormant company, other name for this company is inactive company. Inactive company. A company formed for a future project or holding assets like intellectual property rights with no significant accounting transaction, yes, it can become a dormant company. See, I want to file a tender with government for one project. So at that time, I should have a company. I don't know when government will call for tenders. So if government is calling for tenders, now at that time, incorporating a company, I should wait for ROC, certificate of incorporation. So instead of doing that, first I will incorporate a company. Whenever government calls for an order, I will file a tender in the name of company. Because government tenders, it is of limited period. Like, they will give some 1 week time period. Within 1 week, if I can't incorporate company, I am ineligible to file a tender with governments. That's why before only I will incorporate a company. So this is a company for future project. Or suppose I developed one medicine. Medicine means, medicine formula. So yet to start manufacturing. But before that, what I will do? I will register this medicine formula in my name. But individuals can be personalized. Personalization is possible with respect to individual, because with the name, suppose if you take my name Venkat, with the name Venkat, n number of people are there. But company is not like that. Company will always have a distinct name, unique name. So I will incorporate a company. For example, we Private Limited. So this company will hold intellectual property rights. Now this can't be forged, first of all, because company with We Private Limited, only one company will be there. Whereas individuals name can be, same name is available for multiple people. Identity can be changed with respect to natural persons. We had many movies where easily one can change his identity. Fake passport we can create, like that. Possibility is there. So that's why, instead of avoiding all these things, what I will do, I will incorporate a company to hold few assets like intellectual property rights. Medicine formula is nothing but intellectual property right. Or, I'm a company, incorporated in the year 2010. So I got a contract, that contract completed in the year 2020. So right now I'm not having any work, but in future I will get the work. I will get new work orders. So for the time being, since I'm not having any work, so I will observe whether last 2 years, whether any significant accounting transaction is there or not. If there is no significant accounting transaction in the last 2 years, so then I will apply for dormant status. So first of all, significant accounting transaction means what? Any transaction other than 4 transactions. Any transaction other than 4 transactions. One is payment of fees to ROC. Every year you need to file returns with ROC. At the time, you need to pay fees to the ROC. Now, payment of ROC fees is not a significant accounting transaction. Legal compliance payments. Legal compliance payments. Suppose, I was occupied in a, company is having a building. Company is the owner of the building. Every year, owners of the house properties have to pay property taxes, municipal taxes. So just payment of municipal taxes or property taxes will not constitute significant accounting transaction. Next one, if share allotment is happening, allotment of shares are happening, then also it is not a significant accounting transaction. Suppose maintenance payments, like, we are in rented premises. So every month we need to pay rents. Or we are having a bank account, every quarter banker is imposing bank charges. Now payment of this maintenance related payments will not constitute significant accounting transaction. Suppose we got an order with some L&T. Order value is 20 lakhs. Now this transaction becomes significant accounting transaction. Any transaction other than this 4 transaction becomes significant accounting transaction. If you had significant accounting transaction, you can't be treated as dormant company. Understood? Next one, you have to apply for getting dormant status with a registrar. So as I told you, last 2 years, no business or operations, no significant accounting transactions, and has not filed financial statements, annual returns for the last 2 financial years. Here ROC will give dormant status to you. Then you are prohibited from carrying business operations. So you have to file all the financial statements, annual returns every year, or else ROC will punish you by giving dormant status to you. First 2 you are doing, last one you are not doing. That's why you are getting dormant status. Next one, Nidhi company. See, dormant means inactive. Nidhi means it's like a banking company. It's not banker, but it's a banking company. Olden days, when Companies Act 1956 got enacted, olden days, I'm talking about olden days. Do you think banks are popular in rural areas? Actually, no. Because banks runs on a system. They need internet, they need proper infrastructure. Rural areas, that much infrastructure they will not have. So now in rural areas, banking system is very poor or absence of banking system is there. But majority of population is in rural areas only. So what happens, if we are not providing a facility to save their money, then what they will do, they will spend all their income on expenditures. That means income minus expenses, it will be 0. But suddenly in case of contingent cases like lockdown, so how they can manage their survival? So that's why they should maintain savings. Savings formula is, income minus expenses. So savings can be increased with the reduction of expenses. So first we should provide a facility to save their money. That facility, we can't ask banks, come on, go and open your branch in rural areas. No, for them, wherever business operations are going on, there they establish branches. If no business operation, they will not open branch office. So in rural areas, government came up with a concept called Nidhi company. In Nidhi companies, what happens, members, any person becoming member of Nidhi company, they will deposit their savings with a Nidhi company. Individually, it may be, for example, 500 rupees, 1000 rupees. But company as a whole, if it is receiving 1000 rupees from, for example, 100 members, 100 subscribers, it becomes 1 lakh. So with this 1 lakh, Nidhi company will give loans to existing members who need loan, or it will make deposit with mutual funds. So at the end, Nidhi company will get interest incomes. Certain portion of interest incomes they will spend on administration activities, and remaining portion they will give it to the members who deposited their savings. Understood? So Nidhi company is a company which accept deposits from members and which will grant loans to the members. A company notified by CG created to cultivate thrift and savings habit. Thrift, simply cost cutting. If cost is getting reduced, savings will increase among its members. Encourage savings and mutual benefits, providing loans to the members at reasonable rates. So simply, Nidhi company will carry banking activities in rural areas. Next one, public financial institution. The public financial institutions are government established organizations which are meant for development and growth in the economy. Development and growth in the economy. For example, if you take Axis Bank, for example, I need loan, sir, for my business operations. Axis Bank will think about the security which you provide. Sir, no security, sir. Then Axis Bank will tell no, we can't give you loan. Or sir, I need loan for 40 years, sir. I am going to set up a big factory, sir. So it will generate revenue after 40 years, sir. Now, Axis Bank may not show importance in these kind of projects because here revenue generation is taking more time. But these kind of organizations require finance assistance in long term. And public financial institutions will come forward to finance this kind of projects. If this project, if this project is getting started, what happens? Lot of public will get benefits. Like what? Local people will get employment. So unemployment will get reduced. Next thing, once they generate revenue, so they can make sales. On sales, we can collect GST. They can get profits. On profits, we will collect income tax. That means everyone will get benefit, but not right now. But not in short term. It may be in long term. So for long term, for the growth and development in the economy, public financial institutions will definitely participate. Now, if you look at the definition, public financial institution, it is not defining the word public financial institution. It is giving the list covered by public financial institution. So that list is LIC, Infrastructure Development Finance Company Limited, specified companies under Unit Trust of India, institutions notified under Section 4A, subsection 2. So these comes under public financial institution. And in future, yes, central government can notify few other establishments as public financial institutions. But before notifying them, government ensures that 51% of capital was held by government, either individually or jointly. So they must be established under some special acts, and they must be under the control of government. That means 51% of paid up capital must be held by CG or ESG. Understood? That means private institutions will not become public financial institutions. And there is a difference between private company and public company with respect to private sector undertaking, public sector undertaking. See, private sector undertaking means ownership is with the private individuals like Reliance Industries Limited. Who is having control? Normal person. Public sector undertaking means, for example, if you take IOC, BSNL, so here control is held by CG or ESG. So if government is having control over the company, it is a public sector undertaking. If control is held by private individuals, it becomes private sector undertaking. So all private sector undertakings are private companies. Wrong. Few public companies are also comes under a private sector undertaking. So how can we categorize private company, public company? Looking at AOA, we classify whether it is a private or public. How can we classify private sector undertaking, public sector undertaking? Looking at government control. Understood? Next one, promoter. Next one is promoter. So who is a promoter of the company? One who has been named as a promoter in prospectus or annual return. Company at the time of making public offer, it will issue prospectus. Every year it will file annual return. In these two documents, there is a column with respect to details of promoters. Whose names are written in that column, they become promoters. Second one, exercises direct or indirect control over company affairs as a shareholder, director or otherwise. So that means one who can control company either as a member or as a director or as a otherwise, then also he become a promoter. Suppose I had an idea to start one business. For that business I need 10 lakhs. Right now me and my partner both had only 5 lakhs. And one of my friend, he promised to contribute 5 lakhs, but not as a member, but as a creditor. I'll give you loan to start your business. But everything, whatever is happening in the company, first you communicate with me. First you ask me, I'll give you permission. Like that, my friend is telling. Actually, what is the role of my friend in my company? Creditor. But every time, when I'm making a decision, I'm consulting this fellow. Now, as a creditor also, he can become promoter of the company. Understood? So, controlling member or controlling director and any other person who controls the company affairs, he becomes a promoter. Now, tell me whether creditor can become promoter or not. He can become promoter if he controls the company affairs. Next one, provides advices, directions, instructions that board of directors usually follows. Suppose you incorporated a company, for example, C Private Limited, in which you and your friend both are directors of the company. And every time you are taking my opinion, how to do business, how to start a business, every time, I'm giving series of instructions, series of advices to you, and you are acting according to my advices, according to my interests. Then even though I'm not a director, I will become even though I'm not a promoter, even though I'm not a director, even though I'm not a shareholder, by default I become promoter of the company. The reason is, actually companies day-to-day affairs are controlled by directors, but already I'm controlling these directors. So I'll be treated as a shadow director. I'm not a real director. Shadow director. Shadow director is also a promoter. Understood? But suppose I'm a CA holding certificate of practice, and you are taking my decision with respect to how to conduct AGM, how to prepare financial statements, how to file financial statements with ROC. Now I'm giving these advices. You are following my advices accordingly. Now, is Mr. V treated as a promoter of the company? Answer is no. Why? Because he is rendering services in professional capacity. So as long as professional is rendering professional services, he will not be treated as promoter. But if he is providing any service beyond professional capacity, he will also be considered as promoter. Next one, incorporation of company, section 7. So for incorporation of company, so is incorporation mandatory for company? Is incorporation mandatory for company? Yes. Definition, section 2 clause 20 is telling company means company incorporated under Companies Act 2013. That means incorporation is compulsory to form a company. So for incorporation, one has to file a series of documents with ROC. What are those documents? MOA, AOA, declaration by professionals, declaration by directors stating that company requirements, company incorporation requirements have been fulfilled. For example, for private company, how many members required? Minimum 2. For public company, minimum how many members are required? 7. So this requirement we have complied. So we complied all the requirements with respect to incorporation of company. Like that, we have to file a declaration. And subscribers first director shall also file a declaration stating that last 5 years we have not committed any offense in the company type of organization. Last 5 years we didn't incorporated company by furnishing false information. That means if you are convicted by an offense in any company, 5 years ban period is there. So last 5 years I didn't commit any mistake, either in the promotion of the company, in the formation of the company, or as a director of the company, I didn't commit any mistake. Second one, proposed company incorporation, we are filing these documents, right? All these documents are correct, complete, true. Next one, address for correspondence until registered office is established. You are filing these documents with ROC. ROC requires another document. ROC need one more document, one more clarification ROC need. Then ROC will send a letter to you. To which address? So to the address for temporary correspondence. That means, along with these documents, you have to mention address for temporary correspondence. Once company came into picture, it will have a registered office address. ROC will send letters to the registered office. Next one, who are the subscribers of the company and what are the details of the subscribers, like name, address, nationality proof, identity, everything. Next one, interest and consent of first directors in the prescribed form. If director is having interest in another company, that means you want to appoint Mr. D as director of this private limited company, and he is already a director in another company, for example ABC Private Limited. Now this director, he should give written consent. Okay, I had no problem to act as director to this company, and I'm also holding directorship in these companies. Like that, he need to provide a list. Understood? So very simple to remember the documents. Constitutional documents, MOA, AOA. Very easy. MOA, AOA. In MOA, AOA, you will find who are the subscribers, right? Subscribers details also you furnish. Next one, upon incorporation, company should have a directors. So directors details also you furnish. Along with the details, you need to furnish written consent plus interest in other body corporates. Now whether your incorporation is as per Companies Act or not. So for that, submit one declaration. Are you genuine persons or fraudulent persons? Genuine persons are. For that also furnish one declaration. Last 5 years we didn't commit any mistake with respect to any company. Now, if I want to send certificate of incorporation to you, to which address I should send certificate of incorporation? So address details. So these documents you prepare and file it with ROC. ROC will issue certificate of incorporation. In that you will find identification number, unique identification numbers. We call it as SIN. Like natural persons, we are having, Aadhaar number. For companies, they will have a SIN, maintenance of records. All these records which you prepared and filed with ROC for incorporation, these documents shall be preserved at registered office until company liquidation. That means till the death of the company. What is the period of maintenance of these records? Till the death of the company. And where to preserve these documents? Registered office. And if you furnish any false information in these documents, then you'll get punishment under section 447. Suppose you and your friend incorporated a company. Actually, your friend is 16 years old person, minor. A minor cannot incorporate a company. But what you did, you forged Aadhaar card of your friend. So you modified year of birth you modified. That means you submitted fraudulent documents, false particulars. So punishment will be 447. And if incorporation was based on fraud, promoters, first directors, declarants will be liable for action under section 447. And for company, the punishment would be any of these 5 things. So chance is there. 5 marks theory question, they can ask you. Suppose if any company was incorporated by furnishing false information, discuss the powers of NCLT. If any company was incorporated by furnishing false information. So they can ask this question for 5 marks. In that case, you need to write these 5 points. What are those 5 points? Change in company management, or lifting corporate will, making members liability limited to unlimited, removal of name from the register maintained by ROC, winding up of the company, or pass such other orders, necessary orders. Removal of name means we directly remove your name from register. In case of winding up, what happens? Company comes into the existence. First, company will come into the existence. Later, company will be dissolved. That means birth as well as death you will observe in case of liquidation. Whereas removal, we assume that company never came into the existence. Removal is different, winding up is different. So which one will apply when? If you are not carrying any business operations, just for fraudulent purpose, you incorporate a company. No business operation you carried out, then we will remove the name. No, you took advances from creditors. You took materials from creditors on credit basis, and you took advances from customers. Now what we will do, by considering all the existing transactions, existing liabilities, I will pass an order for winding up. That means, I will try to collect amount from members, and I will try to distribute that amount among the customers as well as the creditors. So before passing any order, company must be given a reasonable opportunity of being heard. So opportunity of being heard means just one clarification, like, is there anything else to tell? If company is silent, then NCLT will pass any of these 5 orders. So if a question is asked like this, writing alone these 5 points is not sufficient. You have to write these preconditions also. Okay. So for incorporation of company, we had one facility called SPICE. It's a simplified proforma for incorporating company electronically. An initiative by MCA to ease the incorporation process. So actually, to become directors of the company, they should have a DIN. And next one, to have a name of the company, first we need to reserve a name. For that we need to file an application separately. And next one, for incorporation, separate document is there. After incorporation, for having registered office, separate application is there. That means, incorporation is happening by filing a series of documents at different point of times, like filing an application for getting DIN once, filing an application for reserving the name, filing an application for incorporation of company, filing an application for appointment of directors, filing an application for establishing registered office. So instead of filing 5 different forms at different point of time, let us file all these forms in a single form. So this information will provide in a single form. That form is nothing but a SPICE. The name itself is telling simplified proforma for incorporating company electronically. It simplifies filing forms for setting up a business electronically. So once incorporation is completed, then next effect of registration. Simply, if you remember characteristics of the company, just write characteristics of the company. That's it. Because company, separate legal entity status, perpetual succession, everything it comes only upon incorporation. So if you write characteristics for section 9, it is sufficient. Let us look into the let us look into the effect of registration. From incorporation date, company become a body corporate. And what is the name of that company? The name mentioned in the MOA. and it will get capabilities that include exercising functions of an incorporated company. It can acquire properties on its own name. It can hold properties in its own name. It can sell those properties in its own name. It can enter into contracts, same like natural persons. And company is a legal person separate from its incorporators. That means promoters, subscribers, and members. Next, it is having a perpetual succession. That means it is in continued existence until legally dissolved. And shareholders do not own company property but have interest in the shares. As I told you, members are owners of the company. Company is owner of company property, but members doesn't mean they are owners of company property. And few case references are there. Just one time give a brief reading of these references, because chance of getting practical question on these references is very, very high. So date of incorporation is very important. From this date onwards, any contract entered by company is liable, but not members, but not promoters, but not directors. And what is the date of incorporation? The date mentioned in certificate of incorporation is the date of incorporation. And if you look into the points, these points are similar to characteristics. So you can write these points in characteristics, or you can write characteristics under this point. Both are same only. Next one, effect of MOA, AOA. Actually, a contract document is required between two parties of the contract. When two parties are entering into a contract, definitely contract document is compulsory. Suppose I want to sell my bike to you. I want to sell my mobile to you. So we will execute it in an agreement. That agreement will decide the rights and obligations of the parties. Similarly, here we had two documents, MOA, AOA. And this MOA, AOA are contractual documents between company and members. So once registered, MOA, AOA binds company and its members as if signed by both the parties. As if signed by both the parties means, here we are making an assumption. Why we are making an assumption, I will tell you. Just wait. See, because of this contract, company is having one obligation. The obligation is to carry business operations as specified in MOA. Only for the business operations, company can utilize funds contributed by members. So company is having an obligation to carry business operations according to MOA, and members are also having an obligation. What is obligation? Whenever company is making calls on share, member is liable to deposit that call amount. So both the parties are having obligation, both the parties are having rights. Clear? So now what happens is, suppose if member fails to deposit call amount, then what company can do? Company can forfeit shares. Company can forfeit shares because company is a aggrieved party. Member is a defaulting person. Aggrieved party can take action against a defaulting person. So accordingly, company can forfeit shares of a member. So this is what happens because of MOA and AOA. Now what happens, suppose if you take Infosys, it was incorporated in the year 1980s. So if you look at Infosys company, it was incorporated in the year 1981, simply 1980s. Now actually, I was not in existence when Infosys was incorporated. Later, in the year 2025, suppose when Infosys came for a public offer, I subscribed few shares and these shares are partly paid up. So company made calls on shares and I failed to pay a call amount. Now company came to me and company told that I'm going to forfeit the shares. Then what I will tell, I didn't sign your MOA. Your MOA is signed by the promoters at the time of incorporation. I didn't sign your MOA. So how can you implement MOA, AOA provisions against me? Since I didn't sign MOA, AOA, so MOA, AOA will not create any obligation on me in favor of you. So therefore, you can't forfeit my shares. Like that, member can make a stupid argument. So that's why lawmaker came with a section 10. As per section 10, whether you signed MOA or not, once you become member of company, we assume that you signed MOA, AOA. Accordingly, you are liable for the provisions of MOA, AOA. Similarly, company is also liable for the provisions of MOA, AOA. So that means company is responsible to members. Members are responsible to company. How company is responsible to members? Company will carry business operations as per MOA. How members are responsible to company? Whenever company is making calls on shares, members will deposit call amount. Understood? Create an agreement to observe all the provisions of these documents. Money is owned by members. These documents constitute a debt to the company. Now they may ask you a question. Whether MOA creates contract between company and outsiders? Answer is wrong. MOA is a contractual document between company and members. That's it. So company can take action against members, members can take action against company because of MOA, but company can't take action against outsiders, or outsiders can't take action against company because of MOA. Understood? Very simple example. Suppose, in my company, suppose I'm incorporating a company like C Section 8 company. In my company AOA, I'm writing a point that Chief Minister of the state should donate 5 lakhs every month to this company. So writing this point, going to Chief Minister and asking 5 lakhs per month. Do you think Chief Minister of the state liable to contribute 5 lakhs per month to my Section 8 company? So that's why AOA MOA binds company to our members. AOA MOA binds members to the company, but not outsiders. Next one, different types of capital. We are having 5 types of capital. Registered capital, which you will find in MOA. Based on registered capital only, company has to pay stamp duty. And this is the maximum capital that company can offer. And the portion of registered capital offered to the subscribers, offered to the members, we call it as issued capital. And the portion of issued capital subscribed by the subscribers, we call it as subscribed capital. And portion of subscribed capital which was called by the company so far, we call it as called up. Called up minus calls in arrears, it becomes paid up. Understood? But this point is very important to remember. The point is, if the authorized capital is mentioned in official documents, communications, the subscribed and paid up capital must also be disclosed. Failure to do so results to penalty of Section 60. Penalties mentioned in Section 60 for company 10,000, for officer 5,000. Logic is very simple. Suppose you incorporated a company like this, C Global Limited, and you fixed authorized share capital as 100 crores. But actually your paid up share capital is 1 lakh. If you are not disclosing paid up share capital, if you are just mentioning name of the company and if you are mentioning authorized share capital, what public will think? Oh my god, this is a global company and the capital of the company is 100 crores. Like that, they think they will make a wrong interpretation and they will give lump sum loans to you. So finally, these parties will be at risk. That's why on official publications, if you are mentioning authorized capital, very important, if you are mentioning authorized capital, along with authorized capital, also mention subscribed capital and paid up capital, so that they can know the real sense, they can know the real thing about the company. Understood? So once again, I'm telling you, if you mention authorized capital, then mention paid up share capital as well as subscribed share capital. If you are not mentioning authorized share capital, then no need to mention subscribed, no need to mention paid up. Failure to mention subscribed capital, paid up share capital attracts punishment. For company 10,000, officer 5,000. Can be tested for 2 marks. In MOA you will find registered capital, and in balance sheet you will find paid up capital. Okay. Next one, kinds of share capital. See, first of all, nature of shares. If you look at nature of shares, they are like goods. That means they are like movable property. They're like movable properties. A share refers to a part of capital of the company representing an interest measured by the amount paid up on it. A share represents shareholders' interest in the company assets. It is not merely a sum of money, but a collection of rights as per the contract. That means, today if you are holding share, you won't get share in the company assets until company gets liquidated. But you will get some bundle of rights. What are those rights? Every year, whenever company is distributing dividends, you will get share in the profits. Every year when company is calling for general meeting, you will get a right to attend general meeting. And in the general meeting, you will get a right to vote. So these rights you are getting because of holding shares. That means what are the benefits we are getting by subscribing shares? These are the benefits. Shareholder hold contractual rights, statutory rights under Companies Act, not ownership of the company assets. Correct. So shareholder is the owner of the company. He is not owner of the company properties. And shares are considered as movable properties and they are transferable as per company articles. Next one, section 45 states that every share must be distinctively numbered except for shares in a depository. Distinctive numbering means, two shares should not have same number. Suppose if you take money as an example, 500 rupee money, 500 rupee note, if you take, two 500 rupee note will not have same specimen number. They will have a numbers, distinctive numbers. So why they maintain that numbers? So simply to have a control, to have a record. So here also, if two or more shares have same number, what happens? It leads to duplication. So to have a control, how many shares we issued so far and what are the shares held by the people. So it should be numbered, and that number should also be like distinctively numbered. It should not have unique numbers. It should not have same numbers. It should be distinctive numbered. Next one, kinds of share capital. Just 1 second. Suppose if you look at this share certificate, these people are holding 5 shares, and they were distinctively numbered. Like, the 5 shares count is like this: 40 crore 57 lakh 80,352, 40 crore 57 lakh 80,354. So 5 shares they are holding, shares are distinctively numbered. And in private company, I forgot to tell you, joint shareholders are counted as one. While counting 200, present employees, past employees are excluded. In addition to that, joint shareholders means, if you look at this share certificate, more than one person, that means, two or more persons holding a share certificate jointly. So in case of private company, they are not counted as 3, they are counted as 1. So this is an example for a joint shareholding, and this is also an example for distinctive numbering of shares. Next one. So we had two kinds of capital. Types of capital is different, kinds of capital is different. If they ask you types means authorized, issued, subscribed, called up, paid up. Kinds of capital means only two kinds we are having: preference, equity. So what is an equity share capital? Any share capital which is not preference share capital, it is equity share capital. Capital which is not preference, it is equity. Then what is preference share capital? Preference share capital will have two preferential rights. Priorities, simply priorities. One is with respect to dividend, other one is with respect to capital redemption. So every year at the time of payment of dividends, first priority is given to the preference shareholders, last priority is given to the equity shareholders. During liquidation, capital redemption, first priority is given to the preference shareholders, last priority is given to the equity shareholders. So any capital which carry these two preferential rights, it becomes preference share capital. Share capital without any priorities, simply share capital other than preference share capital, it is equity share capital. Understood? So equity share capital, non-preference share capital, preference share capital which carries preferential rights over dividends as well as repayment of capital. And this section 43 is not applicable to private companies if MOA, AOA provides otherwise. Not that much relevant, simply private companies, I told you, they had few exemptions. Then no need to comply all the sections, few exemptions are there. So if MOA, AOA provides other things, then no need to follow 43. If MOA, AOA is silent, then section 43 is applicable. Next one, MOA under Companies Act 2013. So first of all, as a natural person, what can I do? What I can't do? Everything is there in Indian Constitution. Constitution of India is deciding my fundamental rights, fundamental duties. But for companies like artificial persons, what is the constitutional document? The answer is MOA. So this is a document for the association which will be used in future. Today, for example, today, 1st January 2025, I'm preparing MOA. Why? To incorporate company. Assume that company is coming on 10th January 2025. Now I'm preparing this document for future reference, yes or no? And why I'm preparing this document? To guide this association. So memorandum, that means it's a document for future reference which governs the association. It's a memorandum of association. So it is a constitutional document and it lays down the things, what a company can do. What to do, what not to do is specified in MOA. What to do, activities specified in MOA you can do. What not to do, activities which are not specified in MOA you can't do. Object of registering MOA. So, MOA defines the scope of the activities, ensures shareholders, creditors about the company powers. Suppose if you look at the natural person, whether natural person is competent to contract or not, we check 3 parameters. If he is a minor, disqualified. If he is unsound mind, disqualified. If the person is disqualified under any other law, for example, becoming insolvent or becoming alien enemy, then that person is ineligible to enter into a contract. Similarly, how can we check eligibility of a company? The answer is MOA. So objects specified in MOA, for the objects, company is competent to enter into a contract. For the objects not specified in MOA, company is incompetent to enter into the contract. And MOA acts as a public document. It provides knowledge to the third parties about company limitations and powers. Suppose if you take Infosys company, in MOA of Infosys company, it talks about IT, about information technology. Now Infosys is competent to enter into only IT related contracts. Suppose Infosys, can it enter into a contract with Kingfisher for supply of 1000 bottles of alcohol? No. Can Infosys enter into a contract to deal with real estate transactions? No. That means all these are company limitations. Can Infosys enter into a supermart business like D-Mart, Reliance Mart? No, because it talks about only IT related activities. So IT related activities, company powers. Other than IT related activities, company limitations. Legal effect of MOA. Company cannot engage in activities beyond those specified in MOA. So what are the things specified in MOA? Engage in those activities. If you are going into the activity which is not there in MOA, we call it as ultra virus. That means beyond the powers of a company. Ultra virus act's effect is void. And looking at form of memorandums, or in which format we need to maintain MOA. The format is prescribed in table A, B, C, D, E. So how to remember these tables? A, B, C, D, E. So here first company limited by shares. For company limited by shares, table A. Mostly this one only they will ask. Remaining company limited by guarantee without share capital. C, limited by guarantee with share capital. D, unlimited company. D, E talks about unlimited company. B, C talks about limited by guarantee. One is without share capital, other one is with share capital. So total 5 companies are there. For 5 companies, 5 forms of MOE is there. Okay. So table A is for limited by shares. Table B is for limited by guarantee without share capital. Very simple to remember the hierarchy. First one is limited by shares. Next one is guarantee without share capital. Third one is guarantee with share capital. Fourth one is unlimited company without shares capital. Last one is unlimited company with share capital. These many companies we have had. These categories we are having. Now just name like this: A, B, C, D, E. So these are the applicable forms of MOA. Understood? So for limited by shares, which form is applicable? Table A. So in MOA, you will find 6 clauses. Simply NOCLES, no class. N stands for name clause. In name clause, you will find name of the company. Name of the company always ends with either private limited for private companies or limited for public companies. But important, for government company, the name always ends with limited. Whether it is a private company or public company, name always ends with limited. For OPC, in brackets, you need to mention OPC. And for Section 8 company, this requirement is not applicable. Registered office means it's not address of the registered office clause. Here you will not find address of the company. Here you will find the name of the state where company was located. You will find only name of the state. Other than name of the state, nothing you will find. So complete address you will be find, you will find in separate documents, INC 22. So, they will ask you a question like this. ROC rejected an application for incorporation on the ground that MOA situation clause doesn't contain complete address of the company. Do you agree with ROC? Answer is no. Why? Situation clause or registered office clause will contain only name of the state. So 2 marks question possible. Object clause. Here you will find what a company can do. Specifies the objects for which company is incorporated. If company changes its activities, the name must also be adopted accordingly. Suppose Infosys. The full form of Infosys is information systems. Information shortcut info, systems sys. If they want to change activities, they will also change the name accordingly. Next one, liability clause. So liability clause talks about liability of company or liability of members. Liability of members, whether it is limited or unlimited. Limited by share capital, limited by unpaid value or limited by guarantee. So everything is taken care by liability clause. Capital clause, here you will find authorized share capital. And this capital should be divided into number of shares and face value of each share. Understood? So just having capital amount alone is not sufficient. How many number of shares there and what is the face value? Everything should be there. In capital clause, 3 components are compulsory. Authorized share capital divided into number of shares and face value. Next one, subscribers and association clause. So here you will find the subscribers who subscribed MOA. who subscribed MOA, you will find a name of details of the subscriber. Coming to OPC, another clause is that is nomination clause. So who can become member upon the death of the member or upon the incapacity of the member, who can become member of the company, you will find nomination clause also. Next one, formal requirements, MOA shall be printed. It should be in documentary form. It should be printed, divided into paragraphs. Yes, name paragraph, object paragraph, like that. Capital, object, next one, liability, divided into paragraphs. And it should be signed by at least 7 members in case of public company, whereas for private company 2, and for 1-person company 1. So that means minimum number of members required for formation of the company. Next one, a company may subscribe through its agent, but a minor cannot be a signatory. Suppose if you take a holding company and subsidiary company, who is the member of subsidiary company? Holding company. So how holding company is going to sign MOA of S Limited? Suppose the MOA of S Limited should be signed by H Limited. In that case, H Limited will appoint a agent who can sign on behalf of H Limited. Next one, MOA must include compulsory clauses as mentioned above. Optional clauses may include provisions or rights attached to the different classes of the shares. Mandatory means this NOCLAS, that means name, object, all these are mandatory. Sir, I will include only 4, sir. I will exclude 2, sir. Not possible. All clauses compulsory. Next one, MOA shall always comply with Companies Act. Best example, only one example I'll tell you. 1-person company. Can 1-person company carry Section 8 activities? Yes or no? No. Can a 1-person company carry NBFC activities? Can a 1-person companies carry investment activities? No. So OPC MOA shall be designed accordingly. Suppose in case of OPC MOA, if you add these 3 things, so these 3 things will not apply to you. You have to follow Companies Act. That means in case of any contrary, apply Companies Act. Understood? Don't apply your MOA. Next one, doctrine of ultra virus, doctrine of constructive notice, doctrine of indoor management. So here first I will narrate you the story. Ultra virus. We had one case study called Ashbury Railway Carriage versus Ritchie. Ashbury Railway Carriage Company versus Ritchie. One day Ritchie got a contract to levy railway track between 2 locations, from location A to location B. So Ritchie, for carrying these operations, Ritchie requested government for some advance. Government told, we can't give you advance right now. So you can go to a company, Ashbury Railway Company, and you can request for a loan like that. Government gave advice. Ritchie went to Ashbury Railway Company and entered into a contract for finance. Contract for finance. Ashbury Railway Company Managing Director, without knowledge of MOA, he signed a finance contract agreement with, finance contract with Ritchie. Later it came to know that, Ashbury Railway Company is not having power to enter into finance contracts. So this is completely ultra virus acts. So what is the effect of ultra virus acts was prescribed under doctrine of ultra virus. So first of all, under ultra virus acts, it is very important that contract is void. Contract becomes, actually it's not a contract, because agreement only. An agreement which is legally enforceable becomes a contract. So here I will use the word called arrangement. Ultra virus arrangement is void ab initio. That means void from beginning. This can't be ratified. Cannot be ratified by the whole body of members. Even whole body of members, if they want to ratify ultra virus acts can't be ratified. Ratification means what? Giving approval for the past acts which were done without authority. Suppose without authority, company made a finance arrangement with Ritchie. Now can it be ratified subsequently? Answer is no. Ratification is applicable only for lawful acts. Ratification is not applicable for void ab initio acts. Understood? Next point, neither company nor outsiders bound by ultra virus acts. Once it becomes void, that means it is not enforceable. Company is not answerable to outsiders. Outsiders cannot take any action against company. And member can bring injunction order. Injunction order means stop order. So any member can bring injunction order against company from entering into ultra virus acts. And from ultra virus acts, if there is any loss to the company, board of directors should personally compensate company. So board of directors are personally liable to the outsiders. The rule is very simple. As long as agent acts within the authority of principal, principal is liable to third party. If agent exceeds authority, his authority as well as principal authority, then principal is not responsible, agent's authority. Agent is liable to third party. That's it. Ultra virus means beyond the powers. In this entire, summary points is very important. Act beyond powers defined in MOA, it becomes ultra virus, it is void. It cannot be ratified even by unanimous. That means even 100% of members give approval, can't be ratified. Acts beyond the powers of directors but within the company scope can be ratified by the shareholders. For example, board of directors can take loan up to 50 crores. Loan exceeding 50 crores can be taken only with the prior approval of members. Now, taking loan is a legal object only, lawful object only. Suppose directors borrowed 60 crores loan amount. Now, this is an act done by the directors which is within the company scope but beyond their scope. Company can take 60 crores loan, no problem. But for taking 60 crores loan, members approval is required. Without members approval, if they go for a loan, subsequently they can request members to ratify it. So that means, ultra virus as to MOA, simply ultra virus as to MOA can't be ratified. Ultra virus as to AOA can be ratified. You remember the point. AOA defines these powers of the directors. Understood? So something ultra virus to AOA, but it is intra virus to MOA can be ratified. But if it is ultra virus as to MOA, cannot be ratified. Next one, acts beyond the articles can be corrected by altering the articles. Advantages of ultra virus, shareholder money is protected. Shareholder money is utilized only for the object specified in MOA. That's it. Next one, disadvantages of doctrine of ultra virus. The doctrine can limit flexibility for the company to evolve its activities in alignment with shareholders' wishes. However, issue has been mitigated since object clause can easily be amended by a special resolution. Ultra virus is having advantage like shareholder funds is protected. But now you can easily, by passing special resolution, you can easily alter object clause. That means you can easily deviate ultra virus act. How? Before entering into finance contract, first amend MOA. If you amend MOA, if you include finance contract in your powers, then you can easily enter into finance contracts. Next one, AOA. See, the role of AOA is simply to manage internal affairs. Since company is a artificial legal person, it can't do acts on its own. It requires human agency. Now, what is the role of human agency in the company? Simply, what is powers of human agency? What is duties of human agency? Everything is specified in AOA. MOA defines company powers, whereas AOA defines powers of internal management. Suppose for making calls on shares, next for issuing bonus shares, for making buyback of shares. Company can do these things only if company, if board of directors are authorized by AOA. That's it. So MOA external purpose, AOA internal purpose. Entrenchment, one point is there. Entrenchment. AOA may contain entrenchment provisions to protect specific provisions requiring more restrictive conditions for amendment. Suppose I want to be managing director of the company. My company, C Private Limited, I want to be managing director of this company. So in AOA, I wrote a point that, Mr. V will be the managing director of the company. Right now, 100% of capital was held by me and my family members. So there is no problem to me. But I had a problem. Tomorrow, if I go with public offers, imagine 75% of the voting power lies with public. And I'm having only 25% of voting power. Now outsiders, by passing special resolution, they can easily alter AOA. They can remove this clause and they can remove me from the position of managing director. So my interest is getting affected. So that's why what I will do, at the time of either at the time of incorporation of company or subsequent to incorporation, I will mention entrenchment provision like this. How I will mention entrenchment provision? Particularly, suppose, this clause number is 42, for example. For alteration of clause 42, special resolution alone is not sufficient. 95% voting power is required. 95% voting power. If it is in favor of alteration of this clause, then only we can alter this clause. Actually, special resolution means, votes in favor greater than or equal to 3 times of votes against. That means 75% votes in favor, 25% votes against. Yes, special resolution is said to be passed. Getting my point? Now, when I mentioned that 95% is required for changing this clause in AOA, definitely my interest is getting protected. That means minority interest is getting protected. So to protect minority interest, company can have entrenchment provisions in AOA. So what is the general rule for altering AOA? For altering AOA, general rule, special resolution is required. But any clause, if you want to alter by unanimous resolution or 90% consent, then we call it as entrenchment provision. The objective of entrenchment provision is making simple thing a very complicated. Simple thing, if you are converting into complicated thing, it is nothing but entrenchment. And I told you A, B, C, D, E is forms of MOA for companies, 5 companies. Table F, G, H, I, J are forms for AOA. A, B, C, D, E, MOA forms. F, G, H, I, J forms of AOA. Next one. Key differences between MOA and AOA can be asked. So this point can be tested for 4 marks. So differences between MOA and AOA. MOA defines company powers, whereas AOA defines internal management rules. MOA governs relationship with the outside world. That means, whether company is competent to enter into contract or not. Which one will decide? MOA. Whereas AOA governs internal relationship between company and its members. Alteration of MOA can only be, MOA can be altered under specific conditions, while AOA can be altered by passing special resolution. Next one, ultra virus. Ultra virus to MOA void, whereas ultra virus as to AOA valid if it is ratified by the members. So remember these 4 points. Next one, doctrine of indoor management. So name itself is telling indoor. That means inside company. What is happening inside company? Don't make any inquiry. Just make an assumption. Just make an assumption. Suppose company want to take a loan of 10 lakhs. For taking 10 lakhs loan, ordinary resolution, members approval is required. For example, members approval is required for taking loan of 10 lakhs. Now you are giving loan to the company, for example. Whether company passed resolution or not, it's an internal matter. Internal matters don't inquire, make an assumption. Yes, company might have passed ordinary resolution. Suppose ordinary resolution not passed. So do you think company can escape from the loan of 10 lakhs to you? No, company is still liable to you for 10 lakh rupees. See, constructive notice, indoor management. I will tell you the connection between these two things, so you will understand. Constructive notice, notice is of 2 types now. Actual notice, demood notice. Other name for demood notice is constructive. Suppose ICA is calling everyone personally and telling that, from January 12th onwards, your CA foundation exams will start. It is actual notice. But ICA is not calling students. ICA is updating schedule in the website. And ICA will assume that every student who is writing CA foundation exam have gone through the website of the company and have gone through the schedule. Now, no one can complain against ICA. They didn't give notice to me, so I will not write examination. Ask them to give qualification certificate. Not possible. Or ask them to cancel the examination. Not possible. So when we update a schedule in the website, we assume that every student has gone through the website. That is nothing but constructive notice. If you are not going to those documents, it's your fault. So company is protected, you are not protected. Similarly, indoor management. With respect to internal matters, don't make inquiry. Like, in case of constructive notice, make inquiry of MOA, AOA. Study MOA, study AOA, whether company is capable or not. But internal matters, make an assumption. Don't inquire. Make an assumption. Accordingly, company is not protected. Outsiders are protected. One case study is there. Royal British Bank versus Turken. So here what happened, 3 years back, Turken gave a loan of, for example, 10 lakhs to Royal British Bank. Later, management of this company has been changed. New management, when Turken approached new management for repayment of loan, sir, I gave you loan of 10 lakhs 3 years back. Now you have to make payment. New management told, we are not liable to you. Why? Old management took loan from you without passing members approval. Without taking members approval, old management took loan. So this loan is invalid. We are not liable to you. If this prevails, what happens, outsiders will be at risk. Even a member can't participate in day-to-day affairs of the company. Who will participate in day-to-day affairs? Board of directors. And who am I? I'm outsider. How outsider is allowed to participate in day-to-day affairs of the company? That's why lawmaker, or simply court judge, he made a statement that outsiders with respect to internal matters, they can make an assumption. They can make an assumption that all internal matters have been complied as per the provisions of Companies Act, AOA, MOA. That's it. So accordingly, bank is held liable to the Turken. So who is protected under indoor management? Outsider. Who is not protected? Company. Constructive notice, it is reverse. In case of constructive notice, company is protected, outsider is not protected. But this indoor management, we had 3 exceptions. That means, under these exceptions, you cannot take benefit of indoor management. One thing, just tell me, doctrine of indoor management, who will be protected? Outsiders. Outsiders. But they will not get protection under these 3 exceptions. So what are those 3 exceptions? First one is knowledge of irregularity. Suppose Turkend is not an outsider. Imagine Turkend is one of the director in the company. He is a director in the company. Now as a director of company, whether ordinary resolution is passed or not, it is easy to know. So without verifying your internal documents, if you give loan and if you think that, sir, I don't know, sir, whether resolution passed or not, it's purely negligence. So if you are having a internal irregularities knowledge, then you can't claim protection under indoor management. And suppose if you had a doubt, then also you can't claim indoor management protection. Suppose company received a check of 10 lakh rupees. Director went to bank and director is telling to the bank, sir, company gave me power to collect amount on behalf of company. That means don't credit this amount to company account. You just deposit that amount in my account. So when director is making statement like this, immediately banker should ask for, sir, show me your power of authority, power of attorney document. So you are telling that company gave authority to you to collect amount for yourself. So show me that letter. If you show that letter, I will give it, or else I will deposit that amount in company account. That means if you had a doubt, you should not proceed with the director. Suppose, in good faith, out of negligence, okay, sir, take money. Like that, if banker is giving money to the director, subsequently, bank will be held liable to the company. So banker can't claim protection under indoor management. Last one is forgery. Forgery means nullity. In case of forgery, what happens? In case of forgery, first of all, contract is not in existence. If contract is not in existence, how outsider will be protected? That's it. So in case of forgery also, indoor management will not apply. So this is all about Companies Act. So let's continue our marathon with the next chapter, Limited Liability Partnership Act 2008, which is having an expected weightage of 5 to 10 marks in your examination. Before I start revision of LLP, let me tell you the differences between partnership, LLP and company. See, for an association which intends to carry business operations, will have 2 options. First one is partnership type of organization. Second one is company type of organization. See, both the options have its own advantages and own disadvantages. Suppose if you look at advantages of partnership firm, easy to form and easy to close. Whereas company, by complying the requirements of section 7. So yes, company has to be incorporated. Here incorporation is mandatory, and that incorporation is as per the provisions of Companies Act 2013. So it is not that much easy to form compared to partnership firm. And with respect to regulation also, partnership firm, initially it is governed by partnership deed. The provisions that are there in partnership deed will apply to the partnership firm. But coming to company type of organization, so company type of organization, from management of the company, it has to comply with the provisions of Companies Act 2013. It has to comply with the provisions of MOA, AOA. That means with respect to formation, with respect to management, you will find more compliance in company and very less compliance coming to the partnership. But if you look at the disadvantages with respect to partnership firm, liability is the biggest disadvantage. Liability of a partners in the partnership firm is the biggest disadvantage. Sir, how? Here the nature of partners liability is unlimited. That means in case of closure of partnership firm, if assets are less than liabilities, that means if business assets, partnership assets are not in a position to meet partnership liabilities, then partners' personal assets are held liable. Partners' personal assets are held liable towards the deficit arising out of closure of the partnership firm. So that's what unlimited liability. And here the nature of a partner's liability is joint and several. That means each and every partner is not only liable to his share of losses, he is also liable for other partners' share of losses if other partners, if they are abscond or if they are become insolvent. So these are the two biggest disadvantages coming to the partnership firm, and these two are advantages coming to the company. How? In company, members' nature of liability is limited, and their liability is limited to the extent of unpaid value multiplied by number of shares held by them. That means each and every member is liable only with respect to his share, not with respect to other members' share. So both had its own advantages as well as disadvantages. Biggest advantage in partnership is formation and regulation. Biggest advantage in company is limited liability. Now, ignoring disadvantages of both the entities, considering only advantages of both the entities, yes, here comes a new concept called limited liability partnership firm. So here, the management is very, very flexible, and compliance is very literally low compared to company. Of course, here compliance is there. Compliance with respect to partnership firm, when you compare compliance of LLPs with respect to partnership is high, but it is very, very less compared to company type of organization. You may get a doubt, sir, why can't we do business under partnership? Why we need only LLP? So can't we continue business organizations in partnership type of model, sir? Why should we come under LLP? The reason is partnership firms registration is not mandatory. It's not compulsory. Whereas LLP is mandatory. Registration is mandatory. Therefore, transparency is possible in case of LLP, whereas the transparency is lacking in case of partnership. Best example, government can easily monitor LLP, the activities of LLP, the net worth of the LLP, turnover of the LLP, and the activities performed by the LLP. Whereas government cannot monitor partnership firms as registration is not mandatory, it's just optional. So government point of view, LLPs are more accountable, partnerships are not accountable. That's why government decided to give more freedom to the LLP by making a liability of the partners limited. Understood? So let's look into the chapter. So here I prepared a summary notes of LLP. Let's look into the notes. See, the bill LLP bill was passed by the parliament on 12th December 2008, and it was approved, it was assented by president on 7th January 2009. Finally, it was notified on 9th January 2009. And the name of this act is LLP, Limited Liability Partnership Act 2008. The main purpose of this act is to provide provisions for incorporation of LLP, regulation of LLP, and governance of LLP. That means not only at the time of incorporation LLP Act will apply, it is also applicable during the continuance of LLP. How LLPs are governed, how LLPs are regulated, everything LLP Act is providing provisions. Next, in our LLP Act, there are total 80 sections. After omission of section 81, yes, finally we are having 80 sections. And in LLP, we are having 4 schedules. First schedule determines rights and duties of partners and LLP in the absence of formal agreement. See, in LLP also you will find partnership deed. We call it as limited liability partnership deed. Actually, deed decides the rights and duties of the partners. But any clause with respect to, any clause, for example, profit sharing clause is absent in LLP deed. Then come to first schedule. As per first schedule, yes, partners profit sharing ratio will be equal. So any particular, if LLP deed is not providing solution with respect to any situation, then come to first schedule. First schedule is determining the rights and duties of the partner to LLP, duties of partner to the LLP. As you all know, in a contract, you will find 2 parties. Each party will have right, and that becomes duty to other party. Each party will have a duty, and that becomes a right to another party. So now the duties and rights of the parties are governed as per the provisions of first schedule only in the absence of formal agreement. Next one, second schedule speaks about conversion of general partnership firm into LLP. Third schedule speaks about conversion of private limited company into LLP. Fourth schedule speaks about conversion of unlisted public company into LLP. That means LLP Act is not talking about conversion of listed company into LLP. If listed company wants to convert itself into LLP, first it should be delisted. That means, listed company should be converted into unlisted public company. Later, fourth schedule is providing procedure for conversion of unlisted public company into LLP. Next one, administrative authorities. Yes, with respect to LLP, administrative authorities are MCA, ROC, Ministry of Corporate Affairs, Registrar of Companies. Rule making authority, central government can frame and amend rules related to LLP Act 2008 through notifications in the official gazette. So in Act, you will find the provisions. Act is simply a bill approved by the Parliament as well as President of India. But during implementation of this Act, all the practical provisions, during implementation, MCA can frame rules from time to the time. Best example, small LLP we are having. Small LLP limits, yes, MCA can increase from time to time by making the rules. So rules are like, they are subordinate to the Act. Rules will not violate Act. Rules, they are complement to the Act. So we should follow Act as well as rules. And Indian Partnership Act 1932 is not applicable to LLP. That means if LLP Act is not providing a solution with respect to any situation in LLP, then LLP Act, that means simply, if LLP Act is silent, don't apply Indian Partnership Act to LLP. That's it. Maximum LLP Act will provide 100% provisions with respect to governance of LLP. But if any clause is absent in LLP Act, don't apply Indian Partnership Act provisions. Strict prohibition is there. Next one, definition of financial year. So with respect to LLP, the financial year start date will be 1st April, end date will be 31st March. But with respect to LLP, which was incorporated after 30th September, just look at this point. For LLPs incorporated after 30th September, the financial year ends on 31st March of the next year. Generally, suppose LLP was incorporated on 1st April 2024. Then first financial year closure date is 31st March 2025. 1st April to 31st March. If LLP was incorporated on 1st June 2024, then first financial year closure date shall be 31st March of 2025 only. But if LLP was incorporated after 30th September, means from 1st October onwards. From 1st October onwards, if LLP was incorporated, then financial year closure date shall not be 31st March of relevant year, it's 31st March of following year. That means next year. So 1st year, October 2024 to 31st March 2026. So that means only first financial year can be 18 months period. But subsequent financial years, you can see only 12 months period you can observe. Only for first financial year, it need not be equal to 12 months. Sometimes it may be equal to 9 months 1 day. 9 months 1 day. Sometimes it may be equal to 18 months. Best example, if LLP was incorporated on 1st October 2024, then first financial year closure date of LLP is 31st March 2026. Here you can see 18 months period. Suppose LLP was incorporated on 30th September 2024. Then financial year closure date, financial year ends with 31st March of 2025. So cutoff date is after 30th September. That means even if it is on 30th September, normal rule shall apply. But if it was incorporated after 30th September, then 31st March of next year you have to take as financial year closure date. Next one, limited liability partnership speciality. What is the speciality of limited liability partnership? It's a new legal business entity offering limited liability to the partners. And it combines features of both corporate structure of company as well as partnership firm. Partners liability is limited to the agreed contribution. So at the time of incorporating LLP, each partner will guarantee certain portion of amount, during liquidation. We will contribute to some extent. So they will make a guarantee. And now partners are liable to the extent of guarantee amounts mentioned. That means to their agreed contribution, their liability is limited. And LLP is liable for its assets. So here, the nature of LLP liability is unlimited, whereas nature of partners liability is limited. Nature of partners liability limited, nature of LLP liability unlimited. Now it's a separate legal entity distinct from its partners. So like LLP, similar to company, it is having a separate legal entity character. It allows partners to organize their internal structure like a traditional partnership. Suppose if you take company, company is separated from its owners. That means company is different, members are different. Then how company is regulated? Company is regulated by, company is, company will do its activities with the help of human agency. We call them as board of directors. See, board of directors are agents to the company and they may be a non-members. But coming to the partnership type of organization, coming to limited liability partnership type of organization, owners of LLP, few owners will come to the management side. That means, who will be there in the management of LLP? Owners only. That means, partners only. And we call them as designated partners. So this is the difference between company and LLP. In case of company, board of directors need not be members, need not be owners. But coming to LLP, management activities are taken care by owners only. Actually, owners of LLP, they are partners. But partners who are taking care of day-to-day activities of LLP, we call them as designated partners. And coming to compliance cost, low compliance cost compared to a company. So, for incorporation of a company, the amount of stamp duty we pay to the registrar, and every year audit requirements, every year. So, compliance cost compared to LLP is very high. That means LLP compliance cost compared to company is very, very low. And LLP is a hybrid form combining the benefits of a company as well as partnership. So it's a hybrid model of both company as well as partnership. Considering the advantages of company and partnership, a separate legal entity which came into the picture is nothing but LLP. Next one, definition of body corporate. This can be expected for 2 marks. Definition of body corporate. Body corporate means company as defined in clause 20 of section 2 of Companies Act 2013. See, section 2 clause 20 of Companies Act is nothing but definition of the company. What is a company? Company means company incorporated under this act or previous company law. So here, the definition of body corporate under LLP Act is body corporate is equal to company. Includes, that means plus, body corporate includes LLP registered under this act, LLP incorporated outside India, that means according to the other country LLP rules and regulations. Next one, company incorporated outside India. But it excludes corporation sole, cooperative society, any other body corporate specified by central government via notification in the official gazette. See, third point is a futuristic point. Here we are not notifying a list of items not covered under body corporate. Here we are giving a power to the central government. So tomorrow central government is having power to prescribe any other body corporate which will not be treated as a body corporate. For example, for the time being, Reserve Bank of India, which was constituted under RBI Act, it is a body corporate. But tomorrow if central government by notification specifies that RBI is no more a body corporate, then point 3 will be RBI. So for the time being, body corporate is equal to company plus LLP incorporated under this act, LLP incorporated outside India plus company incorporated outside India minus corporation sole. See, corporation sole, it's nothing but it's a position. It's all about a position or office held by a natural person. It's a position or office held by natural person. Best example, Prime Minister of India, President of India, Governor of the state. All these positions are perpetual in nature, but the persons occupying this position, every 5 years or every term, they may change. So here we are talking about the positions. We are not talking about the persons who occupy that position. Suppose President of India, it will be forever unless you delete Constitution of India. President of India is forever. The position is forever. Now, body corporate excludes President of India. Understood? So simply, what is the definition of body corporate? Body corporate is equal to company plus LLP incorporated in India under LLP Act, incorporated outside India, company incorporated outside India, and it excludes corporation sole, cooperative societies. Next one, small LLP. So here you need to remember the criteria how an LLP, how LLP be classified as small LLP. So criteria is very, very important. The criteria is contribution and turnover. 2 conditions to be satisfied. It's not either of the 2 conditions, both the conditions to be satisfied. Under Companies Act, we call it as a capital. Contribution is nothing but capital. Whereas coming to LLP Act, we call it as a contribution. So contribution does not exceed. That means, contribution less than or equal to 25 lakhs. Next one, turnover less than or equal to 40 lakhs. If both the conditions are satisfied, then it will be a small LLP. And this contribution turnover, we will look at preceding financial year financial statements. Understood? Can be increased up to 5 crores, can be increased up to 50 crores. Means, tomorrow if MCA, that means, central government decides to increase the limits like 25 lakhs, 40 lakhs, they can increase these limits up to 5 crores for contribution, up to 50 crores in case of turnover. Right now, for the time being, what are the applicable limits? 25 lakhs, 40 lakhs. You have to remember these two limits, 25 lakhs, 40 lakhs. Suppose ABC LLP, it's preceding financial year financial statements, it's financial statements, the contribution amount is 20 lakhs and its turnover is 41 lakhs. Now can we classify it as a small LLP? No. Why? Turnover already exceeded the limit. So simply being an LLP is not sufficient. It should satisfy two more conditions. What are those two more conditions? 25 lakhs plus 40 lakhs. 25 lakhs is for contribution, 40 lakhs is for turnover. Including these limits. Suppose they can ask you a question like this. As per financial statements, contribution amount is equal to 25 lakhs. Turnover is equal to 40 lakhs. Now small LLP or not a small LLP? Answer is small LLP. Small LLP, because it is also covering the value of 25 lakhs. It is also covering the value of 40 lakhs. Only when it crosses, that means, for example, 25 lakh 1 rupee, 25 lakh 1 rupee or 40 lakh 1 rupee, then it is no more a small LLP. Next one, partners in LLP. See, who can be partners of the LLP? What is the eligibility criteria to become a partner of LLP? So here, eligibility criteria was decided in a negative manner. That means any person can become a partner of LLP except a few people. Except few people, all other partners, all other persons are eligible to become partners of LLP. First of all, an individual can also become a partner of LLP, as well as body corporate can also become a partner of LLP, because body corporate is having a separate legal entity character. So by this it is very clear. Cooperative society, general partnership firms. Cooperative society, general partnership firms cannot become partners of LLP. Reason? They are not body corporates. If you take cooperative society, it is not a body corporate. If you take a partnership firm, it is not having separate legal entity character. So only an individual and body corporate can become partners of LLP. Now coming to individual, we have to check whether he is a sound mind or unsound mind, whether he is a insolvent or a discharged insolvent or undischarged insolvent, or whether he was an adjudicated insolvent. These three people are disqualified from becoming partner of LLP. Who are the three people? Unsound mind, disqualified. He don't know what is good, what is bad. Undischarged insolvent, insolvency application pending. See, both are not same, both are different. Undischarged insolvent means, his assets and liabilities were taken by the court, but not yet discharged. So once court pass an order treating him as a discharged insolvent, until then he is ineligible to become a partner of LLP. Next, insolvency adjudication means his assets are not equal to liabilities. Suppose assets 50 lakhs, liabilities 60 lakhs. Now this fellow filed an application to declare him as insolvent, and this application is pending for approval. So that means, if you look at the financial position of this person, he was already insolvent, but court not yet declared him as insolvent. Application is still pending. That fellow we call it as adjudicated insolvent. Whereas undischarged insolvent means court already declared him as an insolvent, and court didn't discharge him. That means his assets are yet to be settled with liabilities. Very simple point. Application pending for approval, adjudicated as insolvent. Application approved, but set off not yet happened. Set off not yet happened. He will be called as undischarged insolvent. Here both the insolvents are disqualified from becoming partners in LLP. And minor point is not there, but if you look at Indian Contract Act, minor is not eligible to enter into the contracts. So accordingly, minor cannot become partner in LLP. Next one, minimum number of partners in LLP. So at any point of time, at the time of incorporation, subsequent to incorporation, LLP must have 2 partners. Suppose if number of partners falls to below 2, that means, for example, A, B, C, LLP, 3 persons started one LLP. One day, accident, BC met with an accident and BC got deceased. Now LLP is left with only 1 partner. Now, lawmaker is giving a time period of 6 months So lawmaker is giving 6 months time. When reduction happened, suppose date of reduction is 1st April 2025. So I'm giving you 6 months time. Why the 6 months? Increase the number of partners from 1 to 2. So as per statute, minimum 2 partners are required for LLP. So within 6 months, if you increase number of partners from 1 to 2, you will have separate legal entity advantages. That means partners nature of liability will be limited liability. Act of LLP, partner is not liable. Who is liable? LLP is liable. But 6 months completed, still number of partners is 1 only. Now any act done after 6 months from the date of reduction of partners, for those acts LLP is not liable. The single partner is liable. So simply 1st April 2025, number of partners fallen from 2 to 1. So we are giving you time up to 30th September 2025 to increase the number of partners. Suppose as on 30th September 2025 also number of partners is 1. Now acts done after this date, that means all the obligations, all the liabilities, all the debts incurred by the LLP, only for this, I'm not talking about these debts. For all these debts, LLP only liable. Only for the debts after expiry of 6 months from the date of reduction, for these debts LLP is not liable. Partner who is aware of the fact that partnership LLP is continuing business operations with reduced number of partners. So if you look at here, personal liability applies if sole partner knew that LLP was carrying on business with only one partner. Next one, designated partner. As I told you, so partners who participate in management activities are known as designated partners. At any point of time, LLP must have 2 designated partners. How many? 2. And these designated partners must be individuals. One of the designated partners should be resident of India. At least one designated partner must be resident of India. So if all partners are body corporates, that means take an LLP, for example ABC LLP. Here who are the partners of LLP? A Limited, B Limited, C Limited. That means all the partners of LLP are body corporates. Now in this case, who will act as a designated partner? As per rule, only individual can act as a designated partner. Now in this case, who will become a designated partner? Answer is the nominees of these body corporates. So nominees of these body corporates will take the position of designated partner. And one of the designated partners should be resident of India. So his period of stay in India should be 120 days during the financial year. So the residential status of a designated partner should be 120 days. His period of stay during the financial year should be at least 120 days. So once again I am telling you how many designated partners we should have. 2. Out of 2, one should be resident in India. And if all the partners of a LLP are body corporates, then the representatives or nominees of body corporate will take the position of designated partner. So designation at incorporation. See, who are the designated partners? You can find through incorporation documents. Yes, here LLP deed will be there. And for incorporation, we use a document called FILIP, form for incorporating a limited liability partnership. So in these 2 forms, whose names were mentioned as designated partners, only those will act as designated partners upon incorporation. Next one, changes in designation. So a partner can become or cease to be a designated partner as per the LLP agreement. That means as per LLP agreement, a designated partner can resign. And if you want to name someone as a designated partner, so what are the rules and regulations? Everything is decided by LLP agreement. That means with the consent of all partners, like that. Next one, consent requirement. Before naming someone as designated partner, compulsorily you have to take a written consent from the person. That means if you want to name Mr. A as designated partner, before naming Mr. A as designated partner, a written consent from Mr. A that to act as a designated partner, he had no objection. So he should give consent before we name him as a designated partner. And the same shall be filed with registrar within 30 days of appointment of designated partner. So every time when you appoint designated partner, communication shall be done with ROC. Eligibility criteria: an individual must meet the prescribed conditions and requirements to be eligible as a designated partner. As you all know, unsound mind, not eligible to act as a partner. Insolvent, not eligible to act as a partner. So other people are eligible to become a partner of LLP, and only a partner can become designated partner. But before that, this person, this designated partner should have a number called designated partner identification number. So every designated partner must obtain DPIN from central government. So without DPIN, you can't name that person as a designated partner. So one of the most important prerequisite is having DPIN. And who will give DPIN? Central government. So issuing of DPIN is regulated by the provisions, section 153 to 159 of Companies Act. Next one, speciality of designated partner. Speciality, simply liabilities. Liabilities of designated partner, he is responsible for ensuring compliance with all the provisions of LLP Act, including filing documents with ROC, returns with ROC, reports as specified by the Act or LLP agreement. Simply, this is all about ROC filings. ROC filing. Two important filings we are having. One is, copy of annual returns we need to file with ROC. Second one is financial statements. Now, in case of delay or in case of default, along with LLP, who will also get punishment? Designated partner will get a punishment. So who is responsible for ensuring compliance with LLP Act provisions? Designated partner. And designated partner is liable for all penalties imposed on LLP for any contraventions. Changes in designated partner. LLP must appoint a new designated partner within 30 days of vacancy. As I told you, compulsory we should have two designated partners. But sometimes, what happens, there arises a vacancy in the position of designated partner. The reason may be death of a designated partner or disqualification, he become insolvent, or he lost residential status. Now any vacancy in the designated partner shall be filled within 30 days of the vacancy. And if no designated partner is appointed within 30 days, then law presumes that all the partners are deemed designated partners until compliance is resorted. That means all partners are deemed to be designated partners. Means with respect to ROC compliance, who will get punishment? All partners or individual partner? All partners. All partners gets punishment because all partners are deemed to be designated partners. And punishments for contraventions. So failure to comply with section 7 subsection 1, one punishment is there. Failure to comply with section 7 subsection 4, another punishment is there. And failure to comply with section 7 subsection 5 or section 9, another punishment was prescribed. So just give one time reading about these punishments. That's it, sufficient. Next one, characteristics of LLP. So what are the features? What are the characteristics of LLP? Let's see. So being an LLP, it will have all these characteristics. If anything is missing, then it is not an LLP. Suppose if you take partnership firm, it may satisfy few essential characteristics, but it may not satisfy body corporate. It will not satisfy perpetual succession. It will not satisfy separate legal entity. Mutual agency is there in partnership. Agreement is there in partnership. Artificial person not there. Common seal not there. Limited liability not there. Management of business there. Number of partners, yes, it is also there in partnership firm. So if you observe, partnership satisfy few characteristics, whereas LLP satisfy all the characteristics. So let's look into these characteristics one by one. LLP is a body corporate. As I told you, every incorporated association is a body corporate. And even if you look at the definition of body corporate includes LLP, which was formed under LLP Act 2008. And being a body corporate, it will have a continued existence. So the existence of LLP is not decided by the death, retirement, incoming, outgoing of the partners. And it is a separate legal body. It can do activities on its own. For the acts of LLP is liable, partners are not liable. And coming to mutual agency, with respect to partnership firm, mutual agency is there between partners. Between partners, mutual agency is there. That means one partner is an agent to all other partners. But coming to LLP, one partner is agent to only LLP. That means act of partner within his authority, LLP is liable but not other partners. So mutual agency arises between only two persons. One is partner and LLP. That's it. Whereas in case of partnership firm, partner is an agent to all other partners. Next one, LLP agreement. Yes, LLP agreement decides rights and duties of the partners. If LLP agreement is absent with respect to any situation, then first schedule shall apply. Artificial legal person. LLP is an artificial legal person. So it can own property. However, it cannot do certain activities like, activities which are personal in nature, like marriage, writing exams, right to vote, like that. Common seal. LLP being a body corporate, it will have an official signature. We call it as common seal. And next one, liability of the partners is limited to the extent of their agreed contributions. Now here, contribution may be tangible or intangible. That means, I can contribute money, for example, 5 lakhs, or I can contribute my assets, furniture, whatever furniture required for LLP, for carrying business operations, I will contribute furniture. So these are tangible net worths, tangible, money, tangible, furniture, tangible, intangible. Suppose, I'm providing my expertise, I'm providing my skills for the for carrying business operations of LLP. For example, if I join in any company, I'll be paid 2 lakhs per month as a salary. Now I am not taking any salary. I'm just working at free of cost to the LLP. Now this, sharing my expertise will comes under contribution, and it is intangible contribution. Management of business, partners manage their business, but designated partners handle legal compliances. That means any person can manage business, but who is responsible for legal compliances? Designated partner. So any non-compliance with respect to legal provisions, designated partners will get a punishment. Number of partners, minimum 2, maximum there is no limit. Business for profit only. Yes, LLP you can form only for business objective. You can't form LLP for charitable objectives. Next one, central government can investigate LLP efforts by appointing a competent authority. Suppose if LLP, if there is a doubt that LLP avoided some taxes, some 30 crores tax evasion is there, central government can appoint a competent person to investigate the matters of LLP. Next one, compromise or arrangement, like, mergers. Two LLPs can be merged, two LLPs can be amalgamated, and any dispute in the LLP, between partner and LLP, between LLP and creditors, so all those disputes can be compromised. Next one, conversion into LLP. Yes, even a partnership firm can be converted into LLP as per Schedule 2. Private companies can be converted into LLP as per Schedule 3. Unlisted public companies can be converted into LLP as per Schedule 4. 4 schedules you need to remember. First schedule talks about rights and duties of partners. Schedule 2, firm. Schedule 3, private company. Schedule 4, unlisted public company. Next one, e-filing of documents. Yes, all documents must be filed electronically via MCA website with a digital signature. If it is a manual form, signature is possible. I can sign it. But if it is a electronic form, that means, submission of forms online. How it will be signed? It will be signed digitally. Next one, foreign LLPs. LLP registered outside India and having a place of business in India. It's similar to foreign company. In case of foreign company also, company was incorporated outside India, but having place of business in India. In case of foreign LLP, incorporated outside India as per their country rules and regulations, and carrying business operations in India. Even a foreign LLP can become partners in Indian LLP. Why? Foreign LLP was declared as a body corporate. All body corporates can acquire properties in their own names, can incur liabilities in their own names. So accordingly, foreign LLP can also become a partner in Indian LLP. So simple point. Can a person, can an individual become a partner of LLP? Yes. Can a minor become partner of LLP? No. Unsound mind? No. Insolvent? No. Corporation soul? No. Next one, body corporates? Yes. LLPs? Yes. Foreign LLPs? Yes. Foreign companies? Yes. Understood. General partnership form? No. Because general partnership form is not a body corporate. Next one, advantages of being LLP. It is a organized and operates on the basis of an agreement. LLP form is a form of business which is organized and operates on the basis of the agreement. LLP agreement decides the powers and duties of the partners. So LLP agreement decides how to do the business. It provides flexibility without imposing detailed legal and procedural requirements like we find in company. In company we will see compulsory directors, appointment of directors, appointment of auditors, audit compulsory for every company. But coming to the LLP, audit is not mandatory for all LLPs. Some exemptions are there. And even appointment of directors is not required in LLP. Partners of LLP, few partners will take a position of designated partner. So management flexibility is there. Easy to form, by agreement it can form, and that agreement should be registered with ROC. That's it. And all partners enjoy limited liability. Flexible capital structure. Whenever LLP needs funds, they will contribute money. Whenever LLP doesn't need funds, they will withdraw the funds. So flexible capital structure. And even if you want to close LLP, it is very easy to dissolve compared to company. Easy to form, easy to dissolve. Flexible in management, flexible in capital structure. Next one, partners liability is limited. That's it. incorporation of LLP. First, minimum basic requirement, 2 partners are required to subscribe incorporation document. And these 2 partners will also act as designated partners. That means here 2 plus 2 is equal to 2 only. It's not 2 plus 2 equal to 4. 2 plus 2 is equal to 2. That means, 2 partners who are incorporating LLP will become designated partners upon incorporation. That means they should have a DPIN at the time of incorporation of LLP. And filing must include, filing of this incorporation document also includes following documents. One document, statement by professionals. It is similar to declaration by professional in case of company. With respect to incorporation of LLP, all applicable rules and regulations under LLP Act have been complied with. So independent professional will verify whether incorporation is happening under LLP Act or not. So he will verify and he will give a statement. Incorporation document with prescribed details like what is the name of LLP, where LLP is going to have registered office, who are the partners of LLP, who are the designated partners of LLP. This information must be included in the incorporation document. And any false statement you furnish in the incorporation document attracts punishment, imprisonment up to 2 years, fine 10,000 to 5 lakhs. It's imprisonment and fine. So this can be asked, prescribe the procedure, describe the procedure for incorporation of LLP and what would be the consequences for false declarations. So this can be asked for 4 marks. Next one, incorporation by registration. Upon compliance of above section, registrar registers LLP within 14 days and he will issue a certificate of incorporation serving as conclusive evidence of LLP formation. So whether LLP was formed or not, which document will decide? Certificate of incorporation. Who is having authority to issue certificate of incorporation? ROC. Registered office. Every LLP must have registered office for receiving communications and notices. So any officer wants to serve notice to the LLP, that notice will be addressed to registered office of the LLP. And changes in address must be notified to the registrar. So whenever you are shifting your registered office from one premises to another premises, LLP has to communicate the same with registrar. Non-compliance, attracts punishment. What is the punishment? 500 per day, maximum 50,000. As I told you, this is a matter of legal compliance. Here, LLP as well as designated partner will get a punishment. Next one, effect of registration. What is the effect of registration of LLP? It can show, it can be showed. It can acquire, own, dispose property in its own name. It can have a common sale and it can perform all other lawful corporate acts. Next one, name of LLP. Like private limited company, like public limited company, name shall always ends with private limited, name shall always ends with limited. And coming to LLP, name shall always ends with limited liability partnership or LLP as the last words. Name must not be undesirable or identical to the existing LLP company's trademarks. That means Reliance Industry Limited is there. Now, can I incorporate a LLP with the name Reliance Industries LLP? Is it possible or not possible? Because name shall not be identical to or name shall not be similar to existing LLPs as well as existing companies as well as existing trademarks. Now, the point is, so you decided one name and you want to know whether this name is available or not available. Not available means already used by some other association. Available means not used by any association. So whether it is available or not available, to know, you can file an application for reserving the name. Reserve. And the name shall be reserved for a period of 3 months once requirements have been complied with. So that means, today if you get approval from registrar, it will be reserved for 3 months. That means up to 3 months from the date of reservation, no association can use that name. No association can register LLP with the same name. Next one, rectification of name. Here the point is very clear. Rectification means what? Something error happened in past. Now correcting this error is nothing but rectification. So here name mistake means what? We incorporated LLP with the name which is similar to or which is identical to the name of existing LLP or existing company or existing trademark. Out of negligence, unintentionally, it's like not intentional, unintentionally, ROC issued a certificate of incorporation with the name which is similar to the name of existing LLP or existing company or existing trademark. Now tomorrow if central government knows that LLP is using the name which was already registered by another association, now central government will give a direction to LLP to change its name within 3 months. So central government, if it is satisfied that yes, LLP is using the name of existing LLP or existing company or existing trademark, So it will give how many months time for changing the name, for rectification of name? 3 months. Within 3 months, LLP has to change its name. Suppose if LLP makes default, suppose if it is not changing the name, then central government will give new name to the LLP. And central government will notify the same to the registrar, who will issue fresh certificate of incorporation. And LLP must notify the registrar and update the LLP agreement within 15 days of the name change. As you know, LLP agreement, coming to LLP, it is similar to MOA of company. It is similar to AOA of company. In company, constitutional documents are MOA, AOA. In LLP, constitutional document is LLP agreement. So whenever name is changed, so LLP agreement has to be updated accordingly. Next one, differences between LLP and partnership, LLP and limited company. Let's see one by one. See, LLP is governed by LLP Act, whereas partnership is governed by Partnership Act. LLP is a body corporate, partnership is not a body corporate. LLP is having separate legal entity, but partnership is not having separate legal entity. LLP is created through LLP Act, whereas partnership is created by partnership deed. Because here registration is voluntary, not compulsory, whereas LLP registration is mandatory. And being a separate legal entity, it will have perpetual succession. Which one? LLP. No perpetual succession with respect to partnership firm. Next one, name includes limited liability partnership as lost words. But coming to partnership firm, there is no specific guidelines. Few partnership firms ends with end co. Few partnership firms ends with end associates. So there is no guidelines with respect to partnership firm names. Next one, liability of partners in LLP limited, whereas partners liability in partnership firm unlimited. Mutual agency is present in both the cases, but partnership firm, one partner is an agent to all other partners, whereas in LLP, one partner is agent to just LLP, but not other partners. Designated partners. How many designated partners we need in LLP? 2. And out of 2 designated partners, one should be resident of India, whereas there is no such requirement in partnership firms. LLP will have a common seal, no common seal in partnership. And LLP legal complaints is there. In case of non-compliance, penalties are there. But those concepts are not there in partnership firm. And moreover, if suppose partnership firm, if you take income tax act, they need to pay income tax yearly. So here non-compliance of IT act attracts punishment to all the partners. Whereas LLP, only designated partners will get that punishment. Annual filing is there in LLP, no annual filings there in a partnership firm. Annual filings means 2 filings. One is financial statements, that means statement of solvency. You can see in statement of solvency financial statements. Second one is annual return. Foreign partnership firms can become partners of LLP, whereas foreign nationals can become partners of LLP. That means foreign citizens. Whereas foreign citizens cannot become partners in general partnership firm. Minor can be admitted as a partner for benefits in general partnership firm, but here minor is strictly prohibited. Next one, LLP, limited liability company. So here few differences we are having. One is act, LLP act, companies act. Similarity, if you ask, limited liability. With respect to dissimilarities, with respect to distinction, let's say here we call owners as partners, here we call owners as members. And here partners are governed by LLP agreement, members are governed by Companies Act. Name ends with limited liability partnership firm for LLP, whereas name ends with limited or private limited with respect to company. And minimum number of partners 2, maximum unlimited, whereas minimum number of members in case of private company 2, maximum 200, public company 7, unlimited. Next one, liability is limited, both the cases limited. But one specific point is there, in case of LLP, if any partner commits fraud, liability arising due to fraud, that partner's liability is not limited, that partner's liability is unlimited. Next one, management. Here, management is taken care by designated partners, whereas here, board of directors. And who appoints board of directors? Members. Who appoints designated partners? It is taken care by LLP agreement. Next one, minimum designated partners 2 here, whereas minimum directors for private company minimum 2, for public company minimum 3. So with this, LLP completed. Let's continue marathon with the next chapter, that is Indian Partnership Act 1932, which is having an expected weightage of 15 marks in your examination. Clear? So first one, what is a partnership? See, partnership is a relationship between persons who have agreed to share profits of a business carried on by all or any of them acting for all. So first of all, what is a partnership? It's a relationship between two or more persons who have agreed to set up a business and who have agreed to share profits of the business. Either the business operations are carried on by all of them or any of them acting for all of them. Understood? And individuals in this partnership, we call them as partners, and collectively we call them as firm. So partnership is not a separate legal person. It's just a relationship between the persons who are in that association. So definitely for partnership, minimum 2 persons are required. And is there any restriction on maximum number of partners? Yes. Indian Partnership Act is not specifying the maximum number of partners, but Companies Act 2013 is specifying the maximum number of partners. So the maximum number of partners is 50. Beyond 50, the firm is said to be dissolved automatically, and that association is said to be an illegal association. Getting my point, students? So in an association, how many persons we should have in case of partnership? Minimum 2, maximum 50. First of all, partnership should satisfy 5 essential elements. 5 essential elements. First of all, there should be an association. As you all know, association requires minimum 2 persons. And there should be an agreement between that association. That association should be governed by an agreement. Agreement may be express or implied. And express agreement, we call it as partnership deed. Next one, existence of business. Simply association plus agreement alone not sufficient. They should set up a business. There must be a business activity. Understood? The primary motive is acquisition of profits, acquisition of gains. If there is no intention to conduct business operations or generate profits, it is not a partnership. Then what it is? It may be a society, it may be a trust. Next one, agreement to share profits. Sharing profits alone is sufficient. Sharing of losses is not a mandatory thing. It's not a compulsion thing. So sharing of profits is compulsory. If any person is not sharing profits of the association, then that person is not treated as partner. Of course, partner can share only profits. Partner cannot share losses. Few partners, they will participate only in profits. They will not participate in losses. But primary important thing is sharing of profits. If nothing is specified, all the partners in an association, all the partners in the firm will have equal profit sharing ratio. And profit sharing ratio is deemed to be loss sharing ratio also. Understood? Loss sharing ratio is equal to profit sharing ratio if unless otherwise specified. Next one, mutual agency. In the definition, you can see business carried by all or any of them acting for all. That means, one partner will carry business operations on behalf of all other partners, or all other partners can carry business operations on behalf of one partner. That means simply in partnership firm, one partner is an agent to all other partners. All other partners are principal to first partner. Understood? So those who are participating in day-to-day affairs of the firm, we call them as active partners. And simply they are not participating in day-to-day affairs, they are simply inactive. We call them as dormant partners. Getting it? Now, any association satisfying these essential elements, we call it as a partnership. So what are those essential elements, ma? First one, 2 or more persons are required. That means association is compulsory. Agreement and partnership is only for business operations, and sharing of profits compulsory. Mutual agency. So business must be carried on by all partners or by anyone or more of acting for all. This ensures mutual agency, which is the cardinal principle of partnership law. Each partner acts as a principal, acts as an agent. See, each partner acts as an agent. For example, throughout this chapter, I will take only one example, that is ABC and Co. partnership firm. ABC and Co. partnership firm, where A, B, C are individuals, partners of the firm. Now, acts of C will bind B and A. That means for C, A, B are principals. Getting my point? Now, act of A, B as well as C are liable. Now, if A is an agent, other partners are principals. If C is an agent, other partners are principals. Getting my point? That means one person will act as a principal as well as agent depending on the acts. For other partner acts, I am principal. For my acts, other partners are principals. True test of partnership. Whether partnership exists or not, what is the true test? Existence of mutual agency. What is the point? Existence of mutual agency. If there is a mutual agency, that means act of one person, all other persons are responsible. Then there is said to be existence of mutual agency. If mutual agency is present, then partnership is present. If there is no mutual agency, then there is no partnership at all. Getting my point, students? See, judicial interpretation in one case study, having partnership for the two essential conditions to be satisfied. In this case study, two essential conditions to be satisfied. What are those essential conditions? First one, sharing of profits and losses. Second one, mutual agency. Absence of any of these things, it is not said to be a partnership. Getting my point, students? So these two essential conditions to be satisfied by that association, then only that association will be termed as partnership. Exclusive power or control with one partner does not nullify, negate means nullify the partnership. Suppose in ABC and co-partnership firm, A is active partner, B as well as C both are dormant partners, inactive partners. Now, can we call it as a sole proprietorship firm? No. This is partnership firm only. Why? Act of A, B as well as C were held liable. They are responsible for acts of A. Mutual agency condition is there. And these three partners will share profits as well as losses. That's it. There is a partnership between A, B and C. Next one. Partnership deed forms the legal foundation of the partnership, outlining the terms, conditions agreed upon by the partners. Simply, partnership deed is a constitutional document. It's a fundamental document or it's a constitutional document governing ABC and co partnership. Governing ABC and co partnership. Getting it? So how much profit each partner is entitled to, how much loss each partner is entitled to, how much capital contribution each partner should contribute, and what would be the objects of the association, what would be the objects of the firm. Everything is specified in partnership deed. So partnership deed is a constitutional document. It's a legal foundation of the partnership, specifying the terms and conditions agreed by all the partners, because partnership deed is something signed by all the partners. Getting it? True test of partnership. Actually, I told you 5 essential elements should be satisfied. 5 essential conditions should be satisfied to call it as a partnership. But out of 5, 3 are very, very important. So there must be an agreement. Agreement should be between association only. That means association condition also satisfied. Next one, sharing of profits. I told you sharing of losses is not mandatory, but sharing of profits is a compulsory essential condition. And carrying on business together. That means one partner acting for all, or all the partners are acting for the firm. Understood? So this is nothing but mutual agency. Mutual agency. So if these essential elements are satisfied, then there is said to be existence of partnership. Getting it? Partnership arises through an agreement. We call it as deed between parties, but not through status. For example, HUF, if you take, by birth you will become member of your HUF. So it is by status, but partnership, it is not through status. Getting it? Next one, sharing profits is essential but not conclusive evidence of partnership. So primary evidence, prima facie evidence is sharing of profits, but simply sharing of profits alone not sufficient. Mutual agency is also compulsory condition to be satisfied. Business must be carried on by all or acting for all, showing some mutual agency. Next one, key elements of partnership. Agreement, profit sharing, mutual agency. Same points ma. If you observe true test of partnership, key elements of partnership, same conditions. Agreement compulsory, partnership, profit sharing compulsory, mutual agency compulsory. But this point is something important. This point is something important. So here you should check whether partnership exists or not. Whether partnership exists or not. Suppose ABC and Co, same partnership firm, agreed to share certain portion of profits to Mr. D, a money lender. Mr. D, a money lender. Now, can we call D is a partner in the partnership firm of ABC and Co? No. Why? Act of ABC, D is not responsible to third parties. So that means simply sharing of profits alone is not sufficient to treat it as a partnership. In addition to sharing of profits, mutual agency condition to be satisfied. Now, act of A, BC liable. Act of B, AC liable. Act of C, AB liable. But act of A, act of B, act of C will not make D liable. So lenders, creditors who are having sharing of profits of the partnership firm, they will not become partners. Next one, employees remuneration. See here, we can have a negotiation with employees like this. Every month fixed salary of 30,000. At the end of the year, we will give you 10% share in the firm profits. Now employee is getting a share in the profits of the association. Now can we call employee as a partner? Can we call employee as a partner? No. Why? Because act of partner, employee is not responsible to third parties. Next one, suppose C got deceased, C died. Now C's widow or C's legal heir, simply children. So they will also get share of profits in the association, but they will not become partners. Simply act of A, act of B, widow or legal heirs of a deceased partner are not liable. Next one, payment for goodwill. Suppose I acquired business from existing business person and I agreed, our association agreed to pay some 20% of profits to the seller of the goodwill, or simply, seller of the business. Now that seller of the business is also getting share in the profits. That doesn't mean he's a partner in our partnership firm. The reason is our acts will not make seller of business liable. So simply in all these exclusions, if you observe, lack of mutual agency, there is no partnership. Lack of mutual agency, there is no partnership. Getting it? Next one, factors for existence of partnership. So whether partnership exists, whether partnership is in existence or not, how we will check. So factors, written or verbal agreement. So there should be an agreement. That agreement may be either express or implied. That means through conduct of parties. By the conduct of parties. Suppose, A is procuring raw materials, B is paying money to the creditors. A is procuring raw materials, B is procuring money. A is procuring raw materials, B is making payment to the creditors. Next one, C is selling finished goods and B is receiving all the amounts from debtors. At the end of the year, A, B, C, they are sharing the profits. They are sharing the profits without written agreement, without oral communication. But these people are doing activities collectively. Now, by the conduct of parties, they become, they will become partners of the partnership firm. Real intention of the partners, the intention of the parties should have an intention to do business collectively and share profits at the end of the period. Surrounding circumstances, cumulative effect of all relevant facts should also be evaluated. Now, if you see the decided case law, Santi Ranjan Das Gupta, in this case study, if you observe, court declared this as not a partnership. The reason is there is no written agreement. Absence of documented terms of partnership weakens the claims of existence. So, they didn't took only agreement as a basis. They also took some other factors as a basis why there is no partnership. Why partnership is not in existence. For that, they had evidences. They considered the following factors. First thing, there is no written agreement. Second one is there is no separate business bank account. That association didn't open bank account in the name of firm. So then how can we treat there is an existence of partnership firm? The firm is in existence. How can we treat? For court, evidence is compulsory. You have to submit some proof, documentary evidence you have to submit. Agreement not there. Bank account not there. Partnership bank account is not there. And next one, lack of partnership specific accounts make a partnership unlikely. Suppose, you are dealing with creditors, you are dealing with debtors. But the debtors, the creditors are not thinking about your firm. They are thinking about the individuals with whom they are dealing. Getting it? Separate ledgers are not there, separate bank account is not there in the name of firm. And next one, no official notification of partnership. Previously, right, not right now, previously when you open partnership, you have to make an intimation to the authorities, and there is no intimation to the authorities. So without written agreement, without separate business accounts, without separate business bank accounts, without official notification, how can we treat whether partnership is in existence or not? Getting it? So that's what, surrounding circumstances means considering all these things. Court will decide whether existence of firm, whether firm is in existence or not. Next one, comparison between partnership and joint stock company can be tested for 7 marks. Chance is there. So remember 7 points, write 7 points in the examination. First thing, partnership has no legal status. Joint stock companies having a separate legal entity. Agency, each partner is an agent to all other partners. But coming to joint stock company, member is not an agent to other members. Distribution of profits, partners will get share in the profits. Whereas members will also get share in the profits, which is decided by the board of directors. Extent of liability, partners liability, owners of partnership firm, their liability is unlimited. Understood? Their liability is joint and several. But coming to joint stock company, their liability is limited to the extent of unpaid value multiplied by number of shares held by them. Property, firm's property is the joint estate of the partners and not separate from their personal ownership. So here, firm property is nothing but partners' joint property. Whereas company's property is nothing but company's property only. Owners are, members are owners of the company. Company is owner of company properties. That doesn't mean members of the company are owners of the company properties. Getting it? Everyone? Next one. Transfer of shares. Yes, in both the cases, transfer of share is possible. Transfer of interest in partnership is possible. Transfer of shares in case of company is also possible. But coming to partnership, consent of all partners is required, or else transferee will not get all the rights like other partners. Management in case of partnership is taken care by owners, whereas management in case of company is taken care by board of directors. Registration is optional for partnership, and registration is compulsory for companies. Winding up, firm can be dissolved anytime with the mutual agreement of all partners. But company is not like, company existence, company liquidation, everything is decided by operation of law. Number of persons in case of partnership, maximum restricted to 50. In case of company, for private company 200, for public company unlimited. Next one, duration of existence. Company will have perpetual succession concept. Company will have continued existence, whereas partnership firm, it will not have continued existence. Firm will be partnership will be dissolved upon the incoming of a new partner, retirement of existing partner. Next one, death of a existing partner. So firm will not have perpetual succession concept. Next one, partnership club. Very important difference is partnership is only for business operations. Club not meant for business. Other than business operations, we can have a club. Simply, clubs provides various benefits to its members. Partnership, the main objective is carrying business operations. The main objective is earning profits, and the main objective is sharing of profits. Mutual agency is present in partnership. There is no mutual agency concept in case of club. Getting it, everyone? So these two are important points, ma. Business operations. Next one, mutual agency. Each will act as an agent, whereas in club, persons forming a club are called members. Member is not an agent for other members. Next one, any change in partners of the firm affects its existence, whereas change in membership of a club will not affect a club's existence. Clear? Next, partnership joined Hindu family. Partnership arises by agreement, voluntarily. Joint Hindu family arises by birth. So here status is important, whereas here agreement is important. So death of a partner usually leads to the death of dissolution of the partnership, whereas death of a family member does not dissolve a family business. Management, all partners except dormant partners will take care of business activities, whereas in joint Hindu family, karta will take care of management. Authority to bind, every partner can bind others. Every partner can bind the firm by their legal actions, but here only karta can bind family. Liability, unlimited liability, and here karta's liability is unlimited. Other persons in that HUF liability is limited to the extent of their share in the family business. Calling for accounts on closure, who can call for books of accounts? All the partners. Any partner can demand books of accounts. Understood? Whereas in case of HUF, only upon separation, member cannot demand on account of family business. Once you got separated, subsequently you had no right to ask for HUF books of accounts, HUF HUF financial position. Governing law, Indian Partnership Act 1932. Here it is governed by Hindu law. Minor's capacity, here minor can be admitted only for profits. Minor can't be admitted for liabilities. Minor only can be admitted for profits, and for the two, consent of partners is required with the consent of partners. But here, minor can also become a member of HUF by birth. From birth, he is a member. He is a member. Continuity. A firm dissolves upon the death of insolvency. There is no perpetual succession. But coming to HUF, it continues until explicitly divided. Unless members of HUF, unless family persons of HUF decide to separate, until then HUF will continue. It's not affected by the death of a member. Even Karta got deceased, no problem, business will survive. Next one, number of members, with respect to partnership, maximum 50. Restriction is not imposed in Indian Partnership Act. Restriction was imposed by Indian Companies Act. Clear? Whereas here, liability is unlimited. Liability, karta's liability, sorry, it's not liability, it's number of persons in case of HUF is unlimited. There is no limit on number of persons in HUF. Share in business, each partner has defined share, like 10% share, 20%, 30%, so defined share. But coming to the HUF, there is no definite share. It depends on the number of persons. Suppose 100 persons are there, each one will get 1%. 10 members are there, each person will get a 10% share. Only 5 members are there, each one will get 20% share. Getting it? So it depends on number of the persons, number of members in a HUF. And it will be always fluctuating in nature with the births and deaths in the family. And next one, partnership co-ownership. Only one difference I will tell you. In partnership, mutual agency is present. In co-ownership, mutual agency is absent. Suppose in co-ownership, mutual agency is present, then it is not co-ownership. It may be a co-ownership, but it is a partnership. Ultimately, it is a partnership. Only mutual agency factor, it is separating partnership and co-ownership. Getting it? Everyone. And other differences you can see, partnership, definitely contract is required, either express contract or implied contract. Co-ownership generally arises by agreement or through operation of law. Suppose Mr. A is a owner of a house property, A got deceased, and A is having a B, C, two children, two sons, for example. Now B, C automatically becomes legal heirs of the property. So they are co-owners of the property. Implied agency, yes, agency is present in partnership, but there is no agency in co-ownership. That's what mutual agency I'm talking about. Nature of interest involves a community of interest. Profits and losses must be shared. Correct. But here, sharing of profits and losses not necessary. Suppose in this house property, some 50 flats are there. 25 belongs to B, 25 belongs to C. Out of 25 of B, 20 got occupied. So he will enjoy with the 20 rents. Suppose C is having 25 flats. Out of 25, only 15 flats were occupied. Now rents of 15 flats are enjoyed by C. So, sharing of profits losses doesn't required, not required in case of co-ownership. Of course, even if sharing of profits or losses is there, but still co-ownership is separated from partnership because of mutual agency. Because act of one co-owner will not make other co-owner liable. Act of one co-owner will not make other co-owner liable. That's the only fundamental difference. Transfer of interest. A partner's share can only be transferred with the consent of all other partners, and a co-owner may transfer their interest even without communicating, without needing the consent of other co-owners. Next one, partnership association. Only difference, partnership is for business operations, whereas association may be for business, maybe not for business, not for profits. That means charitable association. Charitable associations are present here. Simply every association becomes partnership if it is carried for business operations, having mutual agency concept, having sharing of profits. Getting it? So association is broader term, partnership is narrow term. With these differences also completed. Next one, kinds of partnership. Kinds of partnership. On the basis of duration, partnership is classified into two types or two categories. One is partnership at will, that means without any time frame, without any duration. If partnership is formed, we call it as partnership at will. If a partnership is formed for fixed duration, for example 3 years, 5 years, 10 years, then we call it as partnership for fixed period. And once that period is over, it automatically gets dissolved. So it ends on the expiry of the fixed period. Whereas partnership at will, it can be dissolved by any partner by giving notice in writing. Now they can ask you a question like this for 2 marks. Partnership at will, one partner gave a oral notice to dissolve the firm. Is that notice valid? Is the firm dissolved? Answer is no. That notice should be given in writing. And that notice should be given to not majority of the partners. It should be given to all other partners. Getting it? Next one, particular partnership, general partnership. This is based on the project. Partnership for a particular venture, particular project, we call it as a particular partnership. No, for all business ventures are general partnership. So particular partnership, it speaks about only single adventure or single undertaking. And liability of partners is restricted to that project only. Liability of partners is not extended to other projects. It is limited to specified project, specified purpose. Clear? Next one, general partnership. It is constituted for the conduct of general business activities. Partners are liable for the entire business, not just for specific adventure or undertaking. Next one, particular partnership dissolved upon completion of the adventure, undertaking, or subject to agreement. Indeed, they can write a point regarding dissolution. So follow the deed, or else upon completion of the project, upon completion of the undertaking, particular partnership will be dissolved. Whereas general partnership, it will be dissolved as per agreement or by the general terms of the partnership agreement. Suppose if majority of partners agree to dissolve, agree to dissolve the firm, then firm can be dissolved with the consent of majority of the partners. So there is nothing but agreement. So this is all about types of partnership on the basis of duration, on the basis of venture. Next one, partnership deed. I told you this is a legal document, legal foundation, constitutional document where you'll find all the terms and conditions which govern the partners regarding profit sharing ratio, name of the partnership firm, business activities that can be formed by, business activities that can be done by the partnership firm. Understood? So partnership deed, it's a written document containing terms and conditions regarding the ship relationship of partners in the firm. It helps to avoid future disputes. Definitely. Suppose, profit sharing ratio, for example, A1, B2. That means 1:2 ratio. So more profit B will get, less profit A will get. If this is not specified in the agreement, tomorrow in court of law, court will judge or court will give judgment that A and B both are equal partners. So A will get 1 rupee, B will get 1 rupee, like that. So if you had an intention to share profits in 1:2 ratio, put that same in agreement, or else equal partners. Formality, it can be either written or verbal, but written agreements are preferred to avoid future conflicts, future disputes. And it must be stamped. There is no optional. It must be stamped and registered as per the law. Getting it? Deed. Next one, required for partnership with immovable property. Partnership must be in writing. Here, oral partnership alone is not sufficient. Suppose any partnership, if it is acquiring any immovable properties or if it is taking any loans, the deed must be in writing. It must be stamped and it must be registered under Registration Act if partnership includes immovable property. So here registration is compulsory. Generally, registration of firm is not compulsory, it's optional. But if you are acquiring any loans, if you are taking any, if you are taking any loans from banks, if you are acquiring any properties in the name of partnership, then generally registrar will ask registration certificate. Where is the registration certificate of the firm? So that's why registration is compulsory in few cases, whereas it is optional in remaining cases. Now coming to contents of the deed, first important content, it should have a name, what we call that firm. So what is the name of the firm and who are the partners of the firm? So where it is carrying business operations and what are the business operations it is carrying? Date of commencement of partnership, when it got commenced, and what is the duration? If duration is absent, if this point is absent, it will be treated as partnership at will. Capital contribution of each and every partner, how much amount each partner is contributing, and what is the profit sharing ratio of the partners, and what are the terms for admission of the new partner, retirement of the existing partner, and whether a firm is paying any interest on its capital, whether firm is charging any interest on the drawings, whether firm is paying any interest on the loans. If yes, what would be the rate? Provision for settlement of the accounts upon dissolution of the firm. How accounts should be settled. First priority should be given to the outsiders, second priority should be given to the partners. So in what manner settlement will happen and how to dissolve the firm. Next one, provisions regarding partners remuneration, partners commissions, and provisions regarding expulsion of partner in case of breach of duty or in case of fraud done by the partner. Getting it? So these points you can have in deed. See, this is not a complete list. In addition to this, you can have additional points, or this is not compulsory things. That means all these 12 points should be present. It's not like that. You can have 10 points. You can ignore 2 points. Getting it? Next, flexibility. The partnership deed can be modified based on firm needs. So whenever you want to change object, whenever you want to change place of business, whenever you want to admit a new partner, whenever existing partner is retiring, every case, every situation, you can amend the partnership deed, and it is very simple. But if original deed is registered, then altered, amended deed should also be registered with a registrar. Now coming to the types of partners, see, you can see here total 7 partners we are having. One is active partner, one who participate in day-to-day activities, one who participate in ordinary course of business. So any partner participating in day-to-day affairs, we call him as active partner. Next one, he is liable for all acts of the firm, and upon retirement, he must give public notice. He must give public notice. There is no option at all. It is a duty of the active partner to give notice to the public at the time of retirement, or else that retirement is not considered. We assume he is not retired, he is continuing as a partner. Accordingly, acts of the other partners, this fellow will be held liable. Next one, sleeping or dormant partner. He is not known to the public. He will not participate in the business operations. He will simply get share in the profits or losses. So he is liable to the third parties for the acts of the firm. Of course, upon dissolution, in case of capital deficiency, that means assets are not in a position to meet liabilities, this fellow is also liable to contribute from his personal assets towards that capital deficiency. And this fellow, if he want to retire from the firm, no need to give public notice, because public is not having knowledge about this existence of this partner. Public will come to know about this partner only at the time of dissolution, closure. Nominal partner, actually he is not a partner, not actually a partner, but he lends his name to the firm. For example, you take brand ambassadors. They are actually not partners. They may be a partners, but sometimes even if they are not partners, because of their brand ambassador publicity, advertisements, they also become partners of the firm. They're like nothing but nominal partners. They doesn't participate in the business or capital contribution, but they are liable for the acts of the firm in case other partners are not in a position to pay debts, and he is not entitled to share profits of the firm because he is not an actual partner. He is not an actual partner. Then how he will get share in the profits? The only disadvantage with respect to nominal partner is, if firm is not in a situation to pay debts, the nominal partner is liable to contribute something towards those debts. Partner in profits only. As I told you, sharing of profits is compulsory. Sharing of losses is not compulsory. So yes, we can have partners only in profits. But the point is, in case of closure of the firm, if there is any capital deficiency, that means assets is, for example, assets 60,000, whereas liability 90,000. Now capital deficiency of 30,000, who should also contribute? This partner should also contribute. Understood? Business losses, yearly regular losses, he will not participate, but at the time of closure, he is responsible to the outsiders. Next one, incoming partner. So he's a new partner. So generally, new partner admission requires consent of all existing partners. The reason is, upon admission, act of this new partner, all other partners are liable jointly and severally. That's why all other partners' consent is required for incoming partner, and he is liable only for the acts that are done subsequent to his admission. If unless otherwise specified, he is liable for acts that are done subsequent to his admission. Outgoing partner, retiring partner. See, retiring partner is simply coming out of the firm. He should give public notice. From the date of public notice, he is not liable for the acts subsequent to the public notice, or else he is liable as if he is an active partner. Partner by holding out. This fellow is also not an actual partner, but by representation, he becomes a partner. Suppose in the presence of A, B, C, D is making a statement with a supplier. Sir, I am also partner in this firm, sir. Now A, B, C, after listening to these statements, they remain silent. Silence constitutes D as a partner of this firm. Actually, D is not a partner, but D is becoming a partner. Or suppose A, B, C, they are making a statement with yes, stating that D is also partner in our firm. Now D, listening to the statement, D remains silent. Now what S can presume? D is also partner in the firm. So now accordingly, acts of D, other partners are liable. Acts of other partners, D is also liable. Getting it? Acts of D, other partners are liable. Acts of other partners, Mr. D is liable. So a person who represents himself as a partner or so allows others to do, induces third parties to believe that they are partners. Now that partner by holding out is liable for the acts of the firm even if he is not an actual partner. Liability applies even to the former partner. Former means actually right now he is not a partner. Once upon a time he is a partner, but he failed to give public notice on retirement. Now what public presumes? Public presume that this fellow is continuing as a partner in the firm. Accordingly, that person will get a liability. So I told you beginning only, partner by holding out means he is not an actual partner, but because of representations or because of failure to give notice of retirement, he will become a partner. Accordingly, he will get liability. Getting it? Key points for partner by holding out. Just give one time reading. Next one, relationship between partners in Indian Partnership Act 1932. See, this talks about duties and rights of the partners. See, by agreement, partners will get certain duties, but without agreement also, partners will get these two duties, common duties. Every partner in partnership firm will get these duties by default. Default means simply if you purchase any mobile, in mobile you will find default applications like call application, messages application, next one file manager application, getting it, Play Store, Google, all these are default applications. If you want, you can delete some of those default applications. If you want, you can install new applications, getting it. But these are something, even with or without agreement, these are common duties. So every partner must act in the best interest of the firm. So they should think about the firm. Whatever decision they are taking, it should benefit the firm jointly, collectively. So partner should work for firm's benefit, not for his personal benefit. Provide full information to each and other legal representatives. Maintain good faith in dealings. Getting it? Next one, a partner committing fraud must compensate for the loss caused. Any loss caused by the conduct of the partner, fraudulent activities, that particular partner should compensate all other partners whatever loss caused because of his acts. Next one, determination of rights and duties. So here onwards, additional duties, additional rights, it all depends on agreement. First two, with or without agreement, these are common duties. But subsequent points, only by agreement you can give additional duties, you can give additional powers. So what are those additional things? Let's see. First of all, partners' duties, partners' rights are determined by agreement. That means deed. Agreement can be altered with mutual consent. From time to time, if you want, you can modify the agreement. And agreement may also restrict the trade by partners. That means agreements in restraint of trade. So they can contract, they can make a point in the deed like this. As long as partnership continues, no partner in the firm shall carry same business operations in the same locality. So these contracts may prevent existing partners from carrying on any other business during the partnership period. So by this, what happens, everyone will work for the firm, every partner in the firm will be benefited, or else each and every person will set up a separate branch, separate proprietorship concern, and they work for proprietorship concern, ignoring partnership. Now other partners' interest is getting affected. Getting it? Next one, of course, section 27 Indian Contract Act, restraint of trade. This point is an exception to that point. That means actually agreement in restraint of trade is generally void. Okay, but here it is valid. This is an exception to that general rule. Next one, formation and variation of agreements. Partnership agreements depend on mutual consent for the formation and any variations. And deed, there is no specific form at all. For amendment also, there is no specific form at all. You can have your own form. That's it. Writing, stamping, compulsory. Form, it's up to you. Getting it? Everyone. Next point. Provisions regarding conduct of business under section 12 of Indian Partnership Act 1932. So simply it is talking about conduct of business by the partners. So business can be carried by all the partners or one partner on behalf of all other partners. It is decided by agreement. Understood? So if agreement is silent, then every partner has right to participate in the business operations. Management powers of the partners are generally coextensive unless stated otherwise in the partnership agreement. That means equal rights. Each and every partner will have equal rights to participate in the business operations, and they should carry business operations diligently. That means if that business belongs to them, how much reasonable care they exercise, same level of reasonable care they should exercise with respect to business operations of the partnership firm. That means they should not act negligently. And decision making and majority rule, differences on ordinary matters. In case of dispute with respect to ordinary matters, in case of conflict with respect to ordinary matters, that dispute can be solved by consent of majority of partners. That means more than half of the partners, if they are okay with the new object, then it can be carried out. All ordinary matters, disputes can be resolved by majority partners consent. But if it is a matter, if every partner has right to express, every partner has right to express their opinion before decisions are made, and no change in the business nature without unanimous consent. So if it is not an ordinary matter, it's an extraordinary matter, unusual matter, like change of objects, change of business nature, change of business objects or change of business nature. So for that, unanimous consent is required. All other matters, ordinary matters like increase of production, decrease of production, selecting a supplier, okay, listing out the suppliers, appointment of the managers, all ordinary matters, all usual matters, majority consent is sufficient, but fundamental changes, fundamental, deed changes, it requires consent of all other partners, all partners. Simply, it's unanimous consent. Right to access and inspect books of accounts. Whether you are a sleeping partner or not, you can inspect books of accounts to know whether your profit share is correct or not. You can also inspect books of accounts, and but one condition, that right should be exercised in good faith. That means only for partners' benefit, only for all the collective benefits of the partners. This right should be exercised. You should not steal some information which is very confidential so that you can sell it. You can make more profits by selling that confidential information with the competitors. So simply, copyrights, trademarks, patents, these kind of things, secret information, you should not inspect with an intention to sell that information to the competitors. Rights of legal heirs, rights of legal representatives of a deceased partner. Upon a partner's death, their heirs, legal representatives, or unauthorized agents have right to access and inspect the firm's books with respect to full and final settlement. You all know, when a partner got deceased, so their legal heirs are entitled to get full and final settlement. Here they will get, capital contribution by the deceased partner plus share of profits, deceased partner share of profits. These two amounts they are entitled to. Whether these amounts are correctly determined or not, for that they had a right to access books of accounts. They had a right to access books of accounts, and they had a right to inspect books of accounts. Next one, section 13 of Indian Partnership Act, which deals with mutual rights, mutual liabilities of all the partners in the partnership firm. This is like default application in the mobile. By default, certain rights they will get. If they want any modification in these rights, those modifications is possible only when there is an express provision in the partnership agreement. Only with the express provision in the partnership agreement, these rights can be altered, these rights can be changed. Understood? So right to remuneration. Actually, every partner should work for an association for the collective benefit of the association. Generally, no partner is entitled to the remuneration. But if you want to take remuneration, the same point should be dealt in the agreement. Understood? So in agreement, if it is telling that all active partners will get 30,000 per month remuneration, now all active partners are entitled to claim remuneration. Dormant partners, no remuneration. Sharing of profits, generally equal ratio. But if agreement is telling that 1:2:3 ratio, then follow that ratio. Interest on capital, generally no interest, but if it is specified in an express agreement, or if a trade customs allows to claim interest on capital, then they are entitled to claim interest on the capital. Interest on advances, yes, they are entitled to claim interest on advances. This is a loan. This is not a capital contribution. This is a loan. On loans, partner is entitled to take interest. How much? 6% per annum. 6% per annum, and interest on advances continues even after dissolution of the firm until payment. Closure of business will not remove the right of claiming interest on advances. They can claim interest on advances even firm got dissolved or relationship got dissolved. Until they get payment, they are entitled to claim interest. Indemnification by the firm. So firm must indemnify a partner for payments or liabilities incurred in the ordinary and proper conduct of the business. Suppose one supplier came to the firm and demanded the money. So today is due date. If you don't pay money today, we will file case on you. Now partner verified bank accounts, and partner came to know that bank account is not having sufficient balance. Now partner, out of his own pockets, he paid amount to the supplier. Later that partner will get indemnity from the firm. That means all other partners will make payment to that partner. Respect to shares. Indemnification of the firm. Suppose any partner negligently, intentionally or unintentionally, incurred, created loss to the firm. Now that partner must indemnify the firm for any loss caused by their willful neglect in conduct of the business. So this is also by default, this right is available. Right, this is a right in favor of firm, and this is a right in favor of partner who is taking care of firm. Getting it? Next one, partnership property, section 14 and 15, dealing with the property of the partnership. See, generally partnership is not a separate legal person. It's just a relationship. It's just a relationship between partners. It's just a relationship between partners. Now in this case, listen carefully. In this case, what would be the property of the partnership? So can partnership acquire property in its own name? Actually, no. But here we can make a distinction, which property belongs to partnership, which property doesn't belong to the partnership. The partnership property is nothing but who are the owners of the property. All partners are owners of the partnership property jointly, not single owner. All of us are owners to the property. Whether all of us are owners to the property or not, it depends on the agreement. So whatever contributions made by the partners, yes, it becomes partnership property. All partners will have a right over that contribution amount in the case of closure of the business entity. Partnership property acquired for the business, any property, any vehicle or anything purchased by the firm for business, it will become partnership property. And goodwill. So goodwill is nothing but brand, image or reputation. So which creates some advantage, additional benefit to the firm when compared to the competitors. So how can we calculate goodwill? It is based upon the future profits which are above the normal earnings. Suppose our competitor C is getting 10,000 rupees profit per day, and we are getting, ABC and Co. For example, ABC and Co. is getting a profit of 12,000 per day. Competitor is getting 10,000 per day, we are getting 12,000 per day. That extra profit, actually normal course of business, ordinary course of business, 10,000 is the profit, but we are earning 20% extra. The 2,000 would be abnormal profits. Based on this, we calculate goodwill, and it can be sold. It can be sold as similar to other asset also. A partner may agree not to engage in similar business post sale within the reasonable limits. Once any partner selling goodwill, that means what? He's a retiring partner. Generally, what he will do? Retiring partner, along with his capital contribution and share of profits, he will also take certain portion of goodwill. Now once he took these three amounts, he is not permitted to carry similar business operations within reasonable local limits. Locations, it's all about city, town, village limits. Property of a partner. So here I am talking about individual properties of the partner. Property owned exclusively by a partner, personal property, it remains personal property, not part of the partnership unless specifically agreed to convert into partnership property. So he took consent of all other partners and he told that this property, my property, will become partnership property. All the partners agreed, it becomes a partnership property. Now application of property of the firm. Firm's property must be used solely for the purpose of the firm. Partners shares an interest in the firm's property but have no proprietary right in the firm's assets during partnership. Partners can ensure property is used exclusively for partnership business. Partnership property should be utilized only for partnership business operations. It should not be used for the benefit of individual partners. If they use and if they get any profits, they cannot enjoy with the profits. They should compensate firm. They should return the profit or benefit that arises by using firm's property shall be transferred to firm account. So if a partner makes any profit from transactions related to the firm or uses the firm's property, business connection, business name for personal gains, then he must account the personal gains to the firm. As an individual, you are not entitled to these profits. You utilized firm's name, you used firm's assets, and you got this gain. So you have to transfer these gains to the firm account. Getting it? Next one, competing business. If a partner engage in a business that is similar to and competes with the firm's business, they must pay any profits earned from the business to the firm. So here, utilization of firm assets. Here, carrying similar business. Similar business means business of the firm. So, in addition to firm business, I started my own business, which is similar to partnership business. Now, what possibility is there? Here, you may divert few customers of the firm to your individual business in order to take 100% profits. Allowed or not at all allowed? Not at all allowed. Getting it? Next one, rights and duties of a partner after a change in the firm under section 17 of Indian Partnership Act 1932. Even after changes in the firm. That means, for example, A, B, C and Co partnership firm is there. C got retired, D got admitted. So there are changes in the firm. That changes in the firm will not affect the rights and duties of the partners. Unless otherwise agreed in the agreement, all the rights Mr. A, Mr. B, all the duties Mr. A, Mr. B having same rights, same duties shall prevail. Next one, even after expiry of firm term. Suppose you established a partnership for fixed period. Now, even after expiry of fixed term, if you are willing to continue that firm, if you want to make it to partnership at a will, all existing partners' rights, all existing partners' duties will prevail without any changes. Of course, if they want to change their rights and duties, it is possible through amendment to the agreement. Additional undertaking, suppose particular partnership is there, so when project gets completed, it is accepting second project, it is accepting subsequent projects, so it itself is becoming a general partnership. Particular partnership is getting converted into general partnership. Now, in this case also, let me tell you, in this case also, the rights and duties of existing partners will not change simply because of accepting second subsequent projects. Getting it? So after changes in the firm, after expiry of the firm's tenure, after completion of specific project, if they still continue, there will be no changes in the rights and duties of the partners. Next one, relations of partners to the third parties. So here, I'm talking about, so far I talked about, I revised with you regarding partner A, partner B, partner C duties. Now, ABC individual partners formed ABC and Co. And this ABC and Co. is dealing with outsiders, third parties. Example, creditors, example, debtors. Now, what would be the consequences? Let's see. Every partner is an agent to the firm. A partner acts both as a principal and agent. As an agent, whatever acts you did, all other partners are liable. As a principal, you are liable for the acts of active partners who acted as an agent. When acting for the firm, the partner is an agent and binds the firm. As a principal, partner acts for his own interest. As an agent, he acts for the interest of the other partners. See here, one more point also we need to think about. We need to think. Suppose Mr. A is having a family. He is entering into some transactions for his family. Now, for these transactions, BC are not liable. BC are not liable. Each and every individual will have a family. Each and every individual will do some things for their family in addition to the partnership. Now, all the personal things, all the personal transactions entered by them will not affect firm's liability, will not affect other partners' liability. They are personal contracts. In personal contracts, individual partners who entered into those personal contracts are responsible. This rule applies only to the actions done for the business of the firm, not personal dealings between the partners. Next one, implied authority of partner as agent of the firm. A partner has implied authority to bind the firm by actions done in the usual course of business. See, just look at the point, ma. First of all, authority is of three types. It's important to know authority is of three types: express, implied, emergency. Express authority is possible through deed or agreement. Implied authority is possible through conduct. Emergency, it all depends upon the circumstances where communication is impossible, but still partner is doing some acts for the benefit of for the collective benefit of the firm. We call that emergency authority. Now, implied authority, it's not possible everything to be written. Sometimes some acts he can do by implied authority. So he can do acts in implied authority only in the name of firm, and it is a usual course of business. It should be in ordinary course of business operations. The authority covers acts done in the firm's name or in any manner expressing the intent to bind the firm. See whether acts are covered within the implied authority or not. Let's see. Following all these acts are not covered in implied authority. Let's see. First one, submit a dispute to the arbitration. In case of dispute, if you are going to court, definitely it comes under ordinary course of business. But to the arbitration for compromise, this is something, it's not usual course of business. So this is not covered in implied authority. If you want this authority, it is possible only by express. Mention this point in agreement. Managing partner will get a power to submit a dispute to arbitration. Like that, if you write by express authority, he get power to submit a dispute to the arbitration. Opening bank account not in the name of firm but in his own name. If you are opening bank account in firm name, it's usual course of business. But if you are opening a bank account in your personal name, it's not usual course of business, not covered in implied authority. Compromises relinquish any claim of the firm. Suppose you filed a case on debtor. Debtor is liable to you 50,000. He is not making payment. Now you filed a case on debtor. Firm filed a case on a debtor. Now you entering into an agreement to compromise with the claim. Okay, we will no need to pay entire amount, pay me 10,000, I will withdraw the case, I will withdraw the suit. So all these you will not get within the implied authority. Next one, admit liability in a suit against firm. Suppose creditor filed case on the firm. Now, as long as case is running, don't interfere in that operations. Don't interfere in the legal proceedings. If you want to interfere in the legal proceedings, get authority from other partners. Get authority expressly. Getting it? Now, we will okay. We will accept the liability. Creditor, how much amount we are liable to you? 70,000. Okay, we are admitting the liability. Don't do these things without express authority. Acquire or transfer immovable property. If you want to transfer immovable, sell, if you want to sell immovable property, or if you want to purchase immovable property, you won't get that authority by implied. And if you want to enter into a partnership on behalf of our partnership firm, you can't get that authority by implied. You need to get that authority by express. So in an examination they may ask you whether they are covered within the implied authority or not. So it's not covered under implied authority. Mode of binding the firm. For a partner act to bind the firm, it must be done in firm's name or in a way that implies intention to bind the firm. The act must be related to the usual business of the firm. First of all, you have to do the act in the good faith. You have to do the act in the name of firm, and it should be in the usual course of business, ordinary course of business. Of course, if it's a partnership for general commercial nature, you can do these things. All these are covered. So you can sell pledge partnership property, you can buy goods on credit basis, you can sell goods on credit basis, you can borrow money on behalf of firm, you can also transfer, you can also create, you can also transfer negotiable instruments. Next one, extension on restriction of implied authority of the partners. Partner can restrict each other's implied authority by mutual agreement. Yes, by default you will not get these powers, but if you write them in agreement, so these powers are given to the managing partner, so managing partner will get these powers. So extension is possible. Dormant partner can't do these things. Restriction is also possible. So condition for restrictions: first, agreement should be there and it should be communicated with the third party. About restrictions, you have to communicate with third party. So third party must have knowledge about the restrictions. So with whom we should deal, with whom we should not deal. So that information to third party must be made available. And consent of all partners is necessary for extending the powers as well as restricting the powers. Next one, partners authority in emergency. Partners authority in emergency. Suppose partner B is not taking, partner A, partner B, partner C. Partner B is taking about care of finance activities. One day B was absent. Supplier issued a notice to A. If you fail to pay the amount, within 2 days, we are going to sue you legally. Now A immediately he tried to communicate with B, but B is not available. So now A went to cash box. A took some cash and A paid that amount to supplier. Now this is an act which is done in emergency situations. To protect firm from legal proceedings, Mr. A is acting in a good faith. And here communication with B is not possible at that point of time. Now act of partner A, we said we can treat it as act in emergency. Now any act, if it is done in good faith, if it is done in the usual course of business, then those acts which are done during emergency, for those acts, the entire firm is liable, entire firm is responsible. Everyone getting my point? So next point is effect of admissions by a partner. It's like admitting the liability. So or making claims. Understood? So effect of admissions by the partner. Partners can make binding admissions, but only for partnership transactions in the ordinary course of business. So making a purchase transaction, incurring a liability, acquiring asset, all this partner can do only in the ordinary course of business, and he can represent partnership firm only if the transaction is in ordinary course of business. Understood? Admissions or representations will not bind the firm if partner's authority is limited and the other party knows this. Suppose partner C is not having authority to make collections from the debtor. Partner C is not having authority. Now if debtor is making payment to C, that payment to C is not payment to the firm. If third party knowingly makes payment to C, that C is not having authority, but still debtor is making payment to C, this case firm is not responsible. Admissions and representations by partner affect the firm when made by the third parties, but not affect partners in disputes. So this is all about, with the third parties, whatever admissions or representations made with the third parties, it will affect the firm. And whatever admissions, whatever statements made by the partners internally to solve their disputes or to affect the other partners, it will not affect the firm. Getting it? So if a statement is made with a third party and third party acted according to the statement, firm is responsible. However, firm is not responsible if that person making a statement had no authority to do the act. Next one, notice. This is very simple. Notice to active partner. Notice to active partner is equal to notice to firm. Suppose a debtor became insolvent. Debtor become insolvent. Court issued notice to all his creditors. One of the creditor is our partnership firm. Now, any notice given to the active partner, it is deemed that notice is given to the firm. Accordingly, firm is responsible, and that notice must be actual. It must not be constructive. It should not be a deemed notice. It should be an actual notice. And fraud committed by or with the consent of partners exempts this provision. So, active partner and one debtor intentionally to make a fraud, to get some illegal or unlawful gains, unlawful advantages. If they are making such notices, now firm is not responsible with that notices. Firm is not responsible with that notices. Liability to the third parties. Liability of a partner for act of the firm. Liability of a partner for the act of firm. So, act of the firm, partner is liable when partners are jointly and severally responsible for all acts within their express or implied authority. And the act of the firm includes acts, omissions by any partner or agent of the firm that create enforceable rights for or against the firm. So simply, act of a partner, all other partners are liable if that partner is acting within the authority. And omission by the partner. Because of that omission, if there is any loss to the firm, all other partners are responsible for that loss initially. Liability only applies if that act was done while the person was a partner. That's it. Everyone. So, act of other partners, this partner is liable as if he is a principal to the firm. Everyone. Suppose act means, collections, purchases, incurring liabilities. Omissions like breach of contract. One partner omitted to supply material to customer on agreed date. Now that customer filed a case on our firm. Now, firm is responsible for that case. Even this partner is also responsible. This partner is also having liability towards that damages. Next one, liability of the firm for wrongful acts of the partner. So here, partner is doing some wrongful acts. In that case, what would be the effect on the firm? Firm is liable to the same extent as the partner for any loss or injury caused by the wrongful acts of a partner. So that means, even for wrongful acts of the partner, firm is liable. And it applies if the acts were done in the ordinary course of business or within the authority of the partners. Unauthorized acts, wrongful acts by a partner do not affect firm's liability. Partners are liable for the loss or injury caused by neglect acts of a partner in the ordinary course of business. Suppose, one particular partner collected amount from the debtor and he misappropriated that collection. Now, firm is responsible to the debtor. Firm will not collect a second time from the debtor. So, whatever loss arising due to misapplication of funds, misutilization of funds of the partner, firm will bear that loss. Getting it? Of course, this fraudulent partner has to compensate other partners. That is altogether different. Now I'm talking from third party point of view, whether firm is responsible or not. Suppose this partner without authority, he collected amount, debtor negligently made payment to this partner. Now this will not affect a firm's position. This will not affect firm's responsibility. Firm can collect amount from the debtor one more time. Next one, liability of firm for misapplication by partners. So two clauses we are having. A partner misapplying third party property or money even without being in the firm's custody makes the firm's liable when if he is acting within the authority. If he is acting within the authority, whether third party's property or whether third party's money is with firm or not, whether within the firm custody or not, if he is misutilizing them within the authority, if he is misutilizing them, then firm is responsible. If money or property in the firm's custody, in clause B, the custody, the possession of the property, the possession of the money of third party is lying with firm and it is misapplied by the partner. Now it is immaterial whether he is acting within the authority or not, firm is liable. Getting it? So in clause A, clause B, firm is liable. Clause A, clause B, firm is liable. In clause A, possession, that means custody, is with third party, and the partner who is having authority dealing with the third party misapplied the party's property or third party's money. Now also firm liable. Clause B, here the money or property of third party is in the possession of the firm. Now any partner, whether within the authority or without authority, if he is misapplying those assets, then also firm is liable to the third party. If money is received by a partner outside the scope of their authority, the firm is not liable unless it comes under the control of other partners. Simply custody. So unless other partners get custody, firm is not responsible. Similar example, debtor paid amount to a partner who is not having authority, and debtor know the point. This partner is not having authority, but still they made payment to the debtor, that partner. Now payment to the partner who is not having authority, it will not make firm responsible. Firm is not liable. Section 29 regarding the rights. Section 29 is dealing about the rights of a transferee of partner's interest. Here, same partnership firm ABC and Co, where A agreed to transfer his partnership interest to D. A agreed to transfer his interest in D. Suppose A need money. A is having actually 20% share in the partnership firm, and A want to sell this 20% partnership share to D. Can he do so? Yes, he can do so. He can do so. But D, we call him as transferee from now onwards. Mr. Transferee will not have management rights, will not participate in management decisions, will not participate in verifying books of accounts, will not get access of books of accounts. He is simply entitled to the share of profits which A is entitled to receive. Understood? See, a partner share is transferable, but the transferee does not enjoy same rights, same privileges as if he is a original partner. He is not entitled to interfere with the business conduct. He is not entitled to access books of accounts. He is not entitled to inspect books of accounts. However, he is entitled to receive share of profits of transferring partner and must accept profits agreed by the partners. But in one instance, he is entitled to verify books of accounts. In which instance, if firm is dissolved, upon this transfer, if firm is dissolved, he can inspect books of accounts to check whether he is getting correct share or not. So share of, he is entitled to share of firm's assets. So actually, Mr. A, the transferor partner, how much amount he is entitled to. So his transfer is also entitled to same amount. Suppose A is entitled to 30 lakhs. Now transferee D is also entitled to get 30 lakhs. Next one, an account from the date of dissolution to ascertain his share. So from the date of dissolution till the date of payment, whatever result is there, profit or loss, he will also get that share. Capital profits, capital deficiency. Next one, a partner cannot introduce someone as a new partner by transferring their interest without consent of all partners. I told you, admission of a partner requires consent of all partners, or it is decided by the agreement, partnership deed. So first of all, why other partners' consent is required? This logic is very simple. Tomorrow, after admission, act of new person, all other partners are liable. So whether that new person is a man of ordinary prudence or not, whether he is a negligent person or is a good person or not, we need to check, and upon giving consent only he can become a partner of the firm. Upon becoming a partner, he will get all the rights, all the inherent rights he will get. A partner's interest is transferable tangible property. Correct. Next one, section 30 is dealing about minors. Can we admit minor as a partner? Actually no, general rule is no, but minor can be admitted for profits. So only for getting share in the profits, minor can be admitted as a partner, but he is not responsible for the losses. Even tomorrow, if firm is dissolved and if assets are not sufficient to meet liabilities, getting it? Suppose if there is a capital deficiency of 60 lakhs and there are 4 partners, A, B, C and M. M is a minor. Now M is not liable to contribute towards deficiency. So in the worst case, M can lose his capital contribution, but M is not liable for extra liabilities, extra capital deficiencies. That means the 60 lakhs loss should be borne by A, B, C. Understood? So if you look at the rights of minor partner, he is entitled to share in profits of the firm. He is entitled to access, inspect books of accounts. He can sue for the accounts for payment of his share only after getting separated from the firm, only after getting out of the firm. Only after retirement he can sue for accounts, he can sue for his payments. Upon attaining majority, the minor must decide within 6 months whether to continue as a partner or not. Actually, the rule is date of becoming major or date of knowledge that he is a partner in a firm. Whichever is later, from here onwards, within 6 months, he need to make a decision. He need to make a decision whether to continue or not. If he decides to continue as a partner, then his liability is will have a retrospective effect. That means he's not liable from the date of becoming date of exercising the option, but from the date of admission as a partner when he was a minor. Getting it? So he is liable to the third parties for all the acts since he admitted, since his minority. Share in the profits property remains same as when he was a minor. Same, similar share of profits, similar share of properties. Next one, before attaining majority, the liability of the partner, liability of a minor partner is limited to his share in the profits or to his share in the property of the firm. Property of the firm, I told you, contributions made to the firm, it's a property of the firm. Assets, nothing but this will also comes under contributions only. So agreed ratio, for agreed ratios, for agreed shares, he is entitled to get share in the profits, he is entitled to get share in the properties. No personal liability, and he can't be declared as an insolvent. And next one, after attaining age of majority, he must decide within 6 months whether to remain as a partner or not. If he elects not to become a partner, his rights and liabilities remain same as if he is a minor. But he must give a notice. He must give a notice of not becoming a partner. But suppose if he is not giving a notice, if he fails to give notice, automatically he becomes a partner. Next one, if he does not become a partner, his liabilities, his rights will remain same as if he is a minor until he get his share in the profits, until he gets share in the property of the firm, his rights and liabilities remain same. Next one, he is also entitled to sue for recovering those dues. Next one, introduction of a partner. This is all about admission of a partner. I told you admission of a partner requires consent of all partners. This is by default, but however it may be subject to the contract also, subject to the majority of the partners consent also. Admission is possible subject to any contract between them and provisions regarding minors. Next one, new partner rights and liabilities. New partner will get liability from the date of admission, but if he wants share in existing profits at the time of admission, what is the profit of the firm? If he want the share in those profits also, past profits, past properties also, then his liability will be retrospective liability. That means his liability will start from the date of partnership. His liability will start from the date of partnership. That's what unless otherwise agreed means. Okay. And the new firm, including the new partner, may assume liability for existing debts with the creditor's consent. So creditor consent is required. Creditor must consent to accept the new firm as a debtor and discharge the old partners. It's like novation, nothing but novation. Partnership of two partners. If a partnership is with only two partners, for example, A and B, upon death of B, firm will dissolve automatically. Firm gets dissolved automatically, and it's a compulsory dissolution. It's not optional dissolution, compulsory, because for partnership firm, minimum two partners are required. Clear? Next one is all about retirement of the partner. In retirement of the partner, yes, we need to think about 4 points. One is how he will retire. What is the effect of liability? What is the effect of retirement on his liabilities? Whether he is discharged from all the liabilities or not. And what he should do at the time of retirement. What he should do at the time of retirement. So these 4 points you have to revise. One is a partner, how he will retire. He may retire with the consent of all other partners or as per an express agreement with the partners. Suppose, by giving 30 days notice or by giving 3 months notice. So I will retire from the firm. Like that, if you give notice, after expiry of 3 months from giving the date of from giving the notice, he will be treated as retired partner. By giving written notice to all the partners if it is a partnership at will. So in case of partnership at will, by giving a notice to all other partners in writing, yes, he can retire from the firm. And he is discharged from all the subsequent liabilities from the date of retirement. Up to the date of retirement, he is responsible for firm's obligations, firm's liabilities. But from the date of retirement, he is not liable to any third party. He is not liable to the third parties. Liability after retirement. Even after retirement, retiring partner and remaining partners are liable for the acts done when before retirement until public notice is given. Retired partner is not liable to the third parties who dealt with the firm without knowing about the retirement. It's, communication with third parties is sufficient. Whether third parties have read that notice or not, it is immaterial. But after retirement, retiring partner is not liable. Next, a retiring partner may be discharged from the liability of the acts done before his retirement by an agreement with the third party and remaining partners. Even for past debts also, if creditor agrees to discharge him and all other partners are giving consent to discharge him for existing responsibilities, existing liabilities, then also he gets discharged with respect to existing liabilities, existing obligations. This discharge may be implied by a course of dealing between the third party and reconstituted firm after the partner's retirement. Next one, notice of retirement is compulsory in case of in case of partner is getting retired. Of course, notice of retirement is not required for dormant partner, deceased partner, insolvent partner. For these three partners, notice of retirement is not required. Next one, expulsion of partner. Forcefully we are throwing one partner from the firm. We are throwing a partner outside from the existing firm forcefully. So a partner may be expelled if following conditions are satisfied. One is power of expulsion should exist in the contract. Deed should give power to expel a partner. The power is exercised by majority of the partners. Majority of partners consent is required for expulsion of a partner, and that expulsion should be exercised in good faith for the benefit of the firm, for the collective benefit of other partners. The partners should exercise this power. And whether good faith is there or not, we need to check. How can we check? Expulsion is valid if the power was exercised in good faith. If any one of the conditions are not met, expulsion is invalid and not in bona fide interest of the firm. So if it is not genuine, simply he is against to us, he is not accepting our proposals, he is a genuine person, and he is not accepting some unlawful activities, that's why we want to expel him from the partnership. Is it said to be in good faith? No. Satisfaction of above conditions alone is not required. Satisfaction of above conditions except good faith alone not sufficient for expulsion of the partner. All the conditions should be satisfied. Next one, in case of invalid expulsion, that expulsion is treated as invalid. That means the person expelled partner will continue as a partner. Impact on the firm. Expulsion does not necessarily result in the dissolution of the firm. The firm continues unless otherwise stated. And expelled partner's right. Expelled partner is treated similarly to the retired partner under sections 32, subsection 2, subsection 3 and subsection 4. So he is entitled to his share of profits as well as properties. Next one, insolvency and liability of a deceased partner's estate. So in case of insolvent partner, official SNE will get all the rights of insolvent partner. In case of deceased partner, legal heirs, nominees of deceased partner will get all the rights of deceased partner. You see, they will not become partners by default, but they are not they are entitled to. They will not become partners of the firm without consent of other partners. However, they are entitled to claim share in profits and share in properties. And from the date of declaration of insolvency, from the date of death, for subsequent acts, neither insolvent partner nor deceased partner's estate held liable. Getting it? So simple points, just go through these points. Next one, yeah, you can go through it. Let me read it. A partner ceases to be a partner when adjudicated as insolvent starting from the date of adjudication order. Date of declaration, from the date of declaring him as an insolvent, is not responsible. If partnership agreement allows, firm may continue despite insolvency of a partner. Firm will still continue its business operations. Sorry, small disturbance. Now listen carefully. So insolvency of a partner ceases to be a partner. I told you, in case of insolvency of a partner, in case of deceased partner, so subsequent to the date of declaring him as an insolvent partner or date of death, he or his estate not liable. Understood? Not liable for subsequent acts. Even in case of partnership agreement allows, even in case of insolvency of a partner, if partnership agreement allows to carry business operations, then they can carry business operations. There would be no effect. After adjudication, the estate of insolvent partner is not liable for any future acts of the firm. Next one, the firm is not liable for any acts of the insolvent partner after adjudication. It's like vice versa. Insolvent partner is not liable for subsequent acts of the firm. And next one, firm is not responsible for the acts of insolvent partner from the date of declaration, from the date of adjudication. I'm not liable for your acts, you are not liable for my acts. Next one, deceased partner. Generally, death of a partner leads to the dissolution of the partnership unless specified otherwise in the partnership contract. If partnership contract, partnership deed allows to continue business operations even an active partner got deceased, then they can continue business operations, or else business operations can't be continued. If partnership agreement allows, the death of a partner will not dissolve if there are more than two partners. Suppose A, B, two partners are there, B got deceased. Now they can't continue business operations in the name of partnership. Why? Partnership requires minimum two partners. One partner already deceased, right? So compulsory dissolution. Suppose three partners are there, one partner deceased. They can still continue business operations if deed permits them. The estate of deceased partner is not liable for the future obligations of the firm unless specified in the agreement. Clear? Next one, rights of an outgoing partner. Rights of the former partner or rights of the legal heirs of the deceased partner. See, they are entitled to get share in the profits, accumulated profits so far. They are also entitled to get share in the properties. So outgoing partner may carry on a competing business subject to partnership agreement. If partnership agreement imposes a restraint of trade, then they are not allowed to carry competing business, or else they can carry similar business. Competing business means a business in competition with the partnership firm. Outgoing partner cannot use firm's name because he already retired. He cannot represent the partnership firm. He cannot solicit partnership customers. Next one, a valid agreement in restraint of trade can be made prohibiting outgoing partner from competing within the specified limits, like state of Andhra Pradesh or state of Tamil Nadu don't do similar business. So like that, restraint of trade is possible. Next one, rights of outgoing partner regarding his estate. Rights of a deceased partner regarding his share of profits, his share of estate. Let's see, if a partner dies, that means death of a partner or ceases to be a partner, like insolvent or retirement, then the firm continues and the firm continues. Look at the conditions, ma. Look at the conditions. Very, very simply, conditions were prescribed. Firm, a partner died or partner retired, but still firm is continuing business operations. Then outgoing partner or their estate is entitled to share of profits made since their departure. Even they get departed, even they got retired, he got deceased, his legal heirs are still entitled to get share of accumulated profits, share in the firm's properties. The outgoing partner is entitled to either a share of the profits or interest on their share in the firm's property. Now, the point is, suppose they are not getting paid, they are not getting a full and final settlement, F&F not over. Now, for the period of full and final settlement is pending, on their outstanding dues, they are entitled to either 6% interest, like a creditor getting interest, or they are entitled to get share of profits. But simply getting share of profits for the period, it doesn't mean they're partners. Why? There is no mutual agency concept. Already retired. Now his acts, firm is not liable. Firm's acts, he is not liable. Mutual agency is not there. Therefore, he's not an act. He's not a partner. If there is a contract giving continuing partners the option to buy out deceased or outgoing partner's share, the estate loses the right to further profits. Once F&F is over, that means existing partner paid sufficient consideration to the outgoing partner regarding all outstanding dues. Now, with respect to future profits, you will not get any share. If continuing partners do not comply with the terms of the option, they must account for profits as stated in this section. That means if acquisition of outgoing partner share not happened, then whatever profits firm is generating over a period of time, from now onwards, whatever profits firm is creating, all those future profits, firm should give certain share of profit to the outgoing partner or legal heirs of the deceased partner. Now, change in the firm constitution will definitely affect continuing guarantee. What is continuing guarantee? You all know. In indemnity and guarantee chapter, guarantees of two types. When a guarantee is given to the specific transaction, specific guarantee. When a guarantee is given to the series of transactions which can be extended to the future, series of transactions extended to the future, we call it as a continuing guarantee. Now, whenever there is a change in the firm, continuing guarantee gets revoked subsequently. That means guarantee with respect to future transactions comes to an end. Next one is all about registration of firms. Is registration mandatory? It's optional. It's just optional. But if you are acquiring any immobile properties, or if you are acquiring immobile properties in the name of firm, listen carefully. If you are acquiring immobile properties in the name of firm, not in the name of firm, sir, but jointly in the name of Mr. A, Mr. B, Mr. C, then also firm registration is not required. But if you want to register property in the name of firm, or if you want to take loans from banks, compulsory to have a registration. And you have to file an application for registration. In that application, you need to furnish these details. Along with that, verification statement is compulsory. So it's like a declaration. Whatever information we submitted, it is correct and complete. And there is a restriction on the usage of firm's name. Firm's name should not contain these words. If you want to use these words, it requires prior approval of state government. Next one, registration process. Once registrar is satisfied with the application, he will issue certificate of registration. First, he will enter the name of firm in the register of firms maintained by the registrar. See, registrar is a person. Register is a document. Registrar is a person. Registrar is a document. In the document, he will enter the details of the firm and he will issue certificate of registration. Understood? And from the date of filing an application with the registrar and from the date of payment made to the registrar, unless rejected by the registrar, unless rejection made by the registrar, we can assume that firm is a registered firm. And registration may occur even after a suit has been filed, but the suit must first be withdrawn. Afterward, firm must be registered before filing a new suit. What all about this point? I will tell you. Just keep this point pending. See, if you look at the consequences of non-registration, you will get to know about this point. But before that, one small point is there. Let me tell you that small point. Small point is late registration on payment of penalty. So, per year, in case of delay, firm was constituted in the year 2009 and you're registering that firm in the year 2011. So how many years delay happened? 2 years delay happened. For each year, 100 rupees is the fine. So pay 200 rupees penalty and you will get firm registered. You will get registration of the firm certificate. Okay. Even for part of the year also, you need to pay 100 rupees. So 2 years, 1 month delay, sir. Pay 300 rupees. That's it. Consequences of non-registration. In case of non-registration, what are the consequences? Suppose, there is a dispute between firm and a third party. So in the case of dispute, actually firm with third party, in any contract, both the parties will have rights and duties. Yes or no? Rights and duties. My right is your duty and your duty is my right. Same point only. Your duty is my right. My duty is your right. Now, if a firm is unregistered firm is responsible for duties, but firm can't exercise rights. Firm cannot exercise rights. Suppose third party is a debtor. Firm is having a collection from debtor. Can firm take action against debtor if it is an unregistered firm? No. Suppose third party is a creditor. Can creditor take action against firm? Yes. Even that firm is unregistered firm, that unregistered firm is liable to creditor. But unregistered firm cannot exercise rights over debtors. Understood? So it cannot file a suit against third party and it cannot claim set off. An amount exceeding 100 rupees. If you want to exercise set off, up to 100 rupees set off is possible whether you are registered or unregistered. But exceeding 100 rupees, if you want to claim set off, only registered firms are eligible. And no legal action against the firms or partners. Even partner cannot sue firm. Firm cannot sue partners if that firm is unregistered firm. But if a partner is getting retired, if he is becoming a former partner, so legal heads of the former partner, legal heads of the deceased partner or retiring partner can take action against the firm because they are not connected with the firms, they are third parties. So third party can bring action against unregistered firm. However, unregistered firm cannot bring action against third party. Now, suppose, it filed a suit in the court of law and court rejected the claim because you are unregistered. Now, you just now get yourself registered. Withdraw old case, file new case. Now in new case, you are a registered firm. Now your case will be valid, your case will be acceptable. Your case will be accepted. Understood? Exceptions to the disabilities. third parties can still sue the firm, whether firm is registered or unregistered, third parties will sue. Partners can sue for dissolution, so dissolve the firm. Like that, they can file a case, but they cannot file a case for for getting dues, for getting loans, for getting advances which they provided to the firm. Without dissolution, without sue for dissolution, they cannot claim their dues. Official SNEs or courts receives can release the property of an insolvent partner and bring actions. And next one, for a set off of 100 or less, disabilities are not there. Legal representatives of deceased partner can claim accounts or property, even though firm is dissolved. Sorry. Even though firm is unregistered firm, unregistered partnership firm, these disabilities are not there. But as an unregistered firm, these disabilities are there. So gunshot point unregistered partner cannot exercise its rights. Exercise of rights is not possible, but it is responsible for its duties towards third party. That's it. Even set off is also not possible. Clear? Next one, if a registered firm undergoes any changes, change of partners, immediately it should be notified to the registrar for a new partner's name to appear in the registrar of firms. Without such notification, the firm cannot sue as a new partner name will not be listed. Firm cannot sue as the new partner's name will not be listed. So only after amendments to the firm, after registration of amendments to the firm will get again powers to sue third parties. Next one, dissolution of firm and dissolution of partnership. One small point you have to understand. Dissolution of partnership means dissolution of relationship. Here relationship is getting dissolved. Dissolution of firm means here business is getting dissolved. Relationship dissolved. In addition to this relationship, firm is also getting dissolved. When both are getting closed, we call it as dissolution of firm. Suppose A, B, C and co, 3 partners are there. C is getting retired. Now, relationship is getting changed, but there is no effect on business. Business is still continuing. Then we call it as dissolution of partnership. No, sir. They decided to stop business also. Now it is said to be dissolution of partnership firm. Because of dissolution of firm, dissolution of partnership will automatically happens. But dissolution of partnership will not result into dissolution of firm. Getting my point? Relationship got affected, sir. But firm deed is telling, firm can continue business operations. Then it will not result to dissolution of firm. But in case of dissolution of firm, automatically dissolution of partnership will take place. Getting it? Just look at the scope. Necessarily involves dissolution of the partnership. But here, it may or may not involve the dissolution of the firm. So happening 1, definitely 2 will happen. Happening 2, it will not imply that 1 will happen. 1 will not happen. Because of happening 2, 1 will not happen. Understood? Next one, modes of dissolution of firm. Dissolution of firm can be happen voluntarily or compulsorily. Voluntarily, it can happen by agreement. Compulsorily, it can also happen by agreement. In addition to that, it can also happen by the order of the court. Okay. See, partners can dissolve the partnership by mutual agreement or in accordance with the contract, in accordance with the deed. So, if you take a particular partnership or if you take partnership for fixed duration, particular partnership or partnership for fixed term. So upon happening of those completion of projects or upon completion of their tenure, partnership will be dissolved. Next one, compulsory dissolution. Firm is dissolved compulsorily if an event makes it unlawful or business to continue or for the partners to carry on business together. However, multiple activities are involved. Only illegal ones will cause dissolution. This means suppose ABC and Co are engaged in selling alcohol. Now, government passed an order. Sale of liquor by private individuals is illegal. Only government agencies will sell alcohol. So, private individuals cannot deal with alcohol. Now, the business of ABC and Co became illegal. So, firm will be dissolved compulsorily. Suppose ABC and Co involved in 2 activities. One is, printing of books. Second one is preparation of alcohol. Now, only alcohol business gets dissolved, whereas printing of books business will continue. Next one, dissolution on happening of certain contingencies, like death of the active partner, insolvent of the active partner, insane of the active partner. In these contingent events also, in case of these contingencies also, firm can be dissolved. Next one, if it is a partnership at will, dissolution is possible if any partner is writing a notice writing, giving a notice, written notice to all other partners about his about his intention to dissolve the firm. If a date is mentioned, the dissolution occurs on the date, otherwise it happens upon communication. Whatever date mentioned in the written notice, from that date onwards, firm gets dissolved. If remaining partners want to continue business operations, they will form a new partnership, they will form a new firm, that new firm will take up new business activities. Next one, dissolution by the court. So in the following cases, any partner can file a complaint with the court and can request court to dissolve the firm. So suppose active partner became insane or unsound mind. Active partner met with an accident. So permanent incapacity. Some managing partners are involved in misconduct activities or some breach of agreement activities. Suppose active partner transferred his interest to another partner or another outsider, or continuous losses in case of continuous losses, or valid justifiable grounds. For example, deadlock in management. Suppose A, B and co. If A is saying okay, B is not agreeing. If A is not agreeing, then B is agreeing. That means without consent of these partners, nothing can be nothing can be taken place, nothing can be done. So if there is a deadlock in the management, if they are not deciding about the matters, then also one particular partner can approach court for dissolving the firm. And partners are not on speaking terms, that means they are not following partnership deed terms and conditions. Loss of substratum, loss of the stand for which they formed a partnership, loss of trust. Next one, partner involved in the gambling activities, any partner involved in the gambling activities. So in all these cases, if a partner is filing an application for dissolution of the firm, then court can decide whether to dissolve or not to dissolve. And upon dissolution, what would be the consequences? So this is the last point of the partnership, last point. So upon dissolution, what are the consequences? So liability is for acts of partner after dissolution. Partners remain liable for the acts done after dissolution until public notice is given. So without giving public notice, even if firm is dissolved, partners liability will still continue. But this notice, the provision of giving notice is exempted to deceased partners, death partners, insolvent partners, dormant partners. And rights of partners to have business wound up, they can proceed with the closure of the firm, that means selling the properties and settlement of the outside liabilities. Continuing authority of partners for winding up, if they decide to wind up the firm, so if they want, they can do the same. Understood? See, first of all, rights of partners to have business wound up. Once business is wound up, they had a right to get share in the profits, right to share in the properties. Understood? In case of closure of business, the result, if it is a positive result, surplus is there, they will distribute that surplus. Getting it? And they can also proceed with winding up. Happening of this thing, second thing will happen. 1, 2. Next one, mode of settlement of the partnership accounts. Rules for settling. Let me read it. Partners retain authority to bind the firm for winding up purposes and completing unfinished transactions like selling assets, settlement of the outside liabilities. Partners adjudicated insolvent cannot bind the firm. Yes, insolvent can make firm liable subsequent to insolvency, subsequent to the order of adjudication. Next one, mode of settlement of partnership accounts. Suppose just look at the balance sheet. Partners contribution 30 lakhs. Partners accumulated profits 30 lakhs. Outside liabilities 30 lakhs. Fixed assets plus current assets put together 90 lakhs. So total how much? 90 lakhs. But when these assets were sold, they got 120 lakhs. Now from 120 lakhs, first you settle 30 lakhs outside liabilities, remaining 90 lakhs. Out of remaining 90 lakhs, first distribute profits. First distribute partners dues. What is the dues of the partner? 30 lakhs is the due. So distribute dues. Now remaining 60 lakhs. Okay, partners dues means what? Partners will dues means partner will get a share of contribution. Partner will also get share of accumulated profits. So that means minus 30 minus 30. So what is the capital surplus? 30 lakhs. Upon dissolution, capital surplus of what? 30 lakhs is there. This 30 lakhs is distributed by the partners in the same ratio. Suppose in case of losses, in case of losses, suppose sale value of all these assets is, imagine sale value of all these assets is 20 lakhs. Now with this 20 lakhs, you can't settle outside liabilities. So there is a deficiency of 10 lakhs. So towards this 10 lakhs, other partners, all partners of the firm should contribute towards the deficiency. So contribution will take place. That means first there is a loss. How much? 20 lakhs is the realizable value of assets. But looking at the balance sheet liability side is 90 lakhs. So the deficiency of 70 lakhs, if you observe, first you set off with accumulated profits. Next, you set off with contributions. Balance, if any, partners should bring that amount. So losses paid from profits, capital, and then by partners individually. Partners should bring deficient amounts from their personal assets. Next one, payment of firm debts, payment of separate debts. Firm assets should be utilized for firm liabilities. Partner assets should be used for partner liabilities. Inter, that means, changing is not possible. Firm assets responsible for firm liabilities. Partner assets are responsible for partner liabilities. You cannot make partner assets. See, you cannot make directly partner assets to firm liabilities, or you cannot make firm assets liable to partner liabilities. Interchange not possible. But of course, with respect to firm, if assets are not in a position to meet liabilities, then partners net assets means what? After deduction of his liabilities from the assets, whatever net worth is left, that net worth is responsible for firm liabilities. Similarly, firm net worth is responsible for partners liabilities. Getting it? My assets, my liabilities, whereas my net worth with respect to firm's liabilities. Okay, firm assets, firm liabilities, but firm's net worth is responsible for my liabilities. I mean, my share in firm's net worth is responsible for my liabilities in case of my insolvency. So with this, revision of partnership completed.